Section 105 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 17, The Only Game in Town. But Fannie and Freddie were the only game in town once the housing market dried up in the summer of 2007, Paulson told the FCIC. And by the spring of 2008, the GSEs, more than anyone, were the engine we needed to get through the problem. Few doubted Fannie and Freddie were needed to support the struggling housing market. The question was how to do so safely. Purchasing and guaranteeing risky mortgage-backed securities helped make money available for borrowers, but it could also result in further losses for the two huge companies later on. There's a real trade-off, Lockhart said in late 2007. A trade-off made all the more difficult by the state of the GSE's balance sheets. The value of risky loans and securities was swamping their reported capital. By the end of 2007, guaranteed and portfolio mortgages with FICO scores less than 660 exceeded reported capital at Fannie Mae by more than 7-1. Alt-A loans and securities by more than 6-1. Loans for which borrowers did not provide full documentation amounted to more than 10 times reported capital. In mid-September, OFHEO relented and marginally loosened the GSE's portfolio cap from about $728 billion to $735 billion. It allowed Fannie to increase the amount of mortgage loans and securities it owned by 2% per year, a power that Freddie already had under its agreement with OFHEO. OFHEO ruled out more dramatic increases because the remediation process is not yet finished, many safety and soundness issues are not yet resolved, and the criteria in the Fannie Mae Consent Agreement and Freddie Mac's Voluntary Agreement have not been met. As the year progressed, Fannie and Freddie became increasingly important to the mortgage market. By the fourth quarter of 2007, they were purchasing 75% of new mortgages, nearly twice the 2006 level. With $5 trillion in mortgages resting on razor-thin capital, the GSEs were doomed if the market did not stabilize. According to Lockhart, a withdrawal by Freddie Mac and Fannie Mae, or even a drop in confidence in the enterprises, would have created a self-fulfilling credit crisis. In early October, Senator Charles Schumer and Representative Barney Frank introduced similar bills to temporarily lift portfolio limits on the GSEs by 10%, or approximately $150 billion, most of which would be designated for refinancing subprime loans. The measures, which Federal Reserve Chairman Ben Bernanke called ill-advised, were not enacted. In November, Fannie and Freddie reported third-quarter losses of $1.5 billion and $2 billion, respectively. At the end of December 2007, Fannie reported that it had $44 billion of capital to absorb potential losses on $879 billion of assets and $2.2 trillion of guarantees on mortgage-backed securities. If losses exceeded 1.45%, it would be insolvent. Freddie would be insolvent if losses exceeded 1.7%. Moreover, there were serious questions about the validity of their reported capital. End of section 105. Section 106 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 17, It's a Time Game, Be Cool. In the first quarter, real gross domestic product fell 0.7% at an annual rate, reflecting in part the first decline in consumer spending since the early 1990s. The unemployment rate averaged 5% in the first 3 months of 2008, up from a low of 4.4% in spring of 2007. As the Fed continued to cut interest rates, the economy was sinking further into recession. In February, Congress passed the Economic Stimulus Act, which raised the limits on the size of mortgages that Fannie and Freddie could purchase, among other measures. The push to get OFHEO to loosen requirements on the GSEs also continued. Schumer pressed OFHEO to justify or lower the 30% capital surcharge. Such a stringent requirement, he wrote Lockhart on February 25, hampered Fannie's ability to provide financing to homeowners. 2 days later, Fannie CEO Mudd reported losses in the fourth quarter of 2007, acknowledging that Fannie was working through the toughest housing and mortgage markets in a generation. The company had issued $7.8 billion of preferred stock, had completed all 81 requirements of the consent agreement with OFHEO, and was discussing with OFHEO the possibility of reducing the 30% capital surplus requirement. The next day, Freddie also reported losses and said the company had raised $6 billion of preferred stock. As both companies had filed current financial statements by this time, fulfilling a condition of lifting the restrictions imposed by the consent agreements, Lockhart announced that OFHEO would remove the portfolio caps on March 1, 2008. He also said OFHEO would consider gradually lowering the 30% capital surplus requirement because both companies had made progress in satisfying their consent agreements and had recently raised capital through preferred stock offerings. Mudd told the FCIC that he sought relief from the capital surplus requirement because he did not want to face further regulatory discipline if Fannie fell short of required capital levels. On February 28, 2008, the day after OFHEO lifted the growth limits, a New York Fed analyst noted to Treasury that the 30% capital surcharge was a constraint that prevented the GSEs from providing additional liquidity to the secondary mortgage market. Calls to ease the surcharge also came from the marketplace. Mike Farrell, the CEO of Annaly Capital Management, warned Treasury Undersecretary Robert Steele that a crisis loomed in the credit markets that only the GSEs could solve. We believe we are nearing a tipping point. Lack of transparency on pricing for virtually every asset class and a dearth of buyers foreshadowed worse news, Farrell wrote. Removing the capital surcharge and passing legislation to overhaul the GSEs would make it possible for them to provide more stability, he said. Farrell recognized that the GSEs might believe their return on capital would be insufficient, but contended that they will have to get past that and focus on fulfilling their charters because the big picture is that right now, whatever is best for the economy and financial security of America trumps the ROI, return on investment, for Fannie and Freddie shareholders. Days before Bear Stearns collapsed, Steele reported to Mudd that he had encouraging conversations with Senator Richard Shelby, the ranking member of the Senate Committee on Banking, Housing, and Urban Affairs, and Representative Frank, chairman of the House Financial Services Committee, about the possibility of GSE reform legislation and capital relief for the GSEs. He intended to speak with Senate Banking Committee Chairman Christopher Dodd. Confident that the government desperately needed the GSEs to back up the mortgage market, Mudd proposed an easier trade. If regulators would eliminate the surcharge, Fannie Mae would agree to raise new capital. In a March 7 email to Fannie Chief Business Officer Levine, Mudd suggested that the 30% capital surplus requirement might be reduced without any trade. It's a time game, whether they need us more or if we hit the capital wall first. Be cool. On the next day, March 8, Treasury and White House officials received additional information about Fannie's condition. The White House economist Jason Thomas sent Steele an email enclosing an alarming analysis. It claimed that in reporting its 2007 financial results, Fannie was masking its insolvency through fraudulent accounting practices. The analysis, which resembled one offered in a March 10 Barron's article, stated, "Any realistic assessment of Fannie Mae's capital position would show the company is currently insolvent. Accounting fraud has resulted in several asset categories: non-agency securities, deferred tax assets, low-income partnership investment, being overstated, while the guarantee obligation liability is understated. These accounting shenanigans add up to tens of billions of exaggerated net worth. Yet the impact of a tsunami of mortgage defaults has yet to run through Fannie's income statement and further annihilate its capital. Such grim results are a logical consequence of Fannie's dual mandate to serve the housing market while maximizing shareholder returns. In trying to do both, Fannie has done neither well. With shareholder capital depleted, a government seizure of the company is inevitable." Given the turmoil of the Bear Stearns crisis, Paulson said he wanted to increase confidence in the mortgage market by having Fannie and Freddie raise capital. Steele told him that Treasury, OFHEO, and the Fed were preparing plans to relax the GSE's capital surcharges in exchange for assurances that the companies would raise capital. On March 16, 2008, Steele also reported to his Treasury colleagues that William Dudley, then Executive Vice President of the New York Fed, wanted to harden the implicit government guarantee of Freddie and Fannie. Steele wrote that Dudley leaned on me hard to make the guarantee explicit in conjunction with dialing back the surcharge and attempting to raise new capital. And Steele worried about how this might affect the federal government's balance sheet. I do not like that, and it has not been part of my conversation with anyone else. I view that as a very significant move way above my pay grade to double the size of the U.S. debt in one fell swoop. End of section 106. Section 107 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 17, The Idea Strikes Me as Perverse. Regulators at OFHEO and the Treasury huddled with GSE executives to discuss lowering capital requirements if the GSEs would raise more capital. The entire mortgage market was at risk, Lockhart told the FCIC. The pushing and tugging continued. Paulson told the FCIC that personal commitments from MUD and Freddie Mac CEO Richard Siren to raise capital cinched the deal. Just days earlier, on March 13, Siren had announced in a quarterly call to investors that his company would not raise new capital. Fannie and Freddie executives prepared a draft press release before a discussion with Lockhart and Steele. It announced a reduction in the capital surcharge from 30% to 20%. Lockhart was not pleased. The draft lacked a commitment to raise additional capital, stating instead that the GSEs planned to raise it over time as needed. It looked as if the GSEs were making the deal with their fingers crossed. In an email to Steele and the CEOs of both entities, Lockhart wrote, "The idea strikes me as perverse, and I assume it would seem perverse to the markets that a regulator would agree to allow a regulatee to increase its very high mortgage credit risk leverage, not to mention increasing interest rate risk, without any new capital. The initial negotiations had the GSEs raising $2 of capital for each $1 of reduction in the surplus." Lockhart wrote in frustration, "We seem to have gone from 2 to 1 right through 1 to 1 to now 0 to 1. Despite Lockhart's reservations, OFHEO announced the deal unaltered in any material way on March 19. OFHEO agreed to ease the capital restraint from 30% to 20%. Fannie and Freddie pledged to begin the process to raise significant capital, giving no concrete commitment. Paulson told the FCIC that the agreement, which included a promise to raise capital, was a no-brainer, and that he had no memory of Lockhart ever having called it perverse. The market analyst Joshua Rosner panned the deal. "We view any reduction in capital as a comment not only on the GSEs but on the burgeoning panic in Washington," he wrote. "If this action results in the destabilizing of the GSEs, OFHEO will go from being the only regulator that prevented its charges from getting into trouble to a textbook example of why regulators should be shielded from outside political pressure." Fannie would keep its promise by raising $7.4 billion in preferred stock. Freddie reneged. Executive Vice President Donald Bicenius offered 2 reasons why, in hindsight, Fannie Mae did not raise additional capital. First was protecting the assets of existing shareholders. "I'm sure Fannie's investors are not very happy," Bicenius told the FCIC. Part 2 is, if you actually fundamentally believe you have enough capital to withstand even a fairly significant downturn in house prices, you wouldn't raise capital. Similarly, CEO Siren spoke of the downside of raising capital on August 6, 2008. "Raising a lot more capital at these kinds of prices could be quite dilutive to our shareholders. So we have to balance the interest of our shareholders." But Lockhart saw it differently. In his view, Siren's public comments put a good face on Freddie's inability to raise capital. He speculated that Siren was masking a different concern, lawsuits. Siren was getting advice from his attorneys about the high risk of raising capital before releasing quarterly earnings. "And our lawyers could not disagree because we know about their accounting issues," Lockhart told the FCIC. End of section 107. Section 108 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 17, It Will Increase Confidence. In May, the 2 companies announced further losses in the first quarter. Even as the situation deteriorated on June 9, OFHEO rewarded Fannie Mae for raising $7.4 billion in new capital by further lowering the capital surcharge from 20% to 15%. In June, Fannie's stock fell 28%, Freddie's 34%. The price of protection on $10 million in Fannie's debt through credit default swaps jumped to $66,000 in June, up from $47,700 in May. Between 2004 and 2006, it had typically been about $13,000. In August, they both reported more losses for the second quarter. Even after both Fannie and Freddie became public companies owned by shareholders, they had continued to possess an asset that is hard to quantify: the implicit full faith and credit of the U.S. government. The government worried that it could not let the $5.3 trillion GSEs fail because they were the only source of liquidity in the mortgage market and because their failure would cause losses to owners of their debt and their guaranteed mortgage securities. Uncle Sam had rescued GSEs before. It bailed out Fannie when double-digit inflation wrecked its balance sheet in the early 1980s, and it came through in the mid-1980s for another GSE in duress, the Farm Credit System. In the mid-1990s, even a GSE-type organization, the Financing Corporation, was given a helping hand. As the market grappled with the fundamental question of whether Fannie and Freddie would be backed by the government, the yield on the GSE's long-term bonds rose. The difference between the rate that the GSEs paid on their debt and rates on treasuries, a premium that reflects investors' assessment of risk, widened in 2007 to 0.5 percentage point. That was low compared with the same figure for other publicly traded companies, but high for the ultra-safe GSEs. By June 2008, the spread had risen 65% over the 2007 level. By September 5, just before regulators parachuted in, the spread had nearly doubled from its 2007 number to just under 1%, making it more difficult and costly for the GSEs to fund their operations. On the other hand, the prices of Fannie Mae mortgage-backed securities actually increased slightly over this time period, while the prices of private label mortgage-backed securities dramatically declined. For example, the price of the FNCI 7 index, an index of Fannie mortgage-backed securities with an average coupon of 7%, increased from 102 in January 2007 to 103 on September 5, 2008, 2 days prior to the conservatorship. As another example, the price of the FNCI 5 index, Fannie securities with an average coupon of 5%, increased from 95 to 96 during the same time period. In July and August 2008, Fannie suffered a liquidity squeeze because it was unable to borrow against its own securities to raise sufficient cash in the repo market. Its stock price dove to less than $7 a share. Fannie asked the Fed for help. A senior advisor in the Federal Reserve Board's Division of Banking Supervision and Regulation gave the FCIC a bleak account of the situation at the two GSEs and noted that liquidity was just becoming so essential, so the Federal Reserve agreed to help provide it. On July 13, the Federal Reserve Board in Washington authorized the New York Fed to extend emergency loans to the GSEs, should such lending prove necessary, to promote the availability of home mortgage credit during a period of stress in financial markets. Fannie and Freddie would never tap the Fed for that funding. Also on July 13, Treasury laid out a 3-part legislative plan to strengthen the GSEs by temporarily increasing their lines of credit with the Treasury, authorizing Treasury to inject capital into the GSEs, and replacing OFHEO with the new Federal Housing Finance Agency, FHFA, with the power to place the GSEs into receivership. Paulson told the Senate that regulators needed a bazooka at their disposal. "You are not likely to take it out," Paulson told legislators. "I just say that by having something that is unspecified, it will increase confidence, and by increasing confidence, it will greatly reduce the likelihood it will ever be used." Fannie's mud and Freddie's siren praised the plan. At the end of July, Congress passed the Housing and Economic Recovery Act, HERA, of 2008, giving Paulson his bazooka, the ability to extend secured lines of credit to the GSEs, to purchase their mortgage securities and to inject capital. The 261-page bill also strengthened regulation of the GSEs by creating FHFA, an independent federal agency as their primary regulator, with expanded authority over Fannie's and Freddie's portfolios, capital levels, and compensation. In addition, the bill raised the federal debt ceiling by $800 billion to $10.6 trillion, providing funds to operate the GSEs if they were placed into conservatorship. After the Federal Reserve Board consented in mid-July to furnish emergency loans, Fed staff and representatives of the Office of the Comptroller of the Currency, OCC, along with Morgan Stanley, which acted as an advisor to Treasury, initiated a review of the GSEs. Timothy Clark, who oversaw the week-long review for the Fed, told the FCIC that it was the first time they ever had access to information from the GSEs. He said that previously the GSEs saw the Fed as public enemy one. There was a battle between us and them, Clark added. We would deal with OFHEO, which was also very guarded, so we did not have access to info until they wanted funding from us. Although Fed and OCC personnel were at the GSEs and conferring with executives, Mudd told the FCIC that he did not know of the agency's involvement until their enterprises were both in conservatorship. The Fed and the OCC discovered that the problems were worse than their suspicions and reports from FHFA had led them to believe. According to Clark, the Fed found that the GSEs were significantly under-reserved, with huge potential losses, and their operations were unsafe and unsound. The OCC rejected the forecasting methodologies on which Fannie and Freddie relied. Using its own metrics, it found insufficient reserves for future losses and identified significant problems in credit and risk management. Kevin Bailey, the OCC Deputy Comptroller for Regulatory Policy, told the FCIC that Fannie's loan loss forecasting was problematic, and that its loan losses therefore were understated. He added that Fannie had overvalued its deferred tax assets because without future profits, deferred tax assets had no value. Loss projections calculated by Morgan Stanley substantiated the Fed's and OCC's findings. Morgan Stanley concluded that Fannie's loss projection methodology was flawed and resulted in the company substantially understating losses. Nearly all of the loss projections calculated by Morgan Stanley showed that Fannie would fall below its regulatory capital requirement. Fannie's projections did not. All told, the litany of understatements and shortfalls led the OCC's Bailey to a firm conclusion. If the GSEs were not insolvent at the time, they were almost there, he told the FCIC. Regulators also learned that Fannie was not charging off loans until they were delinquent for 2 years, a head-in-the-sand approach. Banks are required to charge off loans once they are 180 days delinquent. For these and numerous other errors and flawed methodologies, Fannie and Freddie earned rebukes. Given the role of the GSEs and their market dominance, the OCC report said, they should be industry leaders with respect to effective and proactive risk management, productive analysis, and comprehensive reporting. Instead, they appear to significantly lag the industry in all respects. End of section 108. Section 109 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 17, Critical Unsafe and Unsound Practices. Paulson told the FCIC that although he learned of the Fed and OCC findings by August 15th, it took him 3 weeks to convince Lockhart and the FHFA that there was a capital shortfall, that the GSEs were not viable, and that they should be placed under government control. On August 22nd, FHFA informed both Mudd and Siren that their firms were adequately capitalized under the regulations, a judgment based on financial information that was certified and represented as true and correct by GSE management. But FHFA also emphasized that it was seriously concerned about the current level of Fannie Mae's capital if the housing market decline continued. Fannie's prospects for increasing capital grew gloomier. Fannie informed Treasury on August 25 and repeatedly told FHFA that raising capital was infeasible and that the company was expecting additional losses. Even Fannie's base case earnings forecast pointed to substantial pressure on solvency, and a stressed forecast indicated that capital resources will continue to decline. By September 4, Lockhart and FHFA agreed with Treasury that the GSEs needed to be placed into conservatorship. That day, Siren and Mudd received blistering mid-year reviews from FHFA. The opening paragraph of each letter informed the CEOs that their companies had been downgraded to critical concerns, and that the critical unsafe and unsound practices and conditions that gave rise to the enterprise's existing condition the deterioration in overall asset quality and significant earning losses experienced through June 2008, as well as forecasted future losses, likely require recapitalization of the enterprise. A bad situation was expected to worsen. The 21-page report sent to Fannie identified sweeping concerns, including failures by the board and senior management, a significant drop in the quality of mortgages and securities owned or guaranteed by the GSE, insufficient reserves, the almost exclusive reliance on short-term funding, and the inability to raise additional capital. FHFA admonished management and the board for their imprudent decisions to purchase or guarantee higher-risk mortgage products. The letter faulted Fannie for purchasing high-risk loans to increase market share, raise revenue, and meet housing goals, and for attempting to increase market share by competing with Wall Street firms that purchase lower-quality securities. FHFA, noting a conflict between prudent credit risk management and corporate business objectives, found that these purchases of higher-risk loans were predicted on the relaxing of underwriting and eligibility standards. Using models that underestimated this risk, the GSE then charged fees even lower than what its own deficient models suggested were appropriate. FHFA determined that these lower fees were charged because focus was improperly placed on market share and competing with Wall Street and Freddie Mac. Even after internal reports pointed to market problems, Fannie kept buying and guaranteeing riskier loan products, FHFA said. Despite signs in the latter half of 2006 and 2007 of emerging problems, management continued activity in risky programs and maintained its higher eligibility program for Alt-A loans without establishing limits. The company also bought private label securities backed by Alt-A and subprime loans. Losses were likely to be higher than the GSEs had estimated, FHFA found. FHFA also noted increasing questions and concerns regarding Fannie's accounting. The models it used to forecast losses had not been independently validated or updated for several years. FHFA judged that an up-to-date model estimated losses would likely show a material increase. In addition, Fannie had overvalued its deferred tax assets. Applying more reasonable projections of future performance, FHFA found this benefit to be significantly overstated. The 22-page report delivered to Freddie included similarly harsh assessments of the GSE's safety and soundness, but more severe criticisms of its management and board. In particular, the report noted a significant lack of market confidence, which had eliminated the ability to raise capital. FHFA, for its part, lost confidence in the board of directors and the executive management team, holding them accountable for losses stemming from a series of ill-advised and poorly executed decisions and other serious misjudgments. According to the regulator, they therefore could not be relied on, particularly in light of their widespread failures to resolve regulatory issues and address criticisms. In addition, FHFA said that Freddie's failure to raise capital, despite its assurances, invited the conclusion that the board and CEO had not negotiated in good faith about the capital surcharge reduction. As in its assessment of Fannie, FHFA found that Freddie's unsafe and unsound practices included the purchase and guarantee of higher-risk loan products in 2006 and 2007 in a declining market. Even after being told by the regulator in 2006 that its purchases of subprime private label securities had outpaced its risk management abilities, Freddie bought $22 billion of subprime securities in each subsequent quarter. FHFA also found that aggressive accounting cast doubt on Freddie's reported earnings and capital. Despite clear signals that losses on mortgage assets were likely, Freddie waited to record write-downs until the regulator threatened to issue a cease and desist order. Even then, one write-down was reversed just prior to the issuance of the second quarter financial statements. The regulator concluded that rising delinquencies and credit losses would result in a substantial dissipation of earnings and capital. End of section 109. Section 110 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 17. They went from 0 to 3 with no warning in between. Mudd told the FCIC that its regulator had never before communicated the kind of criticisms leveled in the September 4 letter. He said the regulator's chronicling of the situation then was inconsistent with what you would consider better regulatory practice to be, like first warning, fix it, second warning, fix it, third warning, you're out of here. Instead, they went from 0 to 3 with no warning in between. A review of the examination reports and other documents provided by FHFA to the FCIC largely supports Mudd's view on this specific point. While OFHEO's examination reports noted concerns about increasing credit risk and slow remediation of deficiencies required by the May 2006 consent agreement, they do not include the sweeping criticisms contained in the September 4 letter. 2 days after their two companies were designated critical concerns, Mudd at Fannie and Siren at Freddie faced a government takeover. On September 6, FHFA Acting Deputy Director Chris Dickerson sent separate memos to Lockhart recommending that FHFA be appointed conservator for each GSE. Still, conservatorship was not a foregone conclusion. Paulson, Lockhart, and Bernanke met with Mudd, Siren, and their boards to persuade them to cede control. Essentially, the GSEs faced a Hobson's choice. Take the horse offered or none at all. They had to voluntarily agree to a consent agreement, Lockhart told the FCIC. The alternative, a hostile action, invited trouble and nasty lawsuits, he noted. So we made a very strong case so the board of directors did not have a choice. Paulson reminded the GSEs that he had authority to inject capital, but he would not do so unless they were in conservatorship. Mudd was stunned and angry, according to Paulson. Tom Lund, who ran Fannie Mae's single-family business, told the FCIC that conservatorship came as a surprise to everyone. Levin told the FCIC that he never saw a government seizure coming. He never imagined, he said, that Fannie Mae was or might become insolvent. Interviewed in 2010, Mudd told the FCIC, "I did not think in any way it was fair for the government to have been in a position of being in the chorus for the company to add capital, and then to inject itself in the capital structure." The conservatorship memoranda reiterated all the damning evidence presented in the letters 2 days earlier. Losses at Fannie Mae for the year were estimated to be between $18 billion and $50 billion. Freddie Mac's memorandum differed only in the details. Its losses, recorded at $1 billion in the first 6 months of 2008, were projected to end up between $11 and $32 billion by the end of the year. Although the boards had a choice, the only realistic option was assent. "We were going to agree to go in a conservatorship anyway," Siren told the FCIC. There was a very clear message that the September 4 letter was there as a mechanism to bring about a result. Mudd agreed, observing that the purpose of the letter was really to force conservatorship. The boards of both companies voted to accept conservatorship. Both CEOs were ousted, but the fundamental problems persisted. As promised, the Treasury was prepared to take 2 direct steps to support solvency. First, it would buy up to $200 billion of senior preferred stock from the GSEs and extend them short-term secured loans. In addition, it pledged to buy GSE mortgage-backed securities from Wall Street firms and others until the end of 2009. Up front, Treasury bought from each GSE $1 billion in preferred stock with a 10% dividend. Each GSE also gave Treasury warrants to purchase common stock representing 79.9% of shares outstanding. Existing common and preferred shareholders were effectively wiped out. The decline in value of the preferred stock caused losses at many banks that held these securities, contributing to the failure of 10 institutions and to the downgrading of 35 to less than well capitalized by their regulators. Paulson told the FCIC that he was naive enough to believe that the action would halt the crisis because it would put a floor under the housing market decline and provide confidence to the market. He realized he was wrong on the next day when, as he told the FCIC, Lehman started to go. Former Treasury Assistant Secretary Neil Kashkari agreed. "We thought that after we stabilized Fannie and Freddie that we bought ourselves some time, maybe a month, maybe 3 months. But they were such profound interventions, stabilizing such a huge part of the financial markets, that would buy us some time. We were surprised that Lehman then happened a week later, that Lehman had to be taken over or it would go into bankruptcy." The firm's failure was a huge event and increased the magnitude of the crisis, according to Fed Governor Kevin Warsh and New York Fed General Counsel Tom Baxter. Warsh also told the FCIC that the events surrounding the GSE takeover led to a massive, underreported, underappreciated jolt to the system. Then, according to Warsh, when the market grasped that it had misunderstood the risks associated with the GSEs and that the government could have conceivably let them fail, it caused investors to panic about the value of every asset, to reassess every portfolio. FHFA Director Lockhart described the decision to put the GSEs into conservatorship in the context of Lehman's failure. Given that the investment bank's balance sheet was about 1/5 the size of Fannie Mae's, he felt that the fallout from Lehman's bankruptcy would have paled in comparison to a GSE failure. He said, "What happened after Lehman would have been very small compared to these 5.5 trillion institutions failing." Major holders of GSE securities included the Chinese and Russian central banks, which between them owned more than $500 billion of these securities, and U.S. financial firms and investment funds had even more extensive holdings. A 2005 Fed study concluded that U.S. banks owned more than $1 trillion in GSE debt and securities, more than 150% of the bank's Tier 1 capital, and 11% of their total assets at the time. Testifying before the FCIC, Mudd claimed that failure was all but inevitable. In 2008, the companies had no refuge from the twin shocks of a housing crisis followed by a financial crisis, he said. A monoline GSE structure asked to perform multiple tasks cannot withstand a multi-year 30% home price decline on a national scale, even without the accompanying global financial turmoil. The model allowed a balance of business and mission when home prices were rising. When prices crashed far beyond the realm of historical experience, it became the pit and the pendulum, a choice between horrible alternatives. End of section 110. Section 111 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 17, The Worst-Run Financial Institution. When interviewed by the FCIC, FHFA officials were very critical of Fannie's management. John Kerr, the FHFA examiner and an OCC veteran in charge of Fannie examinations, minced no words. He labeled Fannie the worst-run financial institution he had seen in his 30 years as a bank regulator. Scott Smith, who became associate director at FHFA after that agency replaced OFHEO, concurred in his view. Fannie's forecasting capabilities were not particularly well thought out and lacked a variety of stress scenarios. Both officials noted Fannie's weak forecasting models, which included hundreds of market simulations but scarcely any that contemplated declines in house prices. To Austin Kelly, an OFHEO examination specialist, there was no relying on Fannie's numbers because their processes were a bowl of spaghetti. Kerr and a colleague said that they were struck that Fannie Mae, a multi-trillion-dollar company, employed unsophisticated technology. It was less tech-savvy than the average community bank. Nonetheless, OFHEO's communications with Fannie prior to September 4 did not fully reflect these criticisms. FHFA officials conceded that they had made mistakes in their oversight of Fannie and Freddie. They paid too much attention to fixing operational problems and did not react to Fannie's increasing credit risk. Lockhart told the FCIC that more resources should have been dedicated to assessing credit risk of their mortgage assets and guarantees. Current FHFA Acting Director Edward DeMarco told the FCIC that it would not pass the reasonable person test to deny that OFHEO took its eye off the ball by not paying sufficient attention to credit risk and instead focused on operational risk, accounting, and lack of audited results. To Mudd and others, OFHEO's mistakes were not surprising. Mudd told the FCIC that the regulators' skill levels were developing but below average. Henry Cisneros, a former Housing and Urban Development Secretary, expressed a similar view. OFHEO, Cisneros told the FCIC, was puny compared to what Fannie Mae and Freddie Mac could muster in their intelligence, their Ivy League educations, their rocket scientists in their place, their lobbyists, their ability to work the Hill. The costs of the bailouts have been enormous and are expected to increase. From January 1, 2008 through the third quarter of 2010, the two companies lost $229 billion, wiping out $71 billion of combined capital that they had reported at the end of 2007, and the $7 billion of capital raised by Fannie in 2008. Treasury narrowed the gap with $151 billion in support. FHFA has estimated that costs through 2013 will range from $221 billion to $363 billion. The Congressional Budget Office has projected that the economic cost of the GSE's downfall, including the total financial cost of government support, as well as actual dollar outlays, could reach $389 billion by 2019. End of section 111. Section 112 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 17, Wasn't Done at My Pay Grade. Fannie's two most senior executives were asked at an FCIC hearing how their charter could have been changed to make the company more sound and to avoid the multi-billion-dollar bailout. Mudd, who made approximately $65 million from 2000 to 2008, testified that the thing that would have made the institution more sound or have produced a different outcome would have been for it to have become over time a more normal financial institution, able to diversify, able to allocate capital, able to be long or short in the market, able to operate internationally. And if the trade for that would have been, a cut in the so-called implicit ties with the government, I think that would have been a better solution. Chief Business Officer Levin, who received approximately $45 million from 2000 to 2008, answered only that making such decisions wasn't done at my pay grade. End of section 112. Section 113 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Commission conclusions on Chapter 17. The Commission concludes that the business model of Fannie Mae and Freddie Mac, the GSEs, as private sector, publicly traded, profit-making companies with implicit government backing and a public mission, was fundamentally flawed. We find that the risky practices of Fannie Mae, the Commission's case study in the area, particularly from 2005 on, led to its fall. Practices undertaken to meet Wall Street's expectations for growth, to regain market share, and to ensure generous compensation for its employees. Affordable housing goals imposed by the Department of Housing and Urban Development, HUD, did contribute marginally to these practices. The GSEs justified their activities in part on the broad and sustained public policy support for home ownership. Risky lending and securitization resulted in significant losses at Fannie Mae, which, combined with its excessive leverage permitted by law, led to the company's failure. Corporate governance, including risk management, failed at the GSEs in part because of skewed compensation methodologies. The Office of Federal Housing Enterprise Oversight, OFHEO, lacked the authority and capacity to adequately regulate the GSEs. The GSEs exercised considerable political power and were successfully able to resist legislation and regulatory actions that would have strengthened oversight of them and restricted their risk-taking activities. In early 2008, the decision by the federal government and the GSEs to increase the GSEs' mortgage activities and risk to support the collapsing mortgage market was made despite the unsound financial condition of the institutions. While these actions provided support to the mortgage market, they led to increased losses at the GSEs, which were ultimately borne by taxpayers and reflected the conflicted nature of the GSE's dual mandate. GSE mortgage securities essentially maintained their value throughout the crisis and did not contribute to the significant financial firm losses that were central to the financial crisis. End of section 113.
Section 114 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 18, September 2008, The Bankruptcy of Lehman. Intro. Solvency should be a simple financial concept. If your assets are worth more than your liabilities, you are solvent. If not, you are in danger of bankruptcy. But on the afternoon of Friday, September 12, 2008, experts from the country's biggest commercial and investment banks met at the Wall Street offices of the Federal Reserve to ponder the fate of Lehman Brothers and could not agree whether or not the 157-year-old firm was solvent. Only 2 days earlier, Lehman had reported shareholder equity, the measure of solvency, of $28 billion at the end of August. Over the previous 9 months, the bank had lost $6 billion, but raised more than $10 billion in new capital, leaving it with more reported equity than it had a year earlier. But this arithmetic reassured hardly anyone outside the investment bank. Fed officials had been discussing Lehman's solvency for months, and the stakes were very high. To resolve the question, the Fed would not rely on Lehman's $28 billion figure, given questions about whether Lehman was reporting assets at market value. As one New York Fed official wrote to colleagues in July, balance sheet capital isn't too relevant if you're suffering a massive run. If there is a run and a firm can only get fire sale prices for assets, even large amounts of capital can disappear almost overnight. The bankers thought Lehman's real estate assets were overvalued. In light of Lehman's unreliable valuation methods, the bankers had good reason for their doubts. None of the bankers at the New York Fed that weekend believed the $54 billion in real estate assets, excluding real estate held for sale, in Lehman's books was an accurate figure. If the assets were worth only half that amount, a likely scenario given market conditions, then Lehman's $28 billion in equity would be gone. In a fire sale, some might sell for even less than half their stated value. What does solvent mean? JP Morgan CEO Jamie Dimon responded when the FCIC asked if Lehman had been solvent. The answer is, I don't know. I still could not answer that question. JP Morgan's Chief Risk Officer, Barry Subrow, testified before the FCIC that, from a pure accounting standpoint, it was solvent, although it obviously was financing its assets on a very leveraged basis with a lot of short-term financing. Testifying before the FCIC, former Lehman Brothers CEO Richard Fuld insisted his firm had been solvent. There was no capital hole at Lehman Brothers. At the end of Lehman's third quarter, we had $28.4 billion of equity capital. Fed Chairman Ben Bernanke disagreed. I believe it had a capital hole. He emphasized that New York Federal Reserve Bank President Timothy Geithner, Treasury Secretary Henry Paulson, and SEC Chairman Christopher Cox agreed it was just way too big a hole. And my own view is it's very likely that the company was insolvent, even not just illiquid. Others, such as Bank of America CEO Ken Lewis, who that week considered acquiring Lehman with government support, had no doubts either. He told the FCIC that Lehman's real estate and other assets had been overvalued by $60 to $70 billion, a message he had delivered to Paulson a few days before Lehman declared bankruptcy. It had been quite a week. It would be quite a weekend. The debate will continue over the largest bankruptcy in American history, but nothing will change the basic facts. A consortium of banks would fail to agree on a rescue, 2 last-minute deals would fall through, and the government would decide not to rescue this investment bank for financial reasons, for political reasons, for practical reasons, for philosophical reasons, and because, as Bernanke told the FCIC, if the government had lent money, the firm would fail, and not only would we be unsuccessful, but we would have saddled the taxpayer with tens of billions of dollars of losses. End of section 114. Section 115 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 18. Get More Conservatively Funded. After the demise of Bear Stearns in March 2008, most observers, including Bernanke, Paulson, Geithner, and Cox, viewed Lehman Brothers as the next big worry among the 4 remaining large investment banks. Geithner said he was consumed with finding a way that Lehman might get more conservatively funded. Fed Vice Chairman Donald Cohn told Bernanke that in the wake of Bear's collapse, some institutional investors believed it was a matter not of whether Lehman would fail, but when. One set of numbers in particular reinforced their doubts. On March 18, the day after JP Morgan announced its acquisition of Bear Stearns, the market, through credit default swaps on Lehman's debt, put the cost of insuring $10 million of Lehman's 5-year senior debt at $310,000 annually. For Merrill Lynch, the cost was $241,000, and for Goldman Sachs, $165,000. The chief concerns were Lehman's real estate-related investments and its reliance on short-term funding sources, including $7.8 billion of commercial paper and $197 billion of repos at the end of the first quarter of 2008. There were also concerns about the firm's more than 900,000 derivative contracts with a myriad of counterparties. As they did for all investment banks, the Fed and SEC asked, did Lehman have enough capital, real capital, after possible asset write-downs? And did it have sufficient liquidity, cash, to withstand the kind of run that had taken down Bear Stearns? Solvency and liquidity were essential and related. If money market funds, hedge funds, and investment banks believed Lehman's assets were worth less than Lehman's valuations, they would withdraw funds, demand more collateral, and curtail lending. That could force Lehman to sell its assets at fire sale prices, wiping out capital and liquidity virtually overnight. Bear proved it could happen. The SEC traditionally took the view that liquidity was paramount in large securities firms, but the Fed, as a consequence of its banking mandate, had more of an emphasis on capital raising. Eric Siri, head of the SEC's Division of Trading and Markets, told the FCIC, because the Fed had become the de facto primary regulator because of its balance sheet, its view prevailed. The SEC wanted to be collaborative, and so came to accept the Fed's focus on capital. However, as time progressed, both saw the importance of liquidity with respect to the problems at the large investment banks. In fact, both problems had to be resolved. Bear's demise had precipitated Lehman's first real financing difficulties since the liquidity crisis began in 2007, Lehman Treasurer Paolo Tonucci told the FCIC. Over the 2 weeks following Bear's collapse, Lehman borrowed from the Fed's new lending facility, the Primary Dealer Credit Facility, PDCF, but had to be careful to avoid seeming over-reliant on the PDCF for cash, which would signal funding problems. Lehman built up its liquidity to $45 billion at the end of May, but it and Merrill performed the worst among the 4 investment banks in the regulator's liquidity stress tests in the spring and summer of 2008. Meanwhile, the company was also working to improve its capital position. First, it reduced real estate exposures, again excluding real estate held for sale, from $90 billion to $71 billion at the end of May and to $54 billion at the end of the summer. Second, it raised new capital and longer-term debt, a total of $15.5 billion of preferred stock and senior and subordinated debt from April through June 2008. Treasury Undersecretary Robert Steele praised Lehman's efforts, publicly stating that it was addressing the issues. But other difficulties loomed. Fold would later describe Lehman's main problem as one of market confidence, and he suggested that the company's image was damaged by investors taking naked short positions, short-selling Lehman securities without first borrowing them, hoping Lehman would fail, and potentially even helping it fail by eroding confidence. Bear went down on rumors and a liquidity crisis on confidence, Fold told the FCIC. Immediately thereafter, the rumors and the naked short sellers came after us. The company pressed the SEC to clamp down on the naked short selling. The SEC's Division of Risk, Strategy, and Financial Innovation shared with the FCIC a study it did concerning short selling. As Chairman Mary Shapiro explained to the Commission, "We do not have information at this time that manipulative short selling was the cause of the collapse of Bear and Lehman or of the difficulties faced by other investment banks during the fall of 2008. The SEC to date has not brought short selling charges related to the failure of these investment banks." On May 18, Lehman reported better-than-expected earnings of $489 million for the first quarter of 2008. Its stock jumped nearly 50% to $46.49. But investors and analysts quickly raised questions, especially concerning the reported value of Lehman's real estate assets. Portfolio.com called Lehman's write-downs suspiciously minuscule. In a speech in May, David Einhorn of Greenlight Capital, which was then shorting Lehman's stock, noted the bank's large portfolio of commercial real estate loans and said, "There is good reason to question Lehman's fair value calculations. I suspect that greater transparency on these valuations would not inspire market confidence." Nell Minow, editor and co-founder of the Corporate Library, which researches and rates firms on corporate governance, raised other reasons that observers might have been skeptical of management at Lehman. On Lehman Brothers' board, they had an actress, a theatrical producer, and an admiral, and not one person who understood financial derivatives. The Corporate Library gave Lehman a D rating in June 2004, a grade it downgraded to F in September 2008. On June 9, Lehman announced a preliminary $2.8 billion loss for its second quarter, the first loss since it became a public company in 1994. The share price fell to $30. 3 days later, Lehman announced it was replacing Chief Operating Officer Joseph Gregory and Chief Financial Officer Erin Callan. The stock slumped again to $22.70. End of section 115. Section 116 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 18. This is not sounding good at all. After Lehman reported its final second quarter results on June 12, the New York Fed's on-site monitor at Lehman, Kirsten Harlow, reported that there had been no adverse information on liquidity, novations, terminations, or ability to fund either secured or unsecured funds. The announced liquidity numbers were better that quarter, as were the capital numbers. Nevertheless, Lehman's lenders and supervisors were worried. The next morning, William Dudley, then head of the New York Fed's Market Group and its current president, emailed Bernanke, Geithner, Hahn, and others that the PDCF should be extended because it remains critical to the stability of some of the investment banks, particularly Lehman. I think without the PDCF, Lehman might have experienced a full-blown liquidity crisis, he wrote. Just 1 week after the earnings release, Harlow reported that Lehman was indeed having funding difficulties. 4 financial institutions had trading issues with Lehman and had reduced their exposure to the firm, including Natixis, a French investment bank that had already eliminated all activity with Lehman. JP Morgan reported that large pension funds and some smaller Asian central banks were reducing their exposures to Lehman as well as to Merrill Lynch. And Citigroup requested a $3 to $5 billion comfort deposit to cover its exposure to Lehman, settling later for $2 billion. In an internal memo, Thomas Fontana, the head of risk management in Citigroup's Global Financial Institutions Group, wrote that loss of confidence in Lehman is huge at the moment. Timothy Clark, senior advisor in the Federal Reserve's Banking Supervision and Regulation Division, was short and direct. This is not sounding good at all. On June 25, results from the regulator's most recent stress test showed that Lehman would need $15 billion more than the $54 billion in its liquidity pool to survive a loss of all unsecured borrowings and varying amounts of secured borrowings. Lehman's borrowings in the overnight commercial paper market were increasing, however, from $3 billion at the end of November 2007 to $8 billion at the end of May 2008. And it was reliant on repo funding, particularly the portions that matured overnight and were collateralized by illiquid assets. As of mid-June, 62% of Lehman's liquidity was dependent on borrowing against non-traditional securities, such as illiquid mortgage-related securities, which could not be financed with the PDCF and of which investors were becoming increasingly wary. On July 10, Federated Investors, a large money market fund and one of Lehman's largest tri-party repo lenders, notified JP Morgan, Lehman's clearing bank, that Federated would no longer pursue additional business with Lehman because JP Morgan was unwilling to negotiate in good faith and had become increasingly uncooperative on repo terms. Dreyfus, another large money market fund, and a Lehman tri-party repo lender also pulled its repo line from the firm. End of section 116. Section 117 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 18. Spook the Market. As the Fed considered the risks of the tri-party repo market, it also mulled over more specific measures to help Lehman. The New York Fed and FDIC both rejected the company's proposal to convert to a bank holding company, a proposal which Geithner told Fold was gimmicky and could not solve a liquidity capital problem. A proposal by the Fed's Dudley followed the Bear Stearns model. $60 billion of Lehman's assets would be held by a new special-purpose vehicle financed by $5 billion of Lehman's equity and a $55 billion loan from the Fed. This proposal would remove the illiquid assets from the market and potentially avert a fire sale that could render Lehman insolvent. It didn't go anywhere. But when that idea was floated in July, the need for such action was still somewhat speculative. Not so by August. In an August 8 email to colleagues at the Federal Reserve and Treasury, Patrick Parkinson, then the Deputy Director of the Federal Reserve Board's Division of Research and Statistics, described a game plan that would 1. Identify activities of Lehman that could significantly harm financial markets and the economy if it filed for Chapter 11 bankruptcy protection. 2. Gather information to more accurately assess the potential effects of its failure. And 3. Identify risk mitigation actions for areas of serious potential harm. As they now realized, regulators did not know nearly enough about over-the-counter derivatives activities at Lehman and other investment banks, which were major OTC derivatives dealers. Investment banks disclosed the total number of OTC derivative contracts they had, the total exposures of the contracts, and their estimated market value, but they did not publicly report the terms of the contracts or the counterparties. Thus, there was no way to know who would be owed how much and when payments would have to be made, information that would be critically important to analyze the possible impact of the Lehman bankruptcy on derivatives counterparties and the financial markets. Parkinson reviewed a standing recommendation to form a default management group of senior executives of major market participants to work with regulators to anticipate issues if a major counterparty should default. The recommendation was from the private sector Counterparty Risk Management Policy Group, the same group that had alerted the Fed to the backlog problem in the OTC derivatives market earlier in the decade. Parkinson suggested accelerating the formation of this group while being careful not to signal concerns about any one market participant. On August 15, Parkinson emailed New York Fed officials that he was worried that no sensible game plan could be formulated without more information. He was informed that New York Fed officials had just met with Lehman 2 days earlier to obtain derivative-related information, that they still needed more information, and that the meeting had caused a stir, which in turn required assurances that requests for information would not be limited to Lehman. New York Fed officials were also very reluctant to request copies of the master agreements that would shed light on the Lehman's derivatives counterparties, because such a request would send a huge negative signal. The formation of the industry group seemed less provocative, wrote a New York Fed official, but could still spook the market. Parkinson believed that the information was important, but attempting to collect it was not without risks. He also recognized the difficulties in unraveling the complex dependencies among the many Lehman subsidiaries and their counterparties, which would keep lawyers and accountants busy for a long time. On August 28, Treasury's Steve Shafran informed Parkinson that Secretary Paulson agreed on the need to collect information on OTC derivatives. It just had to be done in a way that minimized disruptions. On September 5, Parkinson circulated a draft letter requesting the information from Lehman CEO Fold. Geithner would ask E. Gerald Corrigan, the Goldman Sachs executive and former New York Fed president who had co-chaired the Counterparty Risk Management Policy Group report, to form an industry group to advise on information needed from a troubled investment bank. Parkinson, Shafran, and others would also create a playbook for an investment bank failure at Secretary Paulson's request. Events over the following week would render these efforts moot. On September 4, executives from Lehman Brothers apprised executives at JP Morgan, Lehman's tri-party repo clearing bank, of the third quarter results that it would announce 2 weeks later. A $3.9 billion loss would reflect significant asset write-downs. The firm was also considering several steps to bolster capital, including an investment by Korea Development Bank or others, the sale of Lehman's investment management division, Neuberger Berman, the sale of real estate assets, and the division of the company into a good bank and bad bank with private equity sponsors. The executives also discussed JP Morgan's concerns about Lehman's repo collateral. On Monday, September 8, more than 20 New York Fed officials were notified of a meeting the next morning to continue the discussion of near-term options for dealing with a failing non-bank. They received a list documenting Lehman's tri-party repo exposure at roughly $200 billion. Before this collapse, Bear Stearns' exposure had been only $50 to $80 billion. The documentation further noted that 10 counterparties provided 80% of Lehman's repo financing and that intraday liquidity provided by Lehman's clearing banks could become a problem. Indeed, JP Morgan, Citigroup, and Bank of America had all demanded more collateral from Lehman with the threat they might cut off Lehman if they don't receive it. On Tuesday morning, September 9, news there would be no investment from Korea Development Bank shook the market. Lehman's stock plunged 55% from the day before, closing at $7.79. To prepare for an afternoon call with Bernanke, Geithner directed his staff to put together a quick "what's different, what's the same" list about Lehman versus Bear Stearns, as well as about mid-March then versus early September now. The Fed's Parkinson emailed Treasurer's Shafran about his concerns that Lehman would announce further losses the next week, that it might not be able to raise equity, and that even though its liquidity position was better than Bear Stearns had been, Lehman remained vulnerable to a loss of confidence. At 5 p.m., Paulson convened a call with Cox, Geithner, Bernanke, and Treasury staff to deal with a possible Lehman bankruptcy. At 5:20 p.m., Treasury Chief of Staff Jim Wilkinson emailed Michelle Davis, the Assistant Secretary for Public Affairs at Treasury, to express his distaste for government assistance. "We need to talk. I just can't stomach us bailing out Lehman. Would be horrible in the press, don't you think?" That same day, Fuld agreed to post an additional $3.6 billion of collateral to JP Morgan. Lehman's bankruptcy estate would later claim that Lehman did so because of JP Morgan's improper threat to withhold repo funding. Subro said JP Morgan requested the collateral because of his growing exposure as a derivatives trading counterparty to Lehman. Stephen Black, JP Morgan's president, said he requested $5 billion from Lehman, which agreed to post $3.6 billion. He did not believe the request put undue pressure on Lehman. On Tuesday night, executives of Lehman and JP Morgan met again at Lehman's request to discuss options for raising capital. The JP Morgan group was not impressed. Lehman sent the junior varsity JP Morgan executives reported to Black. They have no proposal and are looking to us for ideas, credit line to bridge them to the first quarter when they intend to split into good bank, bad bank. Black responded, "Let's give them an order for the same drugs they have apparently been taken to think we would do something like that." The Lehman bankruptcy estate has a different view. It alleges Black agreed to send a due diligence team following Diamond's suggestion that his firm might be willing to purchase Lehman preferred stock, but instead sent over senior risk managers to probe Lehman's confidential records and plans. The bankruptcy estate alleges that later that night, JP Morgan demanded that Lehman execute amended agreements to its tri-party repo services before pre-announcing its third quarter earnings at 7:30 the next morning. The amendments required Lehman to provide additional guarantees, increased Lehman's potential liability, and gave JP Morgan additional control over Lehman's bank accounts. Again, the Lehman bankruptcy estate argues that Lehman executed the agreements because JP Morgan executives led Lehman to believe its bank would refuse to extend intraday credit if Lehman did not do so. JP Morgan denies this. Black told the FDIC JPMC never told Lehman that it would stop extending credit and clearing if the September agreements were not executed before the markets opened on Wednesday, September 10, 2008. Before the market opened on Wednesday, Lehman announced its $3.9 billion third-quarter loss, including a $5.6 billion write-down. 4 hours later, Matthew Rutherford, an advisor to Treasury, emailed colleagues that several large money funds had reduced their exposure to Lehman, although there was not yet a wholesale pullback of repo lines. Importantly, Fidelity, the largest fund complex, stressed that while they hadn't made any significant shifts yet today, they were still in the process of making decisions and wanted to update me later in the day, Rutherford wrote. By Friday, Fidelity would have reduced its tri-party repo lending to Lehman to less than $2 billion from over $12 billion the previous Friday. According to Fidelity's response to an FCIC survey of market participants in the week prior to Bear's demise in March, Fidelity had pulled its entire $9.6 billion repo line to that company. End of section 117. Section 118 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 18. Imagination Hat. At the Federal Reserve, working groups were directed to spend the next few hours fleshing out how a Fed-assisted BOFA acquisition transaction might look, how a private consortium of preferred equity investors transaction might look, and how a Fed takeout of tri-party repo lenders would look. That day, New York Fed Senior Vice President Patricia Moser circulated her opinion on Dudley's request for thoughts on how to resolve Lehman. She laid out 3 options. 1. Find the buyer at any price. 2. Wind down Lehman's affairs. Or 3. Force it into bankruptcy. Regarding option 1, Moser said, should be done in a way that requires minimal temporary support. No more maiden lane LLCs, and no more equity position by the Fed. Moral hazard and reputation cost is too high. If the Fed agrees to another equity investment, it signals that everything the Fed did in March in terms of temporary liquidity backstops is useless. Horrible precedent. In the long run, much worse than option 3. Option 3, bankruptcy, would be a mess on every level but fixes the moral hazard problem. On Wednesday night, a New York Fed official circulated a liquidation consortium game plan to colleagues. The plan was to convene in one room senior level representatives of Lehman's counterparties in the tri-party repo, credit default swap, and over-the-counter derivatives markets, everyone who would suffer most if Lehman failed, and have them explore joint funding mechanisms to avert a failure. According to the proposed game, Secretary Paulson would tell the participants they had until the opening of business in Asia the following Monday morning, Sunday night, New York time, to devise a credible plan. The game plan stated that we should have in mind a maximum number of how much we are willing to finance before the meeting starts, but not divulge our willingness to do so to the consortium. Indeed, Paulson would tell the consortium, when it met 2 days later, that the government was willing to let Lehman fail. Former Bank of America CEO Ken Lewis told the FCIC that Treasury Secretary Paulson had called him on Wednesday, September 10, and asked him to take another look at acquiring Lehman, assuring him that Fold was ready to deal. Paulson and Geithner had arranged for Fold and Lewis to discuss an acquisition in July, but Fold had not been interested in selling the entire firm at that time. Because of this history, Lewis expressed his concern to Paulson that Fold would not want to sell the entire company or would not be willing to sell at a realistic price. Still, a team of Bank of America executives began reviewing Lehman's books, and on the next day, Fold sounded optimistic about the deal. But Bank of America determined that Lehman's assets were overvalued, and Lewis told Paulson there will be no deal without government assistance. On the 3rd, Paulson told Lewis, as Lewis informed the FCIC, to put on his imagination hat and figure out a deal. His insistence kept the Bank of America executives working, but on Friday, September 12, Lewis called Paulson to repeat his assessment. no government support, no deal. Apparently, Fold had been kept out of the loop and began to call Louis at home. Louis's wife told Fold that Louis would not come to the phone and to stop calling. On Thursday, September 11, an email time-stamped 8:26 a.m. from Susan McCabe, a Goldman Sachs executive, to Dudley and others set the tone for the day. It is not pretty. This is getting pretty scary and ugly again. They, Lehman, have much bigger counterparty risk than Bear did, especially in the derivatives market. So, the market is getting very spooked, nervous. Also have AIG, WAMU concerns. This is just spinning out of control again. Just FYI, this is shaping up as going to be a rough day. Bernanke was informed that if Lehman failed, it would be a much more complex proposition to unwind their positions than it would have been to unwind the positions held by Bear Stearns, because Lehman was nearly twice the size of Bear Stearns. Some believed government action was required. At 10:46 a.m., Haley Buske, a senior New York Fed official, forwarded to her colleagues an email from the hedge fund manager Louise Bacon suggesting the New York Fed could attempt to stabilize or support the LEH situation, but noting that none of the above will fix the fundamental problem, which is too many bad assets that need to get off too many balance sheets. At 1:40 p.m., Fed officials circulated the outline of a plan to create a Lehman Default Management Group, a group of Lehman counterparties and creditors who would make plans to cope with a Lehman bankruptcy. They would agree to hold off on fully exercising their rights to close out their trades with Lehman. Instead, they would establish a process to net down, that is, reduce, all exposures using a common valuation method. A little before midnight on Thursday, Buske notified colleagues that panicked hedge funds had called to say they were expecting a full-blown recession and that there was a full expectation that LEH goes, WAMU and then ML, Merrill Lynch. They were all begging, pleading for a large-scale solution which spans beyond just LEH. Buske compared the level of panic to the failure of Bear Stearns. On a scale of 1 to 10, where 10 is Bear Stearns' weak panic, I would put sentiment today at 12. At almost the same time, JP Morgan demanded that Lehman post another $5 billion in cash by the opening of business tomorrow in New York. If it didn't, JP Morgan would exercise our right to decline to extend credit to you. JP Morgan CEO Dimon, President Black, and CRO Sobro had first made the demand in a phone call earlier that evening to Lehman CEO Fold, CFO Ian Lowitt, and Treasurer Paolo Tonucci. Tonucci told the JP Morgan executives on the call that Lehman could not meet the demand. Dimon said Lehman's difficulties in coming up with the money were not JP Morgan's problem, Tonucci told the FCIC. They just wanted the cash. We made the point that it's too much cash to mobilize. There was no give on that. Again, they said, that's not our problem, we just want the cash. When Tonucci asked what would keep JP Morgan from asking for $10 billion tomorrow, Dimon replied, nothing, maybe we will. Under normal circumstances, Tonucci would not have tolerated this treatment, but circumstances were far from normal. JPM, as clearing bank, continues to ask for more cash collateral. If we don't provide the cash, they refuse to clear, we fail, was the message circulated in an email to Lehman executives on Friday, September 12. So Lehman delivered the $5 billion in cash only by pulling virtually every unencumbered asset it could deliver. JP Morgan's Subro saw it differently. He told the FCIC that the previously posted $3.6 billion of collateral by Lehman was inappropriate because it was illiquid and could not be reasonably valued. Moreover, Subro said the potential collateral shortfall was greater than $5 billion. Lehman's former CEO Fold told the FCIC that he agreed to post the $5 billion because JP Morgan said it would be returned to Lehman at the close of business the following day. The Lehman bankruptcy estate made the same allegation. This dispute is now the subject of litigation. The Lehman bankruptcy estate is suing JP Morgan to retrieve the $5 billion and the original $3.6 billion. End of section 118. Section 119 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 18 Heads of Family. Should Lehman be allowed to go bankrupt? Within the government, sentiments varied. On Friday morning, as Secretary Paulson headed to New York to sort through this Lehman mess, Wilkinson wrote that he still couldn't imagine a scenario where we put in government money. We shall see. That afternoon, Fed Governor Warsh wrote, in response to a colleague's hope the Fed would not have to protect some of Lehman's debt holders. I hope we don't protect anything. But on Friday, Fed Chairman Bernanke was taking no chances. He stayed behind in Washington in case he had to convene the Fed's board to exercise his emergency lending powers. Early Friday evening, Treasury Secretary Paulson summoned the heads of family, the phrase used by Harvey Miller, Lehman's bankruptcy counsel, to describe the CEOs of the big Wall Street firms, to the New York Fed's headquarters. Paulson told them that a private sector solution was the only option to prevent a Lehman bankruptcy. The people in the room needed to come up with a realistic set of options to help limit damage to the system. A sudden and disorderly wind-down could harm the capital markets and pose a significant risk of a precipitous drop in asset prices, resulting in collateral calls and reduced liquidity. That is, systemic risk. He could not offer the prospect of containing the damage if the executives were unable to fashion an orderly resolution of the situation as had been done in 1998 for long-term capital management. Paulson did offer the Fed's help through regulatory approvals and access to lending facilities, but emphasized that the Fed would not provide any form of extraordinary credit support. As New York Fed General Counsel Tom Baxter told the FCIC, Paulson made it clear there would be no government assistance, not a penny. H. Rogan Cohen, a veteran Wall Street lawyer who has represented most of the major banks, including Lehman, told the FCIC that the government's not a penny posture was a calculated strategy. I don't know exactly what the government was thinking, but my impression was they were playing a game of chicken or poker or whatever. It was said on more than one occasion that it would be very politically difficult to rescue Lehman. There had been a lot of blowback after Bear Stearns. I believe the government thought that it could, with respect to a game of chicken, persuade the private sector to take a big chunk of Lehman's liabilities. The Fed's internal liquidation consortium game plan would seem to confirm Cohen's view, given that it contemplated a financial commitment, even though that was not to be divulged. Moreover, notwithstanding Paulson's not a penny statement, the United Kingdom's Chancellor of the Exchequer, Alistair Darling, said that Paulson told him that the FRB-NY might be prepared to provide Barclays with regulatory assistance to support the transaction if it was required. At that consortium meeting on Friday night, Citigroup CEO Vikram Pandit asked if the group was also going to talk about AIG. Timothy Geithner said simply, "Let's focus on Lehman." End of section 119. Section 120 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 18. Tell the sons of bitches to unwind. What would happen if JP Morgan refused to provide intraday credit for Lehman in the tri-party repo market on Monday, September 15? The Fed had been considering this possibility since the summer. As Parkinson noted, the fundamental problem was that even if Lehman filed for bankruptcy, the SEC would want Lehman's broker-dealer to live on and would not want the Fed in its position as lender to grab tri-party collateral. Parkinson told the FCIC staff that Subrob informed him over the weekend that JP Morgan would not unwind Lehman's repos on Monday if the Fed did not expand the types of collateral that could be financed through the PDCF lending facility. Earlier in the year, Parkinson had said that JP Morgan's refusal to unwind would be unforgivable. Now he told Geithner to tell those sons of bitches to unwind. Merrill CEO John Thain told the FCIC that by Saturday morning, the group of executives reviewing Lehman's assets had estimated that they were overvalued by anywhere from $15 to $25 billion. Thain thought that was more than the assembled executives would be willing to finance, and therefore Thain believed Lehman would fail. If Lehman failed, Thane believed, Merrill would be next. So he had called Ken Lewis, the CEO of Bank of America, and they met later that day at Bank of America's New York corporate apartment. By Sunday, the two agreed that Bank of America would acquire Merrill for $29 per share, payable in Bank of America stock. On Saturday afternoon, Lehman's counsel provided the Fed with a document describing how Lehman's default on its obligations would trigger a cascade of defaults through the subsidiaries, which have large OTC derivatives books. Bernanke, Fed Governor Cohn, Geithner, and other senior Fed officials subsequently participated in a conference call to discuss the possibility of going to Congress to ask for other authorities, something Geithner planned to pitch. However, Fed General Counsel Scott Alvarez cautioned others not to mention the plan to JP Morgan because he did not want to suggest Fed willingness to give JPMC cover to screw Lehman or anyone else. By Saturday night, however, it appeared that the parade of horrors that would result from a Lehman bankruptcy had been avoided. An agreement apparently had been reached. Barclays would purchase Lehman, excluding $40 to $50 billion of assets financed by the private consortium, even though the bankers in the consortium had estimated those assets to be significantly overvalued. Michael Klein, an advisor to Barclays, had told Lehman president Bart McDade that Barclays was willing to purchase Lehman, given the private consortium agreement to assist the deal. It seemed a deal would be completed. End of section 120. Section 121 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 18. This doesn't seem like it is going to end pretty. But on Sunday, things went terribly wrong. At 8 a.m., Barclays CEO John Barley and President Robert Diamond told Paulson, Geithner, and Cox that the Financial Services Authority, FSA, had declined to approve the deal. The issue boiled down to a guarantee. The New York Fed required Barclays to guarantee Lehman's obligations from the sale until the transaction closed, much as JP Morgan had done for Bear Stearns in March. Under UK law, the guarantee required Barclays' shareholder vote, which could take 30 to 60 days. Though it could waive that requirement, the FSA asserted that such a waiver would be unprecedented, that it had not heard about this guarantee until Saturday night, and that Barclays did not really want to take on that obligation anyway. Geithner pleaded with FSA Chairman Callum McCarthy to waive the shareholder vote, but McCarthy wanted the New York Fed to provide the guarantee instead of Barclays. Otherwise, according to the FSA, Barclays would have had to provide a possibly unlimited guarantee for an undefined period of time covering prior and future exposures and liabilities of Lehman that would continue to apply, including in respect of all transactions entered into prior to the purchase, even in the event the transaction ultimately failed. For Paulson, such a guarantee by the Fed was unequivocally out of the question. The guarantee could have put the Fed on the hook for tens of billions of dollars. If the run on Lehman had continued despite the guarantee, Barclays shareholders could reject the acquisition and the Fed would be in possession of an insolvent bank. Baxter told the FCIC that Barclays had known all along that the guarantee was required because JP Morgan had to provide the same type of guarantee when it acquired Bear Stearns. Indeed, Baxter said he was stunned at this development. He believed that the real reason Barclays said it could not guarantee Lehman's obligations was the UK government's discomfort with the transaction. On Sunday morning, Treasurer Wilkinson emailed JP Morgan Investment Bank CEO Jess Staley that he was in a meeting with Paulson and Geithner and that things did not look good. He concluded, "This doesn't seem like it is going to end pretty." In another note, a little more than an hour later, he added that there would be no government assistance. "No way government money is coming in. I'm here writing the USG Comms, United States Government Communications, plan for orderly unwind. Also just did a call with the White House, and USG is united behind no money. No way in hell Paulson could blink now. We will know more after this CEO meeting this morning, but I think we're headed for wind down unless Barclays' deal gets untangled." It did not. Paulson made a last-ditch pitch to his UK counterpart, Darling, without success. 2 years later, Darling admitted that he had vetoed the transaction. "Yeah, I did. Imagine if I had said yes to a British bank buying a very large American bank which collapsed the following week." He would have found himself telling the British audience, "Everybody sitting in this room and your children and your grandchildren and their grandchildren would be paying for years to come." That Bank of America had taken itself out of the picture may have played a role in Darling's decision. My first reaction was, if this is such a good deal, how come no American bank is going to go near it? So Darling concluded that for Barclays to accept the guarantee, which could have a great impact on the British economy, was simply out of the question. I spoke to Hen Paulson and said, "Look, there is no way we could allow a British bank to take over the liability of an American bank," which in effect meant the British taxpayer was underwriting an American bank. Following that decision in London, Lehman Brothers was, for all practical purposes, dead. Cohen, Lehman's counsel at the time, told the FCIC. When Secretary Paulson came out of the meeting with Geithner and Cox, they called Lehman's president and me over and said, "We have the consortium, but the British government won't do it." Darling said he did not want the US cancer to spread to the UK. At around 1 p.m., Lehman's team, President Bart McDade, CFO Ian Lowitt, Head of Principal Investing Alex Kirk, and others, reconvened at Lehman's offices to digest what obviously was stark news. Upon arriving, they heard that the New York Fed would provide more flexible terms for the PDCF lending facility, which would include expanding the types of collateral borrowers could use. McDade, Kirk, Lowitt, and Miller returned to the New York Fed building and met with the Fed's Baxter and Dudley, the SEC's Siri, and others to discuss the expanded PDCF program. According to McDade and Kirk, the government officials, led by Baxter, made it plain they would not permit Lehman to borrow against the expanded types of collateral as other firms could. The sentiment was clear, but the reasons were vague, McDade told the FCIC. He said that the refusal to allow Lehman to provide the expanded types of collateral made a difference in Lehman's being able to obtain the funding needed to open for business on Monday. Baxter explained to the FCIC, however, that Lehman's broker-dealer affiliate, not the holding company, could borrow against the expanded types of collateral. A New York Fed email written at 2:15 p.m. on that Sunday, September 14, stated that Lehman's counsel was informed of the expansion of PDCF-eligible collateral, but that such collateral would not be available to the broker-dealer if it filed for bankruptcy. The minutes of Lehman's September 14 board meeting showed that the Fed rejected Lehman's request for an even broader range of collateral to be eligible for PDCF financing and preferred that Lehman's holding company, but not the broker-dealer, file for bankruptcy and that the broker-dealer be wound down in an orderly fashion. In a letter dated September 14, the New York Fed informed Lehman Senior Vice President Robert Guglielmo that the broker-dealer could finance expanded types of collateral with the PDCF, but that letter was not sent until 2:24 a.m. on September 15, after Lehman had filed for bankruptcy. The Lehman broker-dealer borrowed $20 to $28 billion from the PDCF each day over the next 3 days. As Kirk recounted to the FCIC, during that Sunday meeting at the New York Fed, government officials stepped out for an hour and came back to ask, "Are you planning on filing bankruptcy tonight?" A surprised Miller replied that no one in the room was authorized to file the company, only the board could, and the board had to be called to a meeting and have a vote. There would be some lag in terms of having to put all the papers together to actually file it. There was a practical issue that you couldn't get it done quickly. Unmoved, government officials explained that directors of Lehman's UK subsidiary, LBIE, would be personally liable if they did not file for bankruptcy by the opening of business Monday. As Kirk recalled, they then told us, "We would like you to file tonight. It's the right thing to do because there is something else which we can't tell you that will happen this evening. We would like both events to happen tonight before the opening of trading Monday morning." The second event would turn out to be the announcement of Bank of America's acquisition of Merrill Lynch. End of section 121. Section 122 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 18. The only alternative was that Lehman had to fail. Miller insisted that there had to be an alternative because filing for bankruptcy would be Armageddon. Lehman had prepared a presentation argued that a Lehman bankruptcy would be catastrophic. It would take at least 5 years to resolve, cost $8 to $10 billion, and cause major disruptions in the United States and abroad. Baxter told the FCIC, "I knew that the consequences were going to be bad. That wasn't an issue." Lehman was in denial at that point in time. There was no way they believed that this story ends with a Lehman bankruptcy. They kept thinking that they were going to be bailed out by the taxpayer of the United States. And I'm not trying to convince you that that belief was a crazy belief, because they had seen that happen in the Bear case. Baxter's mission, however, was to try to get them to understand that they weren't going to be rescued, and then focus on what their real options were, which were drift into Monday morning with nothing done and then have chaos break out, or alternatively file. He concluded, "From my point of view, first thing was to convince Harvey that it was far better to file than to go into Monday and have complete pandemonium break out." And then he had to have discussions with the Lehman board because they had a fiduciary duty to resolve what was in the best interest of the company and its shareholders and other stakeholders. The only alternative was that Lehman had to fail, Miller testified to the FCIC. He stated that Baxter provided no further details on the government's plan for the fallout from bankruptcy, but assured him that the situation was under control. Then Miller told the FCIC Baxter told the Lehman delegation to leave the Fed offices. "They basically threw us out," Miller said. Miller remembered telling his colleagues as they left the building, "I don't think they like us." Miller continued, "We went back to the headquarters and it was pandemonium up there. It was like a scene from the 1946 film It's a Wonderful Life with the run on the savings and loan crisis. All of paparazzi running around. There was a guy there in a sort of a Norse god uniform with a helmet and a picket sign saying, 'Down with Wall Street.' There were hundreds of employees going in and out. Bart McDade was reporting to the board what had happened. Most of the board members were stunned. Henry Kaufman in particular was asking, how could this happen in America? The group informed the board that the Barclays deal had fallen apart. The government had instructed the board to file for bankruptcy. SEC's Cox called. With Tom Baxter also on the line, Cox told the board that the situation was serious and required action. The board asked Cox if he was directing them to file for bankruptcy. Cox and Baxter conferred for a few minutes and then answered that the decision was the board's to make. The board again asked if Cox and Baxter were telling them to file for bankruptcy. Cox and Baxter conferred again, then replied that they believed the government's position had been made perfectly clear at the meeting at the Fed earlier in the day. Following the call, McDade advised the board that Lehman would be unable to obtain funding without government assistance. The board voted to file for bankruptcy. The company filed at 1:45 a.m. on Monday morning. End of section 122. Section 123 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 18. A Calamity. Fed Chairman Ben Bernanke told the FCIC that government officials understood a Lehman bankruptcy would be catastrophic. "We never had any doubt about that. It was going to have huge impacts on funding markets. It would create a huge loss of confidence in other financial firms. It would create pressure on Merrill and Morgan Stanley, if not Goldman, which it eventually did. It would probably bring the short-term money markets into crisis, which we didn't fully anticipate. But of course, in the end, it did bring the commercial paper market and the money market mutual funds under pressure. So there was never any doubt in our minds that it would be a calamity, catastrophe, and that, we should do everything we could to save it." "What's the connection between Lehman Brothers and General Motors?" he asked rhetorically. Lehman Brothers' failure meant that commercial paper that they used to finance went bad. Bernanke noted that money market funds, in particular one named the Reserve Primary Fund, held Lehman's paper and suffered losses. He explained that this meant there was a run in the money market mutual funds, which meant the commercial paper market spiked, which created problems for General Motors. As the financial industry came under stress, Paulson told the FCIC, investors pulled back from the market, and when Lehman collapsed, even major industrial corporations found it difficult to sell their paper. The resulting liquidity crunch showed that firms had overly relied on this short-term funding and had failed to anticipate how restricted the commercial paper market could become in times of stress. Harvey Miller testified to the FCIC that the bankruptcy of Lehman was a catalyst for systemic consequences throughout the world. It fostered a negative reaction that endangered the viability of the financial system. As a result of failed expectations of the financial markets and others, a major loss of confidence in the financial system occurred. On the day that Lehman filed for bankruptcy, the Dow plummeted more than 500 points. $700 billion in value from retirement plans, government pension funds, and other investment portfolios disappeared. As for Lehman itself, the bankruptcy affected about 8,000 subsidiaries and affiliates with $600 billion in assets and liabilities, the firm's more than 100,000 creditors, and about 26,000 employees. Its failure triggered default clauses on derivatives contracts, allowing its current parties to have the option of seizing its collateral and terminating the contracts. After the parent company filed, about 80 insolvency proceedings of its subsidiaries in 18 foreign countries followed. In the main bankruptcy proceeding, about 66,000 claims, exceeding $873 billion, have been filed against Lehman as of September 2010. Miller told the FCIC that Lehman's bankruptcy represents the largest, most complex, multifaceted, and far-reaching bankruptcy case ever filed in the United States. The costs of the bankruptcy administration are approaching $1 billion. As of this writing, the proceeding is expected to last at least another 2 years. In his testimony before the FCIC, Bernanke admitted that the considerations behind the government's decision to allow Lehman to fail were both legal and practical. From a legal standpoint, Bernanke explained, "We are not allowed to lend without a reasonable expectation of repayment. The loan has to be secured to the satisfaction of the Reserve Bank. Remember, this was before TARP. We had no ability to inject capital or to make guarantees." A Sunday afternoon email from Bernanke to Fed Governor Warsh indicated that more than $12 billion in capital assistance would have been needed to prevent Lehman's failure. In case I am asked, how much capital injection would have been needed to keep LEH alive as a going concern? I gathered $12 billion or so from the private guys together with the Fed liquidity support was not enough. In March, the Fed had provided a loan to facilitate JP Morgan's purchase of Bear Stearns, invoking its authority under Section 13.3 of the Federal Reserve Act. But even with this authority, practical considerations were in play. Bernanke explained that Lehman had insufficient collateral and the Fed, had it acted, would have lent into a run. On Sunday night of that weekend, what was told to me was that, and I have every reason to believe, was that there was a run proceeding on Lehman. That is, people were essentially demanding liquidity from Lehman, that Lehman did not have enough collateral to allow the Fed to lend it enough to meet that run. Thus, if we lent the money to Lehman, all that would happen would be that the run on Lehman would succeed because he wouldn't be able to meet the demands, the firm would fail, and not only would we be unsuccessful, but we would have saddled the taxpayer with tens of billions of dollars of losses. The Fed had no choice but to stand by as Lehman went under, Bernanke insisted. As Bernanke acknowledged to the FCIC, however, his explanation for not providing assistance to Lehman was not the explanation he offered days after the bankruptcy. At that time, he said that he believed the market was prepared for the event. On September 23, 2008, he testified, "The failure of Lehman posed risks, but the troubles at Lehman had been well known for some time, and investors clearly recognized, as evidenced, for example, by the high cost of insuring Lehman's debt in the market for credit default swaps, that the failure of the firm was a significant possibility. Thus, we judged that investors and counterparties had had time to take precautionary measures. In addition, though the Federal Reserve subsequently asserted that it did not have the legal ability to save Lehman because the firm did not have sufficient collateral to secure a loan from the Fed under Section 13.3, the authority to lend under that provision is very broad. It requires not that loans be fully secured, but rather that they be secured to the satisfaction of the Federal Reserve Bank. Indeed, in March 2009, Federal Reserve General Counsel Scott Alvarez concluded that requiring loans under 13.3 to be fully secured would undermine the very purpose of Section 13.3, which was to make credit available in unusual and exigent circumstances to help restore economic activity. To CEO Fold and others, the Fed's emergency lending powers under Section 13.3 provided a permissible vehicle to obtain government support. Although Fed officials discussed and dismissed many ideas in the chaotic days leading up to the bankruptcy, the Fed did not furnish to the FCIC any written analysis to illustrate that Lehman lacked sufficient collateral to secure a loan under 13.3. Fold asserted to the FCIC that, in fact, Lehman had adequate financeable collateral. On September 12, the Friday night preceding Lehman's bankruptcy filing, Lehman financed itself and did not need access to the Fed's discount window. What Lehman needed on that Sunday night was a liquidity bridge. We had the capital. Along with its excess available collateral, Lehman also could have used whole businesses as collateral, such as its Neuberger Berman subsidiary, as did AIG some 2 days later. Fold also rejected assertions about Lehman's capital hole. He told the FCIC, as of August 31, 2008, 2 weeks prior to the bankruptcy filing, Lehman had $26.7 billion in equity capital. Positive equity of $26.7 billion is very different from the negative $30 to $60 billion holes claimed by some. Moreover, Fold maintained that Lehman would have been saved if it had been granted bank holding company status, as were Goldman Sachs and Morgan Stanley the week after Lehman's bankruptcy. The Fed chairman denied any bias against Lehman Brothers. In his view, the only real resolution short of bankruptcy had been to find a buyer. Bernanke said, when the potential buyers were unable to carry through, in the case of Bank of America, because they changed their minds and decided they wanted to buy Merrill instead, in the case of Barclays, because they withdrew, we essentially had no choice and had to let it fail. During the September 16, 2008 meeting of the Fed's Federal Open Market Committee, some members stated that the government should not have prevented Lehman's failure because doing so would only strengthen the perception that some firms were too big to fail and erode market discipline. They noted that letting Lehman fail was the only way to provide credibility to the assertion that no firm was too big to fail, and one member stated that the market was beginning to play the Treasury and Federal Reserve. Other meeting participants believed that the disorderly failure of a key firm could have a broad and disruptive effect on financial markets and the economy, but that the appropriate solution was capital injections, a power the Federal Reserve did not have. Bernanke's view was that only a fiscal and perhaps regulatory response could address the potential for wide-scale failure of financial institutions. Merrill's Thane made it through the Lehman weekend by negotiating a life-saving acquisition by Bank of America, formerly Lehman's potential suitor. Thane blamed the failure to bail out Lehman on politicians and regulators who feared the political consequences of rescuing the firm. There was tremendous amount of criticism of what was done with Bear Stearns so that JP Morgan would buy them, Thane told the FCIC. There was criticism of bailing out Wall Street. It was a combination of political unwillingness to bail out Wall Street and a belief that there needed to be a reinforcement of moral hazard. There was never a discussion about the legal ability of the Fed to do this. He noted, there was never discussion to the best of my recollection that they couldn't bail out Lehman. It was only that they wouldn't. Thane also told the FCIC that in his opinion, allowing Lehman to go bankrupt was the single biggest mistake of the whole financial crisis. He wished that he and the other Wall Street executives had tried harder to convince Paulson and Geithner to prevent Lehman's failure. As I think about what I would do differently after that weekend, is try to grab them and shake them that they can't let this happen. They were not very much in the mood to listen. They were not willing to listen to the idea that there had to be government support. The group of us should have just grabbed them and shaken them and said, look, you guys could not do this. But we didn't, and they were not willing to entertain that discussion. FCIC staff asked Thane if he and the other executives explicitly said to Paulson, Geithner, or anyone else, "You can't let this happen." Thane replied, "We didn't do it strongly enough. We said to them, look, this is going to be bad." But it wasn't like, "No, you have to help." Another prominent member of that select group, Morgan Stanley, had a different view. He told the FCIC, "I didn't think it was so bad. I hate to say that, but I thought it was almost the same if on Monday morning the government had saved Lehman. You still would have terrible things happen. AIG was going to have their problems that had nothing to do with Lehman. You were still going to have the runs on other banks, and you were going to have absolute fear and panic in the global markets. Whether Lehman itself got saved or not, the crisis would have unfolded along a different path, but it probably would have unfolded." Fed General Counsel Alvarez and New York Fed General Counsel Baxter told the FCIC that there would have been questions either way. As Baxter put it, "I think that if the Federal Reserve had lent to Lehman that Monday in a way that some people think, without adequate collateral and without other security to ensure repayment, this hearing and other hearings would have only been about how we wasted the taxpayers' money." End of section 123. Section 124 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Commission conclusions on Chapter 18. The Commission concludes the financial crisis reached cataclysmic proportions with the collapse of Lehman Brothers. Lehman's collapse demonstrated weaknesses that also contributed to the failures or near failures of the other four large investment banks: inadequate regulatory oversight, risky trading activities, including securitization and over-the-counter OTC derivative dealing, enormous leverage, and reliance on short-term funding. While investment banks tended to be initially more vulnerable, commercial banks suffered from many of the same weaknesses, including their involvement in the shadow banking system, and ultimately many suffered major losses requiring government rescue. Lehman, like other large OTC derivatives dealers, experienced runs on its derivatives operations that played a role in its failure. Its massive derivatives positions greatly complicated its bankruptcy, and the impact of its bankruptcy through interconnections with derivatives counterparties and other financial institutions contributed significantly to the severity and depth of the financial crisis. Lehman's failure resulted in part from significant problems in its corporate governance, including risk management, exacerbated by compensation to its executives and traders that was based predominantly on short-term profits. Federal government officials decided not to rescue Lehman for a variety of reasons, including the lack of a private firm willing and able to acquire it, uncertainty about Lehman's potential losses, concerns about moral hazard and political reaction, and erroneous assumptions that Lehman's failure would have a manageable impact on the financial system because market participants had anticipated it. After the fact, they justified their decision by stating that the Federal Reserve did not have legal authority to rescue Lehman. The inconsistency of federal government decisions in not rescuing Lehman after having rescued Bear Stearns and the GSEs, and immediately before rescuing AIG, added to uncertainty and panic in the financial markets. End of section 124.
Section 125 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 19, September 2008, The Bailout of AIG, Intro. $9 billion is a lot of money, but as AIG executives and the board examined their balance sheet and pondered the markets in the second week of September 2008, they were almost certain $9 billion in cash could not keep the company alive through the next week. The AIG corporate empire held more than $1 trillion in assets, but most of the liquid assets, including cash, were held by regulated insurance subsidiaries, whose regulators did not allow the cash to flow freely up to the holding company, much less out to troubled subsidiaries such as AIG Financial Products. The company's liabilities, especially those due in the near future, were much larger than the $9 billion on hand. On Friday, September 12, 2008, AIG was facing challenges on a number of fronts. It had to fund $1.4 billion of its own commercial paper on that day because traditional investors, for example money market funds, no longer wanted even short-term unsecured exposure to AIG, and the company had another $3.2 billion coming due the following week. On another front, the repo lenders, who had the comfort of holding collateral for their loans to AIG, $9.7 billion in mostly overnight funding, were nonetheless becoming skittish about the perceived weakness of the company and the low quality of most of its collateral, mortgage-related securities. On a third front, AIG had already put up billions of dollars in collateral to its credit default swap counterparties. By June of 2008, counterparties were demanding $15.7 billion, and AIG had posted $13.2 billion. By September 12, the calls had soared to $23.4 billion, and AIG had paid $18.9 billion, $7.6 billion to Goldman alone, and it looked very likely that AIG would need to post billions more in the near future. That day, S&P and Moody's both warned of potential coming downgrades to AIG's credit rating, which, if they happened, would lead to an estimated $10 billion in new collateral calls. A downgrade would also trigger liquidity puts that AIG had written on commercial paper, requiring AIG to come up with another $4 to $5 billion. Finally, AIG was increasingly strained by its securities lending business. As a lender of securities, AIG received cash from borrowers, typically equal to between 100 and 102% of the market value of the securities they lent. As borrowers began questioning AIG's stability, the company had to accept below-market terms, sometimes accepting cash equal to only 90% of the value of the securities. Furthermore, AIG had invested this cash in mortgage-related assets, whose value had fallen. Since September 2007, state regulators had worked with AIG to reduce exposures of the securities lending program to mortgage-related assets, according to testimony by Eric Dinallo, the former superintendent of the New York State Insurance Department, NYSID. Still, by the end of June 2008, AIG had invested $75 billion in cash in mortgage-related securities, which had declined in value to $59.5 billion. By late August 2008, the parent company had to provide $3.3 billion to its struggling securities lending subsidiary, and counterparties were demanding $24 billion to offset the shortfall between the cash collateral provided and the diminished value of the securities. According to Dinallo, the collateral call disputes between AIG and its credit default swap counterparties hindered an orderly wind-down of the securities lending business, and in fact accelerated demands from securities lending counterparties. That Friday, AIG's board dispatched a team led by Vice Chairman Jacob Frenkel to meet with the top officials at the Federal Reserve Bank of New York. Elsewhere in the building, Treasury Secretary Henry Paulson and New York Fed President Timothy Geithner were telling Wall Street bankers that they had the weekend to devise a solution to prevent Lehman's bankruptcy without government assistance. Now came this emergency meeting regarding another beleaguered American institution. Bottom line, the New York Fed later reported of that meeting, AIG's treasurer estimates that parent and financial products have 5 to 10 days before they are out of liquidity. AIG posed a simple question. How could it obtain an emergency loan under the Federal Reserve's 13.3 authority? Without a solution, there was no way this conglomerate, despite more than $1 trillion in assets, would survive another week. End of section 125. Section 126 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 19. Current liquidity position is precarious. AIG's visit to the New York Fed may have been an emergency, but it should not have been a surprise. With the Primary Dealer Credit Facility, PDCF, the Fed had effectively opened its discount window, traditionally available only to depository institutions, to investment banks that qualified as primary dealers. AIG did not qualify, but over the summer, New York Fed officials had begun to consider providing emergency collateralized funding to even more large institutions that were systematically important. That led the regulators to look closely at $2 trillion holding companies, AIG and GE Capital. Both were large participants in the commercial paper market, AIG with $20 billion in outstanding paper, GE Capital with $90 billion. In August, the New York Fed set up a team to study the two companies' funding and liquidity risk. On August 11, New York Fed officials met with Office of Thrift Supervision, OTS, regulators to discuss AIG. The OTS said that it was generally comfortable with the firm's current liquidity and confident that the firm could access the capital markets with no problem if it had to. The New York Fed did not agree. On August 14, 2008, Kevin Coffey, an analyst from the Financial Sector Policy and Analysis Unit, wrote that despite raising $20 billion earlier in the year, AIG is under increasing capital and liquidity pressure and appears to need to raise substantial longer-term funds to address the impact of deteriorating asset values on its capital and available liquidity, as well as to address certain asset-liability funding mismatches. Coffey listed 6 concerns. 1. AIG's significant losses on investments primarily because of securities lending activities. 2. $26.5 billion in mark-to-market losses on AIG Financial Products' credit, default swap book, and related margin calls, for which AIG had posted $16.5 billion in collateral by mid-August. 3. Significant near-term liabilities. 4. Commitment to purchase collateralized debt obligations due to outstanding liquidity puts. 5. Ratings-based triggers in derivative contracts that could cause significant additional collateral calls if AIG were downgraded. And 6. Limited standby credit facilities to manage sudden cash needs. He noted Moody's and S&P had highlighted worries about earnings, capital, and liquidity following AIG's 2008 second quarter earnings. The agencies warned they would downgrade AIG if it did not address these issues. 4 days later, Goldman Sachs issued a report to clients that echoed much of Coffey's internal analysis. The report, "Don't Buy AIG, Potential Downgrades, Capital Raise on the Horizon," warned that we foresee $9 to $20 billion in economic losses from AIG's credit default swap book, which could result in larger cash outlays, resulting in a significant shift in the risk quality of AIG's assets. Put simply, we have seen this credit overhang story before with another stock in our coverage universe and foresee outcomes similar in nature but on a much larger scale. Goldman appeared to be referring to Bear Stearns. Ira Seelig, a manager at the New York Fed, emailed the Goldman report to Coffey and others. The bottom line, large-scale cash outflows and posting of collateral could substantially weaken AIG's balance sheet, the manager wrote. On September 2nd, the New York Fed's Danielle Vincente noted the situation had worsened. AIG's current liquidity position is precarious and asset liability management appears inadequate given the substantial off-balance sheet liquidity needs. Liquidating an $835 billion securities portfolio to cover liabilities would mean substantial losses and potentially affect prices, she wrote. Borrowing against AIG's securities through the Fed's PDCF might allow AIG to unwind its positions calmly while satisfying immediate cash needs, but Vincente questioned whether the PDCF was necessary for the survival of the firm. Arguably, however, AIG's volatile funding sources made the firm vulnerable to runs. Off-balance sheet commitments, including collateral calls, contract terminations, and liquidity puts, could be as high as $33 billion if AIG was downgraded. Yet AIG had only $4 billion of revolving credit facilities in addition to the $12 to $13 billion of cash it had on hand at the time. The rating agencies waited to see how AIG would address its liquidity and capital needs. Analysts worried about the losses in AIG's credit default swaps and investment portfolios, about rating agency actions, and about subsequent impacts on capital. Indeed, Goldman's August 18 report on AIG concluded that the firm itself and the rating agencies were in denial about impending losses. By early September, management was no longer in denial. At the Friday, September 12 meeting at the New York Fed, AIG executives reported that the company was facing serious liquidity issues that threatened its survival viability, and that a downgrade possible after a rating agency meeting September 15 would trigger billions of dollars in collateral calls, liquidity puts, and other liquidity needs. AIG's stock had fallen significantly. Shares hit an intraday low of $11.49 Friday, down from a $17.55 close the day before, and credit default swap spreads had reached 14% during the day, indicating that protection on $10 million of AIG debt would cost approximately $1.4 million per year. AIG reported it was having problems with its commercial paper, able to roll only $1.1 billion of the $2.5 billion that matured on September 12. In addition, some banks were pulling away and even refusing to provide repo funding. Assets were illiquid, their values had declined, borrowing was restricted, and raising capital was not viable. End of section 126. Section 127 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 19, Spillover Effect. The New York Fed knew that a failure of AIG would have dramatic, far-reaching consequences. By the evening of September 12, after the meeting with AIG executives, that possibility looked increasingly realistic. Haley Bosky of the New York Fed emailed William Dudley and others. More panic from hedge funds. Now focus is on AIG, she wrote. I am hearing worse than LEH. Every bank and dealer has exposure to them. Shortly before midnight, New York Fed Assistant Vice President Alejandro Latorre emailed Geithner, Dudley, and other senior officials about AIG. The key takeaway is that they are potentially facing a severe run on their liquidity over the course of the next several, approximately 10 days, if they are downgraded. Their risk exposures are concentrated among the 12 largest international banks, both U.S. and European, across a wide array of product types, bank lines, derivatives, securities, lending, etc., meaning there could be significant counterparty losses to those firms in the event of AIG's failure. New York Fed officials met on Saturday morning and gathered additional information about AIG's financial condition, but according to New York Fed General Counsel Tom Baxter, it seemed clear that the private sector solution would materialize for AIG. Indeed, Christopher Flowers, head of J.C. Flowers & Co., a private equity firm, had spoken to AIG CEO Robert Willemstad the prior Thursday, and the two had called Warren Buffett to discuss a possible deal. Willemstad told the FCIC that he was in contact with about a dozen private equity firms over the weekend. AIG executives also worked with then-Superintendent Eric Dinello to help craft a deal that would have allowed AIG's regulated subsidiaries to essentially lend money to the parent company. Fed officials reported to AIG executives during a conference call on Saturday that they should not be particularly optimistic about financial assistance, given the hurdles, and history of the Fed's 13-3 lending authority. And by the end of the day on Saturday, AIG appeared to the Fed to be pursuing private sector leads. It was clear from the conversation that Flowers is actively involved in working with everything AIG, regulators, bankers, etc., in putting together both the term sheet with AIG and providing analysis to NYSID on liquidity profile of the parent company. Patricia Mosser, a senior vice president at the New York Fed, wrote to Latorre and others. On Sunday morning, September 14, Adam Ashcraft of the New York Fed circulated a memo. Comment on possible 13-3 lending to AIG, discussing the effect of a fire sale by AIG on asset markets. In an accompanying email, Ashcraft wrote that the threat by AIG to sell assets was a clear attempt to scare policymakers into giving AIG access to the discount window, and avoid making otherwise hard but viable options, sell or hedge the CDO risk, little to no impact on capital, sell subsidiaries or raise capital. Before a 2:30 p.m. meeting, Latore sent an analysis, Pros and Cons of Lending to AIG, to colleagues. The pros included avoiding a messy collapse and dislocations in markets such as commercial paper. If AIG collapsed, it could have a spillover effect on other firms involved in similar activities, for example, GE Finance, and would lead to $18 billion increase in European bank capital requirements. In other words, European banks that had lowered credit risk and, as a result, lowered capital requirements by buying credit default swaps from AIG would lose that protection if AIG failed. AIG's bankruptcy would also affect other companies because of its non-trivial exotic derivatives book, a $2.7 trillion over-the-counter derivatives portfolio of which $1 trillion was concentrated in 12 large counterparties. The memo also noted that an AIG failure could cause dislocations in CDS market that could leave dealer books significantly unbalanced. The cons of a bailout included a chilling effect on private sector solutions thought to be underway, the possibility that a Fed loan would be insufficient to keep AIG afloat, undermining efficacy of 13.3 lending as a policy tool, an increase in moral hazard, the perception that it would be incoherent to lend to AIG and not Lehman, the possibility of assets being insufficient to cover the potential liquidity hole. Latore continued, Without punitive terms, lending to AIG could reward poor risk management, which included AIG's unwillingness to sell or hedge some of its CDO risk. The private sector solutions Latore referred to had hit a wall, however. By Sunday afternoon, Flowers had been summarily dismissed by AIG's board. Flowers told the FCIC that under his proposal, his firm and Alliance, the giant insurance company, would have each invested $5 billion in exchange for the stock of AIG subsidiaries. With approval from the NYSID, the subsidiaries would upstream $20 billion to the parent company, and the parent company would get access to bridge financing from the Fed. Then Alliance would take control of AIG almost immediately. Flowers said that he was surprised by AIG's unwillingness to negotiate. I'm not saying it would have worked or that it was perfect as written, but it was astounding to me that given what happened, nobody bothered to check this deal out, he said. Willemstad referred to the Flowers deal as a so-called offer. He did not consider it to be a serious effort, and so it was dismissed immediately. With respect to the other potential investors AIG spoke with over the weekend, Willemstad said that negotiations were unsuccessful because every potential deal would have required government assistance, something Willemstad had been assured by the highest levels would not be forthcoming. On Monday morning, after Lehman had declared bankruptcy and with no private sector solution on the horizon, the Fed initiated an effort to have J.P. Morgan and Goldman Sachs assemble a syndicate of banks to lend about $75 billion to keep AIG afloat. In the afternoon, the rating agencies announced their assessments, which were even worse than expected. All three rating agencies announced downgrades of AIG, S&P by 3 notches to A-, and Moody's and Fitch by 2 notches to A2 and A, respectively. The downgrades triggered an additional $13 billion in cash collateral calls on AIG financial products credit default swaps. Goldman Sachs alone requested $2.1 billion. Demands hit $32 billion, and AIG's payouts increased to $19.5 billion. The company's stock plummeted 61% to $4.76 from the closing price of $12.14 the previous Friday, a fraction of its all-time high of $145.84. The syndicate of banks did not agree on a deal despite the expectations of Fed officials. Once Lehman filed for bankruptcy on the morning of the 15th, everyone decided that we've got to protect our own balance sheet, and the banks that were going to provide the $75 billion decided that they were not going to, Baxter told the FCIC. Sarah Dahlgren, a senior New York Fed official, agreed with Baxter. Lehman's bankruptcy was the end of the private sector solution, she told the commission. After the markets closed, AIG informed the New York Fed it was unable to access the short-term commercial paper market. Regulators spent the next several hours preparing for a late-night teleconference with Geithner. The lead point, according to an email circulated to the Fed's AIG monitoring group, was that the size, name, franchise, and market presence, wholesale and retail, of AIG raised questions about potential worldwide contagion should this franchise become impaired. Late that night, for the second time since the beginning of the crisis, the Federal Reserve Board invoked Section 13(3) of the Federal Reserve Act to bail out a company. As it had done for Bear Stearns, the New York Fed, with the support of the Treasury, would rescue a brand-name financial institution. The Federal Open Market Committee was briefed about AIG. Members were told that AIG faced a liquidity crisis, but that it was unclear if there were also solvency issues. In addition, the staff noted that money market funds had even broader exposure to AIG than to Lehman, and that the parent company could run out of money quite soon, even within days. On Tuesday morning, the Fed put a number on the table. It would loan $85 billion so that AIG could meet its immediate obligations. The collateral would be the assets of the parent company and its primary non-regulated subsidiaries, plus the stock of almost all the regulated insurance subsidiaries. The Fed stated that a disorderly failure of AIG could add to already significant levels of financial market fragility and lead to substantially higher borrowing costs, reduced household wealth, and materially weaker economic performance. By Wednesday, a share of AIG sold for as little as $1.99. The previous 8 years' profits of $66 billion would be dwarfed by the $99.3 billion loss for this 1 year, 2008. But $85 billion would soon prove insufficient. Treasury added $49.1 billion under its Troubled Asset Relief Program, TARP. Ultimately, according to the Congressional Oversight Panel, taxpayer funds committed to AIG reached $182 billion. The panel faulted the government for deciding to bail out AIG too hastily. With AIG, the Federal Reserve and Treasury broke new ground. They put the U.S. taxpayer on the line for the full cost and full risk of rescuing a failing company. The Treasury Department defended its decision, saying that the panel report overlooks the basic fact that the global economy was on the brink of collapse and there were only hours in which to make critical decisions. End of section 127. Section 128 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 19, Like a Gnat on an Elephant. The Office of Thrift Supervision has acknowledged failures in its oversight of AIG. In a March 18, 2009 congressional hearing, Acting Director Scott Polikoff testified that supervisors failed to recognize the extent of liquidity risk of the financial products subsidiary's credit default swap portfolio. John Reich, a former OTS director, told the FCIC that as late as September 2008, he had no clue, no idea what AIG's CDS liability was. According to Mike Finn, the director for the OTS's Northeast region, the OTS's authority to regulate holding companies was intended to ensure the safety and soundness of the FDIC-insured subsidiary of AIG, and not to focus on the potential impact of AIG of an uninsured subsidiary like AIG Financial Products. Finn ignored the OTS's responsibilities under the European Union's Financial Conglomerates Directive, FCD, responsibilities the OTS had actively sought. The directive required foreign companies doing business in Europe to have the equivalent of a consolidated supervisor in their home country. Starting in 2004, the OTS worked to persuade the European Union that it was capable of serving as AIG's home country consolidated supervisor. In 2005, the agency wrote, AIG and its subsidiaries are subject to consolidated supervision by OTS. As part of its supervision, OTS will conduct continuous on-site reviews of AIG and its subsidiaries. Yet even Reich told FCIC staff that he did not understand his agency's responsibilities under the FCD. The former director said he was never sure what authority the OTS had over AIG Financial Products, which he said had slipped through a regulatory gap. Further undermining the OTS's claim that it lacked authority over AIG Financial Products are its own actions. The OTS did in fact examine the subsidiary, albeit much too late to matter. OTS examiners argued they got little cooperation from Joseph Cassano, the head of the subsidiary. Joseph Gonzalez, the examiner in charge from April 2004 to November 2006, told FCIC staff, "I overheard one employee saying that Joe Cassano felt that the OTS was overreaching our scope by going into FP." The OTS did not look carefully at the credit default swap portfolio guaranteed by the parent company, even though AIG did describe the nature of its super senior portfolio in its annual reports at that time, including the dollar amount of total credit default swaps that it had written. Gonzalez said that the OTS did not know about the CDS during the 2004-5 period. After a limited review in July 2007, conducted a week before Goldman sent AIG Financial Products its first demand for collateral, the OTS concluded that the risk in the CDS book was too small to be measured and decided to put off a more detailed review until 2008. The agency's stated reason was its limited time and staff resources. In February 2008, AIG reported billions of dollars in losses and material weaknesses in the way it valued credit default swap positions. Yet the OTS did not initiate an in-depth review of the credit default swaps until September 2008, 10 days before AIG went to the Fed seeking a rescue, completing the review on October 17, more than a month after AIG failed. It was, former OTS Director of Conglomerate Operations Brad Waring admitted, in hindsight, a bad choice. Reich told the FCIC that before 2008, AIG had not been a great concern. He also acknowledged that the OTS had never fully understood the financial products unit, and thus couldn't regulate it. At the simplest level, an organization like OTS cannot supervise AIG, GE, Merrill Lynch, and entities that have worldwide offices. I would be the first to say that for an organization like OTS to pretend that it has total responsibility over AIG and all of its subsidiaries, it's like a gnat on an elephant. There's no way. Reich said that for the OTS to think it could regulate AIG was totally impractical and unrealistic. I think we thought we could grow into that responsibility, but I think that was sort of pie-in-the-sky dreaming. Geithner agreed and told Reich so bluntly. Reich told the FCIC about a phone call from Geithner after the rescue. "About all I can remember is the foul language that I heard on the other end of the line," Reich said. He recalled Geithner telling him, "You guys have handed me a bag of shit. I just listened." End of section 128. Section 129 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Commission Conclusions on Chapter 19. The Commission concludes AIG failed and was rescued by the government primarily because its enormous sales of credit default swaps were made without putting up initial collateral, setting aside capital reserves, or hedging its exposure, a profound failure in corporate governance, particularly its risk management practices. AIG's failure was possible because of the sweeping deregulation of over-the-counter OTC derivatives, including credit default swaps, which effectively eliminated federal and state regulation of these products, including capital and margin requirements that would have lessened the likelihood of AIG's failure. The OTC derivatives market's lack of transparency and of effective price discovery exacerbated the collateral disputes of AIG and Goldman Sachs, and similar disputes between other derivatives counterparties. AIG engaged in regulatory arbitrage by setting up a major business in this unregulated product, locating much of the business in London and selecting a weak federal regulator, the Office of Thrift Supervision, OTS. The OTS failed to effectively exercise its authority over AIG and its affiliates. It lacked the capability to supervise an institution of the size and complexity of AIG, did not recognize the risks inherent in AIG's sales of credit default swaps, and did not understand its responsibility to oversee the entire company, including AIG Financial Products. Furthermore, because of the deregulation of OTC derivatives, state insurance supervisors were barred from regulating AIG's sale of credit default swaps, even though they were similar in effect to insurance contracts. If they had been regulated as insurance contracts, AIG would have been required to maintain adequate capital reserves, would not have been able to enter into contracts requiring the posting of collateral, and would not have been able to provide default protection to speculators. Thus, AIG would have been prevented from acting in such a risky manner. AIG was so interconnected with many large commercial banks, investment banks, and other financial institutions through counterparty credit relationships on credit default swaps and other activities such as securities lending that its potential failure created systemic risk. The government concluded AIG was too big to fail and committed more than $180 billion to its rescue. Without the bailout, AIG's default and collapse could have brought down its counterparties, causing cascading losses and collapses throughout the financial system. End of section 129.
Section 130 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 20, Crisis and Panic. Intro. September 15, 2008. The date of the bankruptcy of Lehman Brothers and the takeover of Merrill Lynch, followed within 24 hours by the rescue of AIG, marked the beginning of the worst market disruption in post-war American history and an extraordinary rush to the safest possible investments. Creditors and investors suspected that many other large financial institutions were on the edge of failure, and the Lehman bankruptcy seemed to prove that at least some of them would not have access to the federal government's safety net. John Mack, CEO of Morgan Stanley during the crisis, told the FCIC, "In the immediate wake of Lehman's failure on September 15, Morgan Stanley and similar institutions experienced a classic run on the bank as investors lost confidence in financial institutions and the entire investment banking business model came under siege. The markets were very bad, the volatility, the illiquidity, some things couldn't trade at all. I mean, completely locked. The markets were in terrible shape," JP Morgan CEO Jamie Dimon recalled to the FCIC. He thought the country could face 20% unemployment. "We could have survived it, in my opinion, but it would have been terrible. I would have stopped lending, marketing, investing, and probably laid off 20,000 people. And I would have done it in 3 weeks. You get companies starting to take actions like that. That's what a Great Depression is." Treasury Secretary Timothy Geithner told the FCIC, "You had people starting to take their deposits out of very, very strong banks, long way removed in distance and risk and business from the guys on Wall Street that were at the epicenter of the problem. And that is a good measure, classic measure in incipient panic." In an interview in December 2009, Geithner said that none of the biggest banks would have survived the situation in which we had let that fire try to burn itself out. Fed Chairman Ben Bernanke told the FCIC, "As a scholar of the Great Depression, I honestly believe that September and October of 2008 was the worst financial crisis in global history, including the Great Depression. If you look at the firms that came under pressure in that period, only one was not at serious risk of failure. So out of maybe the 13 of the most important financial institutions in the United States, 12 were at risk of failure within a period of a week or two." As it had on the weekend of Burns' demise, the Federal Reserve announced new measures on Sunday, September 14, to make more cash available to investment banks and other firms. Yet again, it lowered its standards regarding the quality of the collateral that investment banks and other primary dealers could use while borrowing under the 2 programs to support repo lending, the Primary Dealer Credit Facility, PDCF, and the Term Securities Lending Facility, TSLF. And providing a temporary exception to its rules, it allowed the investment banks and other financial companies to borrow cash from their insured depository affiliates. The investment banks drew liberally on the Fed's lending programs. By the end of September, Morgan Stanley was getting by on $96.1 billion of Fed-provided life support. Goldman was receiving $31.5 billion. But the new measures did not quell the market panic. Among the first to be directly affected were the money market funds and other institutions that held Lehman's $4 billion in unsecured commercial paper and made loans to the company through the tripartite repo market. Investors pulled out the funds with known exposure to that jeopardy, including the Reserve Management Company's Reserve Primary Fund and Wachovia's Evergreen Investments. Other parties with direct connections to Lehman included the hedge funds, investment banks, and investors who were on the other side of Lehman's more than 900,000 over-the-counter derivatives contracts. For example, Deutsche Bank, JP Morgan, and UBS together had more than 150,000 outstanding trades with Lehman as of May 2008. The Lehman bankruptcy caused immediate problems for these OTC derivatives counterparties. They had the right under U.S. bankruptcy law to terminate their derivatives contracts with Lehman upon its bankruptcy, and to the extent that Lehman owed them money on the contracts, they could seize any Lehman collateral that they held. However, any additional amount owed to them had to be claimed in the bankruptcy proceeding. If they had posted collateral with Lehman, they would have to make a claim for the return of that collateral, and disputes over valuation of the contracts would still have to be resolved. These proceedings would delay payment and most likely result in losses. Moreover, any hedges that rested on these contracts were now gone, increasing risk. Investors also pulled out of funds that did not have direct Lehman exposure. The managers of these funds, in turn, pulled $165 billion out of the commercial paper market in September and shifted billions of dollars of repo loans to safer collateral, putting further pressure on investment banks and other finance companies that depended on those markets. When the commercial paper market died, the biggest corporations in America thought they were finished. Harvey Miller, the bankruptcy attorney for the Lehman estate, told the FCIC. Investors and uninsured depositors yanked tens of billions of dollars out of banks whose real estate exposures might be debilitating. Washington Mutual, Wachovia, in favor of those whose real estate exposures appeared manageable, Wells Fargo, JP Morgan. Hedge funds withdrew tens of billions of dollars of assets held in custody at the remaining investment banks, Goldman Sachs, Morgan Stanley, and even Merrill Lynch, as the just-announced Bank of America acquisition wouldn't close for another 3.5 months, in favor of large commercial banks with prime brokerage businesses, JP Morgan, Credit Suisse, Deutsche Bank, because the commercial banks had more diverse sources of liquidity than the investment banks, as well as large bases of insured deposits. JP Morgan and BNY Mellon, the tri-party repo clearing banks, clamped down on their intraday exposures, demanding more collateral than ever from the remaining investment banks and other primary dealers. Many banks refused to lend to one another. The cost of interbank lending rose to unprecedented levels. See Figure 20.1. On Monday, September 15, the Dow Jones Industrial Average fell more than 500 points or 4%, the largest single-day point drop since the 9/11 terrorist attacks. These drops would be exceeded on September 29, the day that the House of Representatives initially voted against the $700 billion Troubled Asset Relief Program, TARP, proposal to provide extraordinary support to financial markets and firms, when the Dow Jones fell 7% and financial stocks fell 16%. For the month, the S&P 500 would lose $889 billion of its value, a decline of 9%, the worst month since September 2002. And specific institutions would take direct hits. End of section 130. Section 131 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 20. Money Market Funds. Dealers weren't even picking up their funds. When Lehman declared bankruptcy, the Reserve Primary Fund had $785 million invested in Lehman's commercial paper. The Primary Fund was the world's first money market mutual fund, established in 1971 by Reserve Management Company. The fund had traditionally invested in conservative assets such as government securities and bank certificates of deposit, and had for years enjoyed Moody's and S&P's highest ratings for safety and liquidity. In March 2006, the fund had advised investors that it had slightly underperformed its rivals, owing to a more conservative and risk-averse manner of investing. For example, the reserve funds do not invest in commercial paper. But immediately after publishing this statement, it quietly but dramatically changed that strategy. Within 18 months, commercial paper grew from 0 to 1/2 of reserve primary assets. The higher yields attracted new investors, and the reserve primary fund was the fastest-growing money market fund complex in the United States in 2006, 2007, and 2008, doubling in the first 8 months of 2008 alone. Earlier in 2008, primary funds managers had loaned Bear Stearns money in the repo market up to 2 days before Bear's near collapse, pulling its money only after Bear's CEO Alan Schwartz appeared on CNBC in the company's final days, primary fund portfolio manager Michael Luciano told the FCIC. But after the government-assisted rescue of Bear, Luciano, like many other professional investors, said he assumed that the federal government would similarly save the day if Lehman or one of the other investment banks, which were much larger and posed greater apparent systemic risks, ran into trouble. These firms, Luciano said, were too big to fail. On September 15, when Lehman declared bankruptcy, the primary fund's Lehman holdings amounted to 1.2% of the fund's total assets of $62.4 billion. That morning, the fund was flooded with redemption requests totaling $10.8 billion. State Street, the fund's custodian bank, initially helped the fund meet those requests, largely through an existing overdraft facility, but it stopped doing so at 10:10 a.m. With no means to borrow, primary fund representatives reportedly described State Street's action as the kiss of death for the primary fund. Despite public assurances from the fund's investment advisors, Bruce Bent Sr. and Bruce Bent II, that the fund was committed to maintaining a $1 net asset value, investors requested an additional $29 billion later on Monday and Tuesday, September 16. Meanwhile, on Monday, the fund's board had determined that the Lehman paper was worth 80 cents on the dollar. That appraisal had quickly proved optimistic. After the market closed Tuesday, Reserve Management publicly announced that the value of its Lehman paper was zero, effective 4 p.m. New York time today. As a result, the fund broke the buck. 4 days later, the fund sought SEC permission to officially suspend redemptions. Other funds suffering similar losses were propped up by their sponsors. On Monday, Wachovia's asset management unit, Evergreen Investments, announced that it would support 3 evergreen mutual funds that held about $540 million in Lehman paper. On Wednesday, BNY Mellon announced support for various funds that held Lehman paper, including the $22 billion Institutional Cash Reserves Fund and 4 of its trademark Dreyfus funds. BNY Mellon would take an after-tax charge of $425 million because of this decision. Over the next 2 years, 62 money market funds, 36 based in the United States, 26 in Europe, would receive such assistance to keep their funds from breaking the buck. After the primary fund broke the buck, the run took an ominous turn. It even slammed money market funds with no direct Lehman exposure. This lack of exposure was generally known, since the SEC requires these funds to report details on their investments at least quarterly. Investors pulled out simply because they feared that their fellow investors would run first. It was overwhelmingly clear that we were staring into the abyss, that there wasn't a bottom to this. As the outflows picked up steam on Wednesday and Thursday, Fed economist Patrick McCabe told the FCIC, the overwhelming sense was that this was a catastrophe that we were watching unfold. We were really cognizant of the fact that there weren't backstops in the system that were resilient at that time, the Fed's Michael Palumbo said. Liquidity crises, by their nature, invoke rapid emergent episodes. That's what they are. By their nature, they spread very quickly. An early and significant casualty was Putnam Investments' $12 billion prime money market fund, which was hit on Wednesday with a wave of redemption requests. The fund, unable to liquidate assets quickly enough, halted redemptions. 1 week later, it was sold to federated investors. Within a week, investors in prime money market funds that invested in highly rated securities, withdrew $349 billion. Within 3 weeks, they withdrew another $85 billion. That money was mostly headed for other funds that bought only treasuries and agency securities. Indeed, it was more money than those funds could invest, and they had to turn people away. See figure 20.2. As a result of the unprecedented demand for treasuries, the yield on 4-week treasuries fell close to 0%, levels not seen since World War II. Money market mutual funds needing cash to honor redemptions sold their now illiquid investments. Unfortunately, there was little market to speak of. We heard anecdotally that the dealers weren't even picking up their funds. The funds had to get rid of their paper. They didn't have anyone to give it to, McCabe said. And holding unsecured commercial paper from any large financial institution was now simply out of the question. Fund managers wanted no part of the next Lehman. An FCIC survey of the largest money market funds found that many were unwilling to purchase commercial paper from financial firms during the week after Lehman. Of the respondents, the 5 with the most drastic reduction in financial commercial paper cut their holdings by half, from $58 billion to $29 billion. This led to unprecedented increases in the rates on commercial paper, creating problems for borrowers, particularly for financial companies such as GE Capital, CIT, and American Express, as well as for non-financial corporations that used commercial paper to pay their immediate expenses such as payroll and inventories. The cost of commercial paper borrowing spiked in mid-September, dramatically surpassing the previous highs in 2007. See figure 20.3. You had a broad-based run on commercial paper markets, Geithner told the FCIC. And so you faced the prospect of some of the largest companies in the world and the United States losing the capacity to fund and access those commercial paper markets. 3 decades of easy borrowing for those with top-rated credit in a very liquid market had disappeared almost overnight. The panic threatened to disrupt the payments system through which financial institutions transferred trillions of dollars in cash and assets every day and upon which consumers rely, for example, to use their credit cards and debit cards. At that point, you don't need to map out which particular mechanism. It is not relevant anymore. It's become systemic and endemic, and it needs to be stopped, Palumbo said. The government responded with 2 new lending programs on Friday, September 19. Treasury would guarantee the $1 net asset value of eligible money market funds for the fee paid by the funds. And the Fed would provide loans to banks to purchase high-quality asset-backed commercial paper from money market funds. In its first 2 weeks, this program loaned banks $150 billion, although usage declined over the ensuing months. The 2 programs immediately slowed the run on money market funds. With the financial sector in disarray, the SEC imposed a temporary ban on short selling on the stocks of about 800 banks, insurance companies, and securities firms. This action, taken on September 18, followed an earlier temporary ban put in place over the summer on naked short selling, that is, shorting a stock without arranging to deliver it to the buyer, of 19 financial stocks in order to protect them from unlawful manipulation. Meanwhile, Treasury Secretary Henry Paulson and other senior officials had decided they needed a more systematic approach to dealing with troubled firms and troubled markets. Paulson started seeking authority from Congress for TARP. One thing that was constant about the crisis is that we weren't always behind. It was always morphing and manifesting itself in ways we didn't expect, Neil Kashkari, then Assistant Secretary of the Treasury, told the FCIC. So we knew we'd get one shot at this authority, and it was important that we provided ourselves maximum firepower and maximum flexibility. We specifically designed the authority to allow us basically to do whatever we needed to do. Kashkari spent the next 2 weeks basically living on Capitol Hill. As discussed below, the program was a tough sell. End of section 131. Section 132 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 20. Morgan Stanley. Now we're the next in line. Investors scrutinized the 2 remaining large independent investment banks after the failure of Lehman and the announced acquisition of Merrill, especially Morgan Stanley. On Monday, September 15, the annual cost of protecting $10 million in Morgan Stanley debt through credit default swaps jumped to $682,000 from $363,000 on Friday, about double the cost for Goldman. As soon as we come in on Monday, we're in the eye of the storm with Merrill gone and Lehman gone. John Mack, then Morgan Stanley's CEO, said to the FCIC. He later added, "Now we're the next in line." Morgan Stanley officials had some reason for confidence. On the previous Friday, the company's liquidity pool was more than $130 billion. Goldman's was $120 billion, and, like Goldman, it had passed the regulator's liquidity stress tests months earlier. But the early market indicators were mixed. David Wong, Morgan Stanley's treasurer, heard early from his London office that several European banks were not accepting Morgan Stanley as a counterparty on derivatives trades. He called those banks and they agreed to keep their trades with Morgan Stanley, at least for the time being. But Wong well knew that rumors about derivatives counterparties fleeing through novations had contributed to the demise of Bear and Lehman. Repo lenders, primarily money market funds, likewise did not panic immediately. On Monday, only a few of them requested slightly more collateral. But the relative stability was fleeting. Morgan Stanley immediately became the target of a hedge fund run. Before the financial crisis, it had typically been prime borrowers like Morgan Stanley who were worried about their exposures to hedge fund clients. Now the roles were reversed. The Lehman episode had revealed that because prime brokers were able to reuse clients' assets to raise cash for their own activities, clients' assets could be frozen or lost in bankruptcy proceedings. To protect themselves, hedge funds pulled billions of dollars in cash and other assets out of Morgan Stanley, Merrill, and Goldman in favor of prime brokers in bank holding companies such as JP Morgan, big foreign banks such as Deutsche Bank and Credit Suisse, and custodian banks such as BNY Mellon and Northern Trust, which they believed were safer and more transparent. Fund managers told the FCIC that some prime brokers took aggressive measures to prevent hedge fund customers from demanding their assets. For example, most hedge funds request cash movement from prime brokers primarily through a fax, the hedge fund manager Jonathan Wood told the FCIC. What tends to happen in very stressful times is those faxes tend to get lost. I'm not sure that it's just coincidental. That was collateral for whatever lending prime brokers had against you, and they didn't want to give it away. Soon, hedge funds would suffer unprecedented runs by their own investors. According to an FCIC survey of hedge funds that survived, investor redemption requests averaged 20% of client funds in the fourth quarter of 2008. This pummeled the markets. Money invested in hedge funds totaled $2.2 trillion globally at the end of 2007, but because of leverage, their market impact was several times larger. Widespread redemptions forced hedge funds to sell extraordinary amounts of assets, further depressing market prices. Many hedge funds would halt redemptions or collapse. On Monday, hedge funds requested about $10 billion from Morgan Stanley. Then on Tuesday morning, Morgan Stanley announced a profit of $1.4 billion for the 3 months ended August 31, 2008, about the same as that period a year earlier. Mack had decided to release the good news a day early, but this move had backfired. One hedge fund manager said to me after the fact that he thought pre-announcing earnings a day early was a sign of weakness. So I guess it was, because people certainly continued to short our stock or sell our stock. I didn't know if they were shorting it, but they were certainly selling it, Mack told the FCIC. Wong said, "We were managing our funding, but really there were other things that were happening as a result of the Lehman bankruptcy that were beginning to really ripple through and affect some of our clients, our more sophisticated clients." The hedge fund run became a $32 billion torrent on Wednesday, the day after AIG was bailed out and the day that many of our sophisticated clients started to liquefy, as Wong put it. Many of the hedge funds now sought to exercise their contractual capability to borrow more from Morgan Stanley's prime brokerage without needing to post collateral. Morgan Stanley borrowed $13 billion from the Fed's PDCF on Tuesday, $27 billion on Wednesday, and $35.3 billion on Friday. These developments triggered the event that Fed policymakers had worried about over the summer: an increase in collateral calls by the two tri-party repo clearing banks, JP Morgan and BNY Mellon. As had happened during the bear episode, the two clearing banks became concerned about their intraday exposures to Morgan Stanley, Merrill, and Goldman. On Sunday of the Lehman weekend, the Fed had lowered the bar on the collateral that it would take for overnight lending through the PDCF. But the PDCF was not designed to take the place of the intraday funding provided by JP Morgan and BNY Mellon, and neither of them wanted to accept for their intraday loans the lower quality collateral that the Fed was accepting for its overnight loans. They would not make those loans to the three investment banks without requiring bigger haircuts, which translated into requests for more collateral. Big intraday issues at the clearing banks, the SEC's Matt Eichner informed New York Fed colleagues in an early Wednesday email. They don't want exposure and are asking for cash securities. Lots of desk-level noise around Morgan Stanley and Merrill Lynch, and taking the name. Not pretty. Taking the name is Wall Street parlance for accepting a counterparty on a trade. On Thursday, BNY Mellon requested $3 billion in collateral from Morgan Stanley, and New York Fed officials reported that JP Morgan was thinking about requesting $2.8 billion on top of a $2.2 billion on deposit. According to a Fed examiner at Citigroup, a banker from that firm had said that Morgan Stanley is the deer in the headlights and having significant stress in Europe. It's looking like Lehman did a few weeks ago. Commercial paper markets also seized up for Morgan Stanley. From Friday, September 12 to the end of September, the amount of the firm's outstanding commercial paper had fallen nearly 40%, and it had rolled over only $20 million. By comparison, on average, Morgan Stanley rolled over about $240 million every day in the last 2 weeks of August. On Saturday, Morgan Stanley executives briefed the New York Fed on the situation. By this time, the firm had a total of $35.3 billion in PDCF funding and $32.5 billion in TSLF funding from the Fed. Morgan Stanley's liquidity pool had dropped from $130 billion to $55 billion in 1 week. Repo lenders had pulled out $31 billion, and hedge funds had taken $86 billion out of Morgan Stanley's prime brokerage. That run had vastly exceeded the company's most severe scenario in stress tests administered only 1 month earlier. During the week, Goldman Sachs had encountered a similar run. Its liquidity pool had fallen from about $120 billion on the previous Friday to $57 billion on Thursday. At the end of the week, its Fed borrowing totaled $5 billion from the PDCF and $13.5 billion from the TSLF. Lloyd Blankfein, Goldman's CEO, told the FCIC, "We had tremendous liquidity through the period, but there were systemic events going on and we were very nervous. If you're asking me what would have happened but for the considerable government intervention, I would say we were in. It was a more nervous position than we would have wanted to be in. We never anticipated the government help. We weren't relying on those mechanisms. I felt good about it, but we were going to bed every night with more risk than any responsible manager should want to have, either for our business or for the system as a whole. Risk, not certainty." Bernanke told the FCIC that the Fed believed the run on Goldman that week could lead to its failure. Like JP Morgan, Goldman Sachs, I would say, also protected themselves quite well on the whole. They had a lot of capital, a lot of liquidity, but being in the investment banking category rather than the commercial banking category, when that huge funding crisis hit all the investment banks, even Goldman Sachs, we thought there was a real chance that they would go under. Although it did not keep pace with Morgan Stanley's use of the Fed's facilities, Goldman Sachs would continue to access the Fed's facilities, increasing its PDCF borrowing to a high of $24 billion in October and its TSLF borrowing to a high of $43.5 billion in December. On Sunday, September 21, both Morgan Stanley and Goldman Sachs applied to the Fed to become bank holding companies. In my 30-year history, Goldman and Morgan Stanley had consistently opposed Federal Reserve supervision, but after Lehman, those franchises saw that they were next unless they did something drastic. That drastic thing was to become bank holding companies. Tom Baxter, the New York Fed's general counsel, told the FCIC. The Fed, in tandem with the Department of Justice, approved the two applications with extraordinary speed, waiving the standard 5-day antitrust waiting period. Morgan Stanley instantly converted its $39 billion industrial loan company into a national bank, subject to supervision by the Office of the Comptroller of the Currency, OCC, and Goldman converted its $26 billion industrial loan company into a state charter bank that was a member of the Federal Reserve System, subject to supervision by the Fed and New York State. The Fed would begin to supervise the two new bank holding companies. The two companies gained the immediate benefit of emergency access to the discount window for terms of up to 90 days. But more important, I think the biggest benefit is it will show you that you're important to the system, and the Fed would not make you a holding company if they thought in a very short period of time you'd be out of business, Mack told the FCIC. It sends a signal that these two firms are going to survive. In a show of confidence, Warren Buffett invested $5 billion in Goldman Sachs, and Mitsubishi UFJ invested $9 billion in Morgan Stanley. Mack said he had been waiting all weekend for confirmation of Mitsubishi's investment when, late Sunday afternoon, he received a call from Bernanke, Geithner, and Paulson. Basically, they said they wanted me to sell the firm, Mack told the FCIC. Less than an hour later, Mitsubishi called to confirm his investment and the regulators backed off. Despite the weekend announcements, however, the run on Morgan Stanley continued. Over the course of a week, a decreasing number of people were willing to do new repos, one said. They just couldn't lend anymore. By the end of September, Morgan Stanley's liquidity pool would be $55 billion. But Morgan Stanley's liquidity depended critically on borrowing from two Fed programs, $60 billion from the BDCF and $36 billion from the TSLF. Goldman Sachs' liquidity pool had recovered to about $80 billion, backed by $16.5 billion from the BDCF and $15 billion from the TSLF. End of section 132. Section 133 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 20. Over-the-counter derivatives, a grinding halt. Trading in over-the-counter derivatives markets had been declining as investors grew more concerned about counterparty risk and as hedge funds and other market participants reduced their positions or exited. Activity in many of these markets slowed to a crawl. In some cases, there was no market at all, no trades whatsoever. A sharp and unprecedented contraction of the market occurred. The OTC derivatives markets came to a grinding halt, jeopardizing the viability of every participant regardless of their direct exposure to subprime mortgage-backed securities, the hedge fund manager Michael Masters told the FCIC. Furthermore, when the OTC derivatives markets collapsed, participants reacted by liquidating their positions in other assets those swaps were designed to hedge. This market was unregulated and largely opaque, with no public reporting requirements and little or no price discovery. With the Lehman bankruptcy, participants in the market became concerned about the exposures and creditworthiness of their counterparties and the value of their contracts. That uncertainty caused an abrupt retreat from the market. Badly hit was the market for derivatives based on non-prime mortgages. Firms had come to rely on the prices of derivatives contracts reflected on the ABX indices to value their non-prime mortgage assets. The ABX HE BBB 062, whose decline in 2007 had been an early bellwether for the market crisis, had been trading around 5 cents on the dollar since May, but trading on this index had become so thin, falling from an average of about 70 transactions per week from January 2007 to September 2008 to fewer than 3 transactions per week in October 2008, that index values weren't informative. So what was a valid price for these assets? Price discovery was a guessing game, even more than it had been under normal market conditions. The contraction of the OTC derivatives market had implications beyond the valuation of mortgage securities. Derivatives had been used to manage all manner of risk: the risk that currency exchange rates would fluctuate, the risk that interest rates would change, the risk that asset prices would move. Efficiently managing these risks in derivatives markets required liquidity so that positions could be adjusted daily and at little cost. But in the fall of 2008, everyone wanted to reduce exposure to everyone else. There was a rush for the exits as participants worked to get out of existing trades. And because everyone was worried about the risk inherent in the next trade, there often was no next trade, and volume fell further. The result was a vicious circle of justifiable caution and inaction. Meanwhile, in the absence of a liquid derivatives market and efficient price discovery, every firm's risk management became more expensive and difficult. The usual hedging mechanisms were impaired. An investor that wanted to trade at a loss to get out of a losing position might not find a buyer, and those that needed hedges would find them more expensive or unavailable. Several measures revealed the lack of liquidity in derivatives markets. First, the number of outstanding contracts in a broad range of OTC derivatives sharply declined. Since its deregulation by federal statute in December 2000, this market had increased more than sevenfold. From June 30, 2008 to the end of the year, however, outstanding notional amounts of OTC derivatives fell by more than 10%. This decline defied historical precedent. It was the first significant contraction in the market over a 6-month period since the Bank for International Settlements began keeping statistics in 1998. Moreover, it occurred during a period of great volatility in the financial markets. At such a time, firms usually turned to the derivatives market to hedge their increased risks, but now they fled the market. The lack of liquidity in derivatives markets was also signaled by the higher prices charged by OTC derivatives dealers to enter into contracts. Dealers bear additional risks when markets are illiquid, and they pass the cost of those risks on to market participants. The cost is evident in the increased bid-ask spread, the difference between the price at which dealers were willing to buy contracts, the bid price, and the price at which they were willing to sell them, the ask price. As markets became less liquid during the crisis, dealers worried that they might be saddled with unwanted exposure. As a result, they began charging more to sell contracts, raising their ask price, and the spread rose. In addition, they offered less to buy contracts, lowered their bid price, because they feared involvement with uncreditworthy counterparties. The increase in the spread in these contracts meant that the cost to a firm of hedging its exposure to the potential default of a loan or of another firm also increased. The cost of risk management rose just when the risks themselves had risen. Meanwhile, outstanding credit derivatives contracted by 48% between December 2007, when they reached their height of $58.2 trillion in notional amount, and the latest figures as of June 2010, when they have fallen to $30.3 trillion. In sum, the sharp contraction in the OTC derivatives market in the fall of 2008 greatly diminished the ability of institutions to enter or unwind their contracts or to effectively hedge their business risks at a time when uncertainty in the financial system made risk management a top priority. End of section 133. Section 134 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 20. Washington Mutual. It's yours. In the 8 days after Lehman's bankruptcy, depositors pulled $16.7 billion out of Washington Mutual, which now faced imminent collapse. WAMU had been the subject of concern for some time because of its poor mortgage underwriting standards and its exposures to payment option adjustable rate mortgages, ARMs. Moody's had downgraded WAMU's senior unsecured debt to Baa3, the lowest tier investment grade rating, in July, and then to junk status on September 11, citing WAMU's reduced financial flexibility, deteriorating asset quality, and expected franchise erosion. The Office of Thrift Supervision, OTS, determined that the thrift likely could not pay its obligations and meet its operating liquidity needs. The government seized the bank on Thursday, September 25, 2008, appointing the Federal Deposit Insurance Corporation as receiver. Many unsecured creditors suffered losses. With assets of $307 billion as of June 30, 2008, WAMU thus became the largest insured depository institution in U.S. history to fail, bigger than IndyMac, bigger than any bank or thrift failure in the 1980s and 1990s. JP Morgan paid $1.9 billion to acquire WAMU's banking operations from the FDIC on the same day. On the next day, WAMU's parent company, now minus the thrift, filed for Chapter 11 bankruptcy protection. FDIC officials told the FCIC that they had known in advance of WAMU's troubles and thus had time to arrange the transaction with JP Morgan. JP Morgan CEO Jamie Dimon said that his bank was already examining WAMU's assets for purchase when FDIC Chairman Sheila Bair called him and asked, "Would you be prepared to bid on WAMU?" I said yes we would, Dimon told the FCIC. She called me up literally the next day and said, "It's yours." I thought there was another bidder, by the way, the whole time. Otherwise, I would have bid $1, not $1.9 billion, but we wanted to win. The FDIC insurance fund came out of the WAMU bankruptcy whole. So did the uninsured depositors and, of course, the insured depositors. But the FDIC never contemplated using FDIC funds to protect unsecured creditors, which it could have done by invoking the systemic risk exception under the FDIC Improvement Act of 1991. Recall the FDICIA required that failing banks be dismantled at the least cost to the FDIC unless the FDIC, the Fed, and Treasury agree that a particular company's collapse poses a risk to the entire financial system. It had not been tested in 17 years. Losses among those creditors created panic among the unsecured creditors of other struggling banks, particularly Wachovia, with serious consequences. Nevertheless, FDIC Chairman Bair stood behind the decision. "I absolutely do think that was the right decision," she told the FCIC. WAMU was not a well-run institution. She characterized the resolution of WAMU as successful. The FDIC's decision would be hotly debated. Fed General Counsel Scott Alvarez told the FCIC that he agreed with Bair that there should not have been intervention in WAMU. But Treasury officials felt differently. "We were saying that's great, we can all be tough, and we can be so tough that we plunge the financial system into the Great Depression," Treasury Neil Kashkari told the FCIC. "And so I think, in my judgment, that was a mistake. At the time, the economy was in such a perilous state, it was like playing with fire." End of section 134. Section 135 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 20. Wachovia at the front end of the dominoes as other dominoes fell. Wachovia, having bought Golden West, was the largest holder of payment option ARMs, the same product that had helped bring down WAMU and Countrywide. Concerns about Wachovia, then the fourth largest bank holding company, had also been escalating for some time. On September 9, the Merrill analyst Ed Najarian downgraded the company's stock to underperform, pointing to weakness in its option ARM and commercial loan portfolios. On September 11, Wachovia executives met Fed officials to ask for an exemption from rules that limited holding companies' use of insured deposits to meet their liquidity needs. The Fed did not accede. Staff believed that Wachovia's cash position was strong and that the requested relief was a want rather than a need. But they changed their minds after the Lehman bankruptcy, immediately launching daily conference calls to discuss liquidity with Wachovia management. Depositor outflows increased. On September 19, the Fed supported the company's request to use insured deposits to provide liquidity to the holding company. On September 20, a Saturday, Wells Fargo Chairman Richard M. Kovacevic told Robert Steele, Wachovia's CEO and recently a Treasury Undersecretary, that Wells might be interested in acquiring the besieged bank, and the two agreed to speak later in the week. The same day, Fed Governor Kevin Warsh suggested that Steele also talk to Goldman. As a former vice chairman of Goldman, Steele could easily approach the firm, but the ensuing conversations were short. Goldman was not interested. Throughout the following week, it became increasingly clear that Wachovia needed to merge with a stronger financial institution. Then, WAMU's failure in September 25 raised creditor concern about the health of Wachovia, the Fed's Alvarez told the FCIC. The day after the failure of WAMU, Wachovia Bank depositors accelerated the withdrawal of significant amounts from their accounts, Alvarez said. In addition, wholesale funds providers withdrew liquidity support from Wachovia. It appeared likely that Wachovia would soon become unable to fund its operations. Steele said, as the day progressed, some liquidity pressure intensified as financial institutions began declining to conduct normal financing transactions with Wachovia. David Wilson, the Office of the Comptroller of the Currency's lead examiner at Wachovia, agreed. The whole world changed for Wachovia after WAMU's failure, he said. The FDIC's bear had a slightly different view. WAMU's failure was practically a non-event, she told the FCIC. It was below the fold if it was even on the front page, barely a blip given everything else that was going on. The run on Wachovia Bank, the country's fourth largest commercial bank, was a silent run by uninsured depositors and unsecured creditors sitting in front of their computers rather than by depositors standing in lines outside bank doors. By noon on Friday, September 26, creditors were refusing to roll over the bank's short-term funding, including commercial paper and brokered certificates of deposit. The FDIC's John Kirsten testified that Wachovia lost $5.7 billion of deposits and $1.1 billion of commercial paper and repos that day. By the end of the day on Friday, Wachovia told the Fed that worried creditors had asked it to repay roughly half of its long-term debt, $50 billion to $60 billion. Wachovia did not have to pay all these funds from a contractual basis. They had not matured, but would have difficulty borrowing from these lenders going forward, given the reluctance to repay early, Richard Westerkamp, the Richmond Fed's lead examiner at Wachovia, told the FCIC. In one day, the value of Wachovia's 10-year bond fell from 73 cents to 29 cents on the dollar, and the cost of buying protection on $10 million of Wachovia's debt jumped from $571,000 to almost $1,400,000 annually. Wachovia's stock fell 27%, wiping out $8 billion in market value. Comptroller of the Currency John Dugan, whose agency regulated Wachovia's commercial bank subsidiary, sent FDIC Chairman Baer a short and alarming email stating that Wachovia's liquidity was unstable. Wachovia was at the front end of the dominoes as other dominoes fell, Steele told the FCIC. Government officials were not prepared to let Wachovia open for business on Monday, September 29, without a deal in place. Markets were already under considerable strain after the events involving Lehman Brothers, AIG, and WAMU, the Fed's Alvarez told the FCIC. There were fears that the failure of Wachovia would lead investors to doubt the financial strength of other organizations in similar situations, making it harder for those institutions to raise capital. Wells Fargo had already expressed interest in buying Wachovia. By Friday, Citigroup had as well. Wachovia entered into confidentiality agreements with both companies on Friday, and the two suitors immediately began their due diligence investigations. The key question was whether the FDIC would provide assistance in an acquisition. Though Citigroup never considered making a bid that did not presuppose such assistance, Wells Fargo was initially interested in purchasing all of Wachovia without it. FDIC assistance would require the first ever application of the systemic risk exception under FDICIA. Over the weekend, federal officials hurriedly considered the systemic risks if the FDIC did not intervene and if creditors and uninsured depositors suffered losses. The signs for the bank were discouraging. Given the recent withdrawals, the FDIC and OCC predicted in an internal analysis that Wachovia could face up to $115 billion of additional cash outflows the following week, including, most prominently, $42 billion of further deposit outflows, as well as $12 billion from corporate deposit accounts and $30 billion from retail brokerage customers. Yet Wachovia had only $17 billion in cash and cash equivalents. While the FDIC and OCC estimated that the company could use its collateral to raise another $86 billion through the Fed's discount window, the repo market, and the Federal Home Loan Banks, even those efforts would bring the amount on hand to only $103 billion to cover the potential $115 billion outflow. During the weekend, the Fed argued that Wachovia should be saved, with FDIC assistance if necessary. Its analysis focused on the firm's counterparties and other interdependencies with large market participants and stated that asset sales by mutual funds could cause short-term funding markets to virtually shut down. According to supporting analysis by the Richmond Fed, mutual funds held $66 billion of Wachovia debt, which Richmond Fed staff concluded represented significant systemic consequences, and investment banks, already weak and exposed to low levels of confidence, owned $39 billion of Wachovia's $191 billion debt and deposits. These firms were in danger of becoming even more reliant on Federal Reserve support programs such as PTCF to support operations in the event of a Wachovia-led disruption. In addition, Fed staff argued that a Wachovia failure would cause banks to become even less willing to lend to businesses and households. These effects would contribute to weaker economic performance, higher unemployment, and reduced wealth. Secretary Paulsell had recused himself from the decision because of his ties to Steele, but other members of Treasury had vigorously advocated saving Wachovia. White House Chief of Staff Josh Bolten called Bear on Sunday to express support for the systemic risk exception. At about 6 p.m. on Sunday, September 28, Wells Kovacevic told Steele that he wanted more time to review Wachovia's assets, particularly its commercial real estate holdings, and could not make a bid before Monday if there were to be no FDIC assistance. So Wells and Citigroup came to the table with proposals predicated on such assistance. Wells offered to cover the first $2 billion of losses on a pool of $127 billion worth of assets, as well as 80% of subsequent losses if they grew large enough, capping the FDIC's losses at $20 billion. Citigroup wanted the FDIC to cover losses on a different and larger pool of $312 billion worth of assets, but proposed to cover the first $30 billion of losses and an additional $4 billion a year for 3 years, while giving the FDIC $12 billion in Wachovia preferred stock and stock warrants, rights to buy stock at a predetermined price, as compensation. The FDIC would cover any additional losses above $42 billion. FDIC staff expected Wachovia's losses to be between $35 billion and $52 billion. On the basis of that analysis and the particulars of the offers, they estimated that the Wells proposal would cost the FDIC between $5.6 billion and $7.2 billion, whereas the Citigroup proposal would cost the FDIC nothing. Late Sunday, Wachovia submitted its own proposal under which the FDIC would provide assistance directly to the bank so that it could survive as a standalone entity. But the FDIC still hadn't decided to support a systemic risk exception. Its board, which included the heads of the OCC and OTS, met at 6 a.m. on Monday, September 29, to decide Wachovia's fate before the markets opened. FDIC Associate Director Miguel Brown hewed closely to the analysis prepared by the Richmond Fed. Wachovia's failure carried the risk of knocking down too many dominoes in lines stretching in too many directions whose fall would hurt too many people, including American taxpayers. He also raised concerns about potential global implications and reduced confidence in the dollar. Bear remained reluctant to intervene in private financial markets, but ultimately agreed. "Well, I think this is, one option of a lot of not very good options," she said at the meeting. "I have acquiesced in that decision based on the input of my colleagues and the fact the statute gives multiple decision makers a say in the process. I am not completely comfortable with it, but we need to move forward with something clearly, because this institution is in a tenuous situation. To win the approval of Bear and John Rich, the OTS director who served on the FDIC board, Treasury ultimately agreed to take the unusual step of funding all government losses from the proposed transaction. Without this express commitment from Treasury, the FDIC would have been the first to bear losses out of its deposit insurance fund, which then held about $34.6 billion. Normally, help would have come from Treasury only after that fund was depleted. According to the minutes of the meeting, Bear thought it was especially important that Treasury agreed to fund losses given that it has vigorously advocated the transaction. After just 30 minutes, the FDIC board voted to support government assistance. The resolution also identified the winning bidder, Citigroup. It was the fog of war, Bear told the FCIC. The system was highly unstable. Who was going to take the chance that Wachovia would have a depository run on Monday? Wachovia's board quickly voted to accept Citigroup's bid. Wachovia, Citigroup, and the FDIC signed an agreement in principle, and Wachovia and Citigroup executed an exclusivity agreement that prohibited Wachovia from, among other things, negotiating with other potential acquirers. In the midst of the market turmoil, the Federal Open Market Committee met at the end of September 2008 at about the time of the announced Citigroup acquisition of Wachovia and the invocation of the systemic risk exception. The planned merger of two very large institutions led to some concern among FOMC participants that bigger and bigger firms were being created that would be too big to fail, according to a letter from Chairman Bernanke to the FCIC. He added that he shared this concern and voiced my hope that TARP would create options other than mergers for managing problems at large institutions, and that subsequently, through the process of regulatory reform, we might develop good resolution mechanisms and decisively address the issues of financial concentration and too big to fail. Citigroup and Wachovia immediately began working on the deal, even as Wachovia's stock fell 81.6% to $1.84 on September 29, the day that TARP was initially rejected by lawmakers. They faced tremendous pressure from the regulators and the markets to conclude the transaction before the following Monday, but the deal was complicated. Citigroup was not acquiring the holding company, just the bank, and Citigroup wanted to change some of the original terms. Then came a surprise. On Thursday morning, October 2, Wells Fargo returned to the table and made a competing bid to buy all of Wachovia for $7 a share, 7 times Citigroup's bid with no government assistance. There was a great deal of speculation about the timing of Wells Fargo's new proposal, particularly given IRS Notice 2008-83. This administrative ruling, issued just 2 days earlier, allowed an acquiring company to write off the losses of an acquired company immediately rather than spreading them over time. Wells told the SEC that the IRS ruling permitted the bank to reduce taxable income by $3 billion in the first year following the acquisition rather than by $1 billion per year for 3 years. However, Wells said this was itself not a major factor in his decision to bid for Wachovia without direct government assistance. Former Wells chairman Kovacevic told the FCIC that Wells' revised bid reflected additional due diligence, the point he had made to Wachovia's CEO Steele at the time. But the FDIC's Bear said Kovacevic told her at the time that the tax change had been a factor leading to Wells' revised bid. On Thursday, October 2, 3 days after accepting Citigroup's federally assisted offer, Wachovia's board convened an emergency 11 p.m. session to discuss Wells' revised bid. The Wachovia board voted unanimously in favor. At about 3 a.m. Friday, Wachovia Steele, its general counsel Jane Sherburne, and FDIC chairman Bear called Citigroup CEO Vikram Pandit to inform him that Wachovia had signed a definitive merger agreement with Wells. Steele read from prepared notes. Pandit was stunned. He was disappointed. That's an understatement, Steele told the FCIC. Pandit thought Citigroup and Wachovia had already had a deal. After Steele and Sherburne dropped off the phone call, Pandit asked Bear if Citigroup would keep its original loss-sharing agreement to purchase Wachovia if it matched Wells' offers of $7 a share. Bear said no, reasoning that the FDIC was not going to stand in the way of a private deal. Nor was it the role of the agency to help Citigroup in the bidding war. She also told the FCIC that she had concerns about Citigroup's own viability if it acquired Wachovia for that price. In reality, we didn't know how unstable Citigroup was at that point, Chairman Baer said. Here we were selling a troubled institution with a troubled mortgage portfolio to another troubled institution. I think if that deal had gone through, Citigroup would have had to have been bailed out again. Later Friday morning, Wachovia announced the deal with Wells with the blessing of the FDIC. This agreement won't require even a penny from the FDIC, Kovacevic said in the press release. Still added that the deal enables us to keep Wachovia intact and preserve the value of an integrated company without government support. On Monday, October 6, Citigroup filed suit to enjoy Wells Fargo's acquisition of Wachovia, but without success. The Wells Fargo deal would close at midnight on December 31 for $7 per share. IRS Notice 2008-83 was repealed in 2009. The Treasury's Inspector General, who later conducted an investigation of the circumstances of its issuance, reported that the purpose of the notice was to encourage strong banks to acquire weak banks by removing limitations on the use of tax losses. The Inspector General concluded that there was a legitimate argument that the notice might have been an improper change of the tax code by Treasury. The Constitution allows Congress alone to change the tax code. A congressional report estimated that repealing the notice saved about $7 billion of tax revenues over 10 years. However, the Wells controller, Richard Levy, told the FCIC that to date, Wells has not recognized any benefits from the notice because it has not yet had taxable income to offset. End of section 135. Section 136 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 20. TARP Comprehensive Approach. 10 days after the Lehman bankruptcy, the Fed had provided nearly $300 billion to investment banks and commercial banks through the PDCF and TSLF lending facilities in an attempt to quell the storms in the repo markets, and the Fed and Treasury had announced unprecedented programs to support money market funds. By the end of September, the Fed's balance sheet had grown 67% to $1.5 trillion. But the Fed was running out of options. In the end, it could only make collateralized loans to provide liquidity support. It could not replenish financial institutions' capital, which was quickly dissolving. Uncertainty about future losses on bad assets made it difficult for investors to determine which institutions could survive even with all the Fed's new backstops. In short, the financial system was slipping away from its lender of last resort. On Thursday, September 18, the Fed and Treasury proposed what Secretary Paulson called a comprehensive approach to stem the mounting crisis in the financial system by purchasing the toxic mortgage-related assets that were weighing down many banks' balance sheets. In the early hours of Saturday, September 20, as Goldman Sachs and Morgan Stanley were preparing to become bank holding companies, Treasury sent Congress a draft proposal of the legislation for TARP. The modest length of that document, just 3 pages, belied its historical significance. It would give Treasury the authority to spend as much as $700 billion to purchase toxic assets from financial institutions. The initial reaction was not promising. For example, Senate Banking Committee Chairman Christopher Dodd said on Tuesday, "This proposal is stunning and unprecedented in its scope, a lack of detail, I might add." There are very few details on this legislation, Ranking Member Richard Shelby said. Rather than establishing a comprehensive, workable plan for resolving this crisis, I believe this legislation merely codifies Treasury's ad hoc approach. Paulson told the Senate committee on Tuesday, "Of course, we all believe that the very best thing we can do is make sure that the capital markets are open and that lenders are continued to lend. And so that is what this overall program does. It deals with that." Bernanke told the Joint Economic Committee Wednesday, "I think that this is the most significant financial crisis in the post-war period for the United States, and it has in fact a global reach. I think it is extraordinarily important to understand that, as we have seen in many previous examples of different countries and different times, choking up of credit is like taking the lifeblood away from the economy." He told the House Financial Services Committee on the same day, People are saying, Wall Street, what does it have to do with me? That is the way they are thinking about it. Unfortunately, it has a lot to do with them. It will affect their company, it will affect their job, it will affect their economy. That affects their own lives, affects their ability to borrow, and to save for retirement, and so on. By the evening on Sunday, September 28, as bankers and regulators hammered out Wachovia's rescue, congressional negotiators had agreed on the outlines of a deal. Senator Mel Martinez, a former HUD secretary and then a member of the banking committee, told the FCIC about a meeting with Paulson and Bernanke that Sunday. I just remember thinking, Armageddon. The thing that was the most frightening about it is that even with them asking for extraordinary powers, that they were not at all assured that they could prevent the kind of financial disaster that I think really was greater than the Great Depression. And obviously, to a person like myself, I think you think, wow, if these guys that are in the middle of it and hold the titles that they hold believe this is to be as dark as they are painting it, it must be pretty darn dark. Nevertheless, on Monday, September 29, just hours after Citigroup had announced its proposed government-assisted requisition of Wachovia, the House rejected TARP by a vote of 228 to 205. The market's response was immediate. The Dow Jones Industrial Average quickly plunged 778 points, or almost 7%. To broaden the bill's appeal, TARP's supporter made changes, including a temporary increase in the cap on FDIC's deposit insurance coverage from $100,000 to $250,000 per customer account. On Wednesday evening, the Senate voted in favor by a margin of 74 to 25. On Friday, October 3, the House agreed 263 to 171, and President George W. Bush signed the law, which had grown to 169 pages. TARP's stated goal was to restore liquidity and confidence in financial markets by providing authority for the federal government to purchase and insure certain types of troubled assets for the purpose of providing stability to and preventing disruption in the economy and financial system and protecting taxpayers. To provide oversight for the $700 billion program, the legislation established the Congressional Oversight Panel and the Office of the Special Inspector General for the Troubled Asset Relief Program, TARP. But the markets continued to deteriorate. On Monday, October 6, the Dow closed below 10,000 for the first time in 4 years. By the end of the week, it was down almost 1,900 points, or 18% below its peak in October 2007. The spread between the interest rate at which banks lend to one another and interest rates on treasuries, a closely watched indicator of market confidence, hit an all-time high, and the dollar value of outstanding commercial paper issued by both financial and non-financial companies had fallen by $264 billion in the month between Lehman's failure and TARP's enactment. Even firms that had survived the previous disruptions in the commercial paper markets were now feeling the strain. In response, on October 7, the Fed created yet another emergency program, the Commercial Paper Funding Facility, to purchase secured and unsecured commercial paper directly from eligible issuers. This program, which allowed firms to roll over their debt, would be widely used by financial and non-financial firms. The three financial firms that made the greatest use of the program were foreign institutions: UBS, which borrowed a cumulative $72 billion over time, Dixia, $53 billion, and Barclays, $38 billion. Other financial firms included GA Capital, $16 billion, Prudential Funding, $2.4 billion, and Toyota Motor Credit Corporation, $3.6 billion. Non-financial firms that participated included Verizon, $1.5 billion, Harley-Davidson, $2.3 billion, McDonald's, $203 million, and Georgia Transmission, $109 million. Treasury was already rethinking TARP. The best way to structure the program was not obvious. Which toxic assets would qualify? How would the government determine fair prices in an illiquid market? Would firms holding these assets agree to sell them at a fair price if doing so would require them to realize losses? How could the government avoid overpaying? Such problems would take time to solve, and Treasury wanted to bring stability to the deteriorating markets as quickly as possible. The key concern for markets and regulators was that they weren't sure they understood the extent of toxic assets on the balance sheets of financial institutions, so they couldn't be sure which banks were really solvent. The quickest reassurance, then, would be to simply recapitalize the financial sector. The change was allowed under the TARP legislation, which stated that Treasury, in consultation with the Fed, could purchase financial instruments, including stock, if they deemed such purchases necessary to promote financial market stability. However, the new proposal would pose a host of new problems. By injecting capital in these firms, the government would become a major shareholder in the private financial sector. On Sunday, October 12, after agreeing to the terms of the capital injections, Paulson, Bernanke, Baer, Dugan, and Geithner selected a small group of major financial institutions to which they would immediately offer capital: the four largest commercial bank holding companies, Bank of America, Citigroup, JP Morgan, and Wells, the three remaining large investment banks, Goldman and Morgan Stanley, which were now bank holding companies, and Merrill, which Bank of America had agreed to acquire, and two important clearing and settlement banks, BNY Mellon and State Street. Together, these 9 institutions held more than $11 trillion in assets, or about 75% of all assets in U.S. banks. Paulson summoned the firm's chief executives to Washington on Columbus Day, October 13. Along with Bernanke, Baer, Dugan, and Geithner, Paulson explained that Treasury had set aside $250 billion from TARP to purchase equity in financial institutions under the newly formed Capital Purchase Program, CPP. Specifically, Treasury would purchase senior preferred stock that would pay a 5% dividend for the first 5 years. The rate would rise to 9% thereafter to encourage the companies to pay the government back. Firms would also have to issue stock warrants to Treasury and agree to abide by certain standards for executive compensation and corporate governance. The regulators had already decided to allocate half of these funds to the 9 firms assembled that day, $25 billion each to Citigroup, JP Morgan, and Wells, $15 billion to Bank of America, $10 billion each to Merrill, Morgan Stanley, and Goldman, $3 billion to BNY Mellon, and $2 billion to State Street. We didn't want it to look or be like a nationalization of the banking sector, Paulson told the FCIC. For that reason, the capital injections took the form of non-voting stock, and the terms were intended to be attractive. Paulson emphasized the importance of the bank's participation to provide confidence to the system. He told the CEOs, if you don't take the capital and sometime later your regulator tells you that you are undercapitalized, you might not like the terms and you have to come back to me. All 9 firms took the deal. They made a coherent, I thought a cogent argument about responding to this crisis, which, remember, was getting dramatically worse. It wasn't leading to a run on some of the banks, but it was getting worse in the marketplace, JP Morgan Diamond told the FCIC. To further reassure markets that it would not allow the largest financial institutions to fail, the government also announced 2 new FDIC programs the next day. The first temporarily guaranteed certain senior debt for all FDIC-insured institutions and some holding companies. This program was used broadly. For example, Goldman Sachs had $26 billion in debt backed by the FDIC outstanding in January 2009 and $21 billion at the end of 2009, according to public filings. Morgan Stanley had $16 billion at the end of 2008 and $24 billion at the end of 2009. GE Capital, one of the heaviest users of the program, had $35 billion of FDIC-backed debt outstanding at the end of 2008 and $60 billion at the end of 2009. Citigroup had $32 billion of FDIC-guaranteed debt outstanding at the end of 2008 and $65 billion at the end of 2009. JP Morgan Chase had $21 billion outstanding at the end of 2008 and $41 billion at the end of 2009. The second provided deposit insurance to certain non-interest-bearing deposits, like checking accounts, at all insured depository institutions. Because of the risk to taxpayers, the measures required the Fed, the FDIC, and Treasury to declare a systemic risk exception under FDICIA, as they had done 2 weeks earlier to facilitate Citigroup's bid for Wachovia. Later in the week, Treasury opened TARP to qualifying healthy and viable banks, thrifts, and holding companies under the same terms that the first 9 firms had received. The appropriate federal regulator, the Fed, FDIC, OCC, or OTS, would review applications and pass them to Treasury for final approval. The program was intended not only to restore confidence in the banking system, but also to provide banks with sufficient capital to fulfill their responsibilities in the areas of lending, dividend and compensation policies, and foreclosure mitigation. The whole reason for designing the program was so many banks would take it, would have the capital, and that would lead to lending. That was the whole purpose, Paulson told the FCIC. However, there were no specific requirements for those banks to make loans to businesses and households. Right after we announced it, we had critics start saying, "You've got to force them to lend," Paulson said. Although he said that he couldn't see how to do this, he did concede that the program could have been more effective in this regard. The enabling legislation did have provisions affecting the compensation of senior executives and participating firms' ability to pay dividends to shareholders. Over time, these provisions would become more stringent, and the following year, in compliance with another measure in the Act that created TARP, Treasury would create the Office of the Special Master for TARP Executive Compensation to review the appropriateness of compensation packages among TARP recipients. Treasury invested about $188 billion in financial institutions under TARP's Capital Purchase Program by the end of 2008. Ultimately, it would invest $205 billion in 707 financial institutions. In the ensuing months, Treasury would provide much of TARP's remaining $450 billion to specific financial institutions, including AIG, $40 billion plus a $30 billion lending facility, Citigroup, $20 billion plus loss guarantees, and Bank of America, $20 billion. On December 19, it established the Automotive Industry Financing Program, under which it ultimately invested $81 billion of TARP funds to make investments in and loans to automobile manufacturers and auto finance companies, specifically General Motors, GMAC, Chrysler, and Chrysler Financial. On January 12, 2009, President Bush notified Congress that he intended not to access the second half of the $700 billion in TARP funds so that he might ensure that such funds are available early for the new administration. As of September 2010, 2 years after TARP's creation, Treasury had allocated $395 billion of the $700 billion authorized. Of that amount, $204 billion had been repaid, $185 billion remained outstanding, and $3.9 billion in losses had been incurred. About $55 billion of the outstanding funds were in the Capital Purchase Program. Treasury still held large stakes in GM, 61% of common stock, Ali Financial, formerly known as GMAC, 56%, and Chrysler, 9%. Moreover, $47.5 billion of TARP funds remained invested in AIG, in addition to $49.7 billion of loans from the New York Fed and a $26 billion non-TARP equity investment by the New York Fed in 2 of AIG's foreign insurance companies. By December 2010, all 9 companies invited to the initial Columbus Day meeting had fully repaid the government. Of course, TARP was only one of more than 24 emergency programs totaling trillions of dollars put in place during the crisis to stabilize the financial system and to rescue specific firms. Indeed, TARP was not even the largest. Many of these programs are discussed in this and previous chapters. For just some examples, the Fed's TSLF and PDCF programs peaked at $483 billion and $156 billion respectively. Its money market funding peaked at $350 billion in January 2009, and its commercial paper funding facility peaked at $365 billion also in January 2009. When it was introduced, the FDIC's program to guarantee senior debt for all FDIC-insured institutions stood ready to backstop as much as $939 billion in bank debt. The Fed's largest program, announced in November 2008, purchased $1.25 trillion in agency mortgage-backed securities. End of section 136. Section 137 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 20. AIG We needed to stop this sucking chest wound in this patient. AIG would be the first TARP recipient that was not part of the capital purchase program. It still had two big holes to fill, despite the $85 billion loan from the New York Fed. Its securities lending business was underwater despite payments in September and October of $24 billion that the Fed loan had enabled, and it still needed $27 billion to pay credit default swaps (CDS) counterparties despite earlier payments of $35 billion. On November 10, the government announced that it was restructuring the New York Fed loan, and in the process, Treasury would purchase $40 billion in AIG preferred stock. As was done in the capital purchase program, in return for the equity provided, Treasury received stock warrants from AIG and imposed restrictions on dividends and executive compensation. That day, the New York Fed created two off-balance sheet entities to hold AIG's bad assets associated with securities lending, Maiden Lane 2 and CDS, Maiden Lane 3. Over the next month, the New York Fed loaned Maiden Lane 2 $19.8 billion so that it could purchase mortgage-backed securities from AIG's life insurance company subsidiaries. This enabled those subsidiaries to pay back their securities lending counterparties, bringing to $43.7 billion the total payments AIG would make with government help. These payments are listed in Figure 20.4. Maiden Lane 3 was created with a $24.3 billion loan from the New York Fed and an AIG investment of $5 billion supported by the Treasury investment. That money went to buy CDOs from 16 of AIG Financial Products CDS counterparties. The CDOs had a face value of $62.1 billion, which AIG Financial Products had guaranteed through its CDS. Because AIG had already posted $35 billion in collateral to its counterparties, Maiden Lane 3 paid $27.1 billion to those counterparties, providing them with the full face amount of the CDOs in return for the cancellation of their rights under the CDS. A condition of this transaction was that AIG waive its legal claims against those counterparties. These payments are listed in Figure 20.4. Goldman Sachs received $14 billion in payments from Maiden Lane 3 related to the CDS it had purchased from AIG. During the FDIC's January 13, 2010 hearing, Goldman CEO Lloyd Blankfein testified that Goldman Sachs would not have lost any money if AIG had failed because his firm had purchased credit protection to cover the difference between the amount of collateral it demanded from AIG and the amount of collateral paid by AIG. Documents submitted to the FDIC by Goldman after the hearing do show that the firm owned $2.4 billion of credit protection in the form of CDS on AIG, although much of that protection came from financially unstable companies including Citibank, $402.3 million, which itself had to be propped up by the government, and Lehman, $174.8 million, which was bankrupt by the time AIG was rescued. In an FDIC hearing, Goldman CFO David Viniar said that those counterparties had posted collateral. Goldman also argued that the $14 billion of CDS protection that it purchased from AIG was part of Goldman's matched book, meaning that Goldman sold $14 billion in offsetting protection to its own clients. It provided information to the FDIC indicating that the $14 billion received from Maiden Lane 3 was entirely paid to its clients. Without the federal assistance, Goldman would have had to find the $14 billion some other way. Goldman also produced documents to the FDIC that showed it received $3.4 billion from AIG related to credit default swaps on CDOs that were not part of Maiden Lane 3. Of that $3.4 billion, $1.9 billion was received after and thus made possible by the federal bailout of AIG, and most $2.9 billion of the total was for proprietary trades made solely for Goldman's benefit rather than on behalf of a client, largely relating to Goldman's Abacus CDOs. Thus, unlike the $14 billion received from AIG on trades in which Goldman owed the money to its own counterparties, this $2.9 billion was retained by Goldman. That AIG's counterparties did not incur any losses on their investments because AIG, once it was backed by the government, paid claims to CDS counterparties at 100% of face value has been widely criticized. In November 2009, TARP faulted the New York Fed for failing to obtain concessions. The Inspector General said that 7 of the top 8 counterparties had insisted on 100% coverage, and that the New York Fed had agreed because efforts to obtain concessions from all counterparties had little hope of success. TARP was highly critical of the New York Fed's negotiations. From the outset, it found the New York Fed was poorly prepared to assist AIG. To prevent AIG's failure, the New York Fed had hastily agreed to the $85 billion bailout on substantially the same terms that a private sector group had contemplated. TARP blamed the Fed's own negotiating strategy for the outcome, which it described as the transfer of billions of dollars of cash from the government to AIG's counterparties, even though senior policymakers contend that assistance to AIG's counterparties was not a relevant consideration. In June 2010, TARP's Congressional Oversight Panel criticized the AIG bailout for having a poisonous effect on capital markets. The report said that the government's failure to require shared sacrifice among AIG's creditors effectively altered the relationship between the government and the markets, signaling an implicit too-big-to-fail guarantee for certain firms. The report said the New York Fed should have insisted on concessions from counterparties. Treasury and Fed officials countered that concessions would have led to an instant ratings downgrade and precipitated a run on AIG. New York Fed officials told the FCIC that they had very little bargaining power with counterparties who were protected by the terms of their CDS contracts. And after providing a $85 billion loan, the government could not let AIG fail. Counterparties said, "We got the collateral, the contractual rights. You've been rescued by the Fed. Uncle Sam's behind you. Why would we let you out of a contract you agreed to?" New York Fed General Counsel Tom Baxter told the FCIC. And then the question was, should we use our regulatory power to leverage counterparties? From my view, that would have been completely inappropriate, an abuse of power, and not something we were willing to even contemplate. Sarah Dahlgren, who was in charge of the Maiden Lane 3 transaction at the New York Fed, said the government could not have threatened bankruptcy. There was a financial meltdown, she told the FCIC. The credibility of the United States government was on the line. TARP acknowledged that the New York Fed felt ethically restrained from threatening an AIG bankruptcy because it had no actual plans to carry out such a threat, and that it was uncomfortable interfering with the sanctity of the counterparty's contractual rights with AIG, which were certainly valid concerns. Geithner has said he was confident that full reimbursement was absolutely the right decision. "We did it in a way that I believe was not just least cost to the taxpayer, best deal for the taxpayer, but helped avoid much more damage than would have happened without that." New York Fed officials told the FCIC that threats to AIG's survival continued after the $85 billion loan on September 16. If you don't fix the securities lending or the CDOs, AIG would blow through the $85 billion. So we needed to stop this sucking chest wound in this patient, Dahlgren said. It wasn't just AIG, it was the financial markets. It kept getting worse and worse and worse. Baxter told the FCIC that Maiden Lane 3 stopped the hemorrhage from AIG Financial Products, which was paying collateral to counterparties by drawing on the $85 billion government loan. In addition, because Maiden Lane 3 received the CDOs underlying the CDS, as value comes back in those CDOs, that's value that's going to be first used to pay off the Fed loan, the likely outcome of Maiden Lane 3 is that we're going to be paid in full, he said. In total, the Fed and Treasury had made available over $180 billion in assistance to AIG to prevent its failure. As of September 30, 2010, the total outstanding assistance has been reduced to $124.8 billion, primarily through the sale of AIG business units. End of section 137. Section 138 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 20. Citigroup Let the World Know That We Will Not Pull a Lehman. The failed bid for Wachovia reflected badly on Citigroup. Its stock fell 18% on October 3, 2008, the day Wachovia announced that it preferred Wells's offer, and another 43% within a week. Having agreed to do the deal was a recognition on our part that we needed it, Edward Ned Kelly III, Vice Chairman of Citigroup, told the FCIC. And if we needed it and didn't get it, what did that imply for the strength of the firm going forward? Roger Cole, then head of banking supervision at the Federal Reserve Board, saw the failed acquisition as a turning point, the moment when Citi really came under the microscope. It was regarded by the market as an indication of bad management at Citi that they lost the deal, and had it taken away from them by a smarter, more astute Wells Fargo team, Cole told the FCIC. And then here's an organization that doesn't have the core funding, insured deposits, that we were assuming that they would get by that deal. Citigroup's stock rose 18% the day after the Columbus Day announcement that it would receive government capital, but the optimism did not last. 2 days later, Citigroup announced a $2.8 billion net loss for the third quarter, concentrated in subprime and Alt-A mortgages, commercial real estate investments, and structured investment vehicle SIV write-downs. The bank's stock fell 17% in the following week, and by November 12 hit single digits for the first time since 1996. The market's unease was heightened by press speculation that the company's board had lost confidence in senior management, Kelly said. On November 19, the company announced that the value of the SIVs had fallen by $1.1 billion in the month since it had released their quarter earnings. Citigroup was therefore going to bring the remaining $17.4 billion in off-balance sheet SIV assets onto its books. Investors clipped almost another 24% off the value of the stock, its largest single-day drop since the October 1987 stock market crash. 2 days later, the stock closed at $3.77. Credit default swaps on Citigroup reached a steep $500,000 annually to protect $10 million in Citigroup debt against default. According to Kelly, these developments threatened to make perceptions become a reality for the bank. Investors look at those spreads and say, "Is this some place I really want to put my money?" And that's just not in terms of wholesale funding. That's people who also have deposits with us at various points. The firm's various regulators watched the stock price, the daily liquidity, and the CDS spreads with alarm. On Friday, November 21, the United Kingdom's Financial Services Authority, FSA, imposed a $6.4 billion cash lockup to protect Citigroup's London-based broker-dealer. FDIC examiners knew that this action would be very damaging to the bank's liquidity and worried that the FSA or other foreign regulators might impose additional cash requirements in the following week. By the close of business Friday, there was widespread concern that if the U.S. government failed to act, Citigroup might not survive. Its liquidity problems had reached crisis proportions. Among regulators at the FDIC and the Fed, there was no debate. Fed Chairman Bernanke told the FCIC, "We were looking at this firm in the fall of 2008 and saying, Citigroup is not a very strong firm, but it's only one firm and the others are okay," but not recognizing that that's sort of like saying, well, 4 out of your 5 heart ventricles are fine, and the 5th one is lousy. They're all interconnected, they all connect to each other, and therefore, the failure of one brings the others down. The FDIC's Arthur Merton emailed his colleague Michael Kriminger on November 22. Given that the immediate risk is liquidity, The way to address that is by letting current parties know that they will be protected both at the bank and holding company level. The main point is to let the world know that we will not pull a Lehman. Kriminger, a special advisor to the FDIC chairman, agreed. At this stage, it is probably appropriate to be clear and direct that the U.S. government will not allow Citi to fail to meet its obligations. Citigroup's own calculations suggested that a drop in deposits of just 7.2% would wipe out its cash surplus. If the trend of recent withdrawals continued, the company could expect a 2% outflow of deposits per day. Unless Citigroup received a large and immediate injection of funds, its coffers would be empty before the weekend. Meanwhile, Citigroup executives remained convinced that the company was sound and that the market was simply panicking. CEO Pandit argued, "This was not the fundamental situation. It was not about the capital we had, not about the funding we had at that time, but with the stock price where it was, perception becomes reality." All that was needed, Citigroup contended, was for the government to expand access to existing liquidity facilities. People were questioning what everything was worth at that time. There was a flight not just to quality and safety, but almost a flight to certainty. Kelly, then Pandit's advisor, told the FCIC. The FDIC dismissed Citigroup's request that the government simply expand its access to existing liquidity programs, concluding that any incremental liquidity could be quickly eliminated as depositors rushed out the door. Officials also believed the company did not have sufficient high-quality collateral to borrow more under the Fed's mostly collateral-based liquidity programs. In addition to the $25 billion from TARP, Citigroup was already getting by on substantial government support. As of November 21, it had $24.3 billion outstanding under the Fed's collateralized liquidity program and $200 million under the Fed's commercial paper funding facility, and it had borrowed $84 billion from the Federal Home Loan Banks. In December, Citigroup would have a total of $32 billion in senior debt guaranteed by the FDIC under the Debt Guarantee Program. On Sunday, November 23, FDIC staff recommended to its board that a third systemic risk exception be made under FDICIA. As they had done previously, regulators decided that a proposed resolution had to be announced over the weekend to buttress investor confidence before markets opened Monday. The failure of Citigroup would significantly undermine business and household confidence, according to FDIC staff. Regulators were also concerned that the economic effects of a Citigroup failure would undermine the impact of the recently implemented capital purchase program under TARP. Treasury agreed to provide Citigroup with an additional $20 billion in TARP funds in exchange for preferred stock with an 8% dividend. This injection of cash brought the company's TARP TAV to $45 billion. The bank also received $19.5 billion in capital benefits related to its issuance of preferred stock and the government's guarantee of certain assets. Under the guarantee, Citigroup and the government would identify a $306 billion pool of assets around which a protective ring fence would be placed. In effect, this was a loss-sharing agreement between Citigroup and the federal government. There was not a huge amount of science in coming to that $306 billion number, Citigroup's Kelly told the FCIC. He said that the deal was structured to give the market comfort that the catastrophic risk has been taken off the table. When its terms were finalized in January 2009, the guaranteed pool, which contained mainly loans and residential and commercial mortgage-backed securities, was adjusted downward to $301 billion. Citigroup assumed responsibility for the first $39.5 billion in losses under ring-fenced assets. The federal government would assume responsibility for 90% of all losses above that amount. Should these losses actually materialize, Treasury would absorb the first $5 billion using TARP funds, the FDIC would absorb the next $10 billion from the Deposit Insurance Fund, for which it had needed to approve the systemic risk exception, and the Fed would absorb the balance. In return, Citigroup agreed to grant the government $7 billion in preferred stock, as well as warrants that gave the government the option to purchase additional shares. After analyzing the quality of the protected assets, FDIC staff projected that the Deposit Insurance Fund would not incur any losses. Once again, the FDIC board met late on a Sunday to determine the fate of a struggling institution. Brief dissent on the 10 p.m. conference call came from OTS Director John Rich, who questioned why similar relief had not been extended to OTS-supervised thrifts that failed earlier. "There isn't any doubt in my mind that this is a systemic situation," he said, but he added, "In hindsight, I think there had been some systemic situations prior to this one that were not classified as such." The failure of IndyMac pointed the focus to the next weakest institution, which was WAMU, and its failure pointed to Wachovia, and now we're looking at Citi, and I wonder who's next. I hope that all of the regulators, all of us, including Treasury and the Fed, are looking at these situations in a balanced manner, and I fear there has been some selective creativity exercised in the determination of what is systemic and what's not, and what's possible for the government to do and what's not. The FDIC board approved the proposal unanimously. The announcement beat the opening bell, and the markets responded positively. Citigroup's stock price soared almost 58%, closing at $5.95. The ring fence would stay in place until December 2009, at which time Citigroup terminated the government guarantee in tandem with repaying $20 billion in TARP funds. In December 2010, Treasury announced the sale of its final shares of Citigroup's common stock. End of section 138. Section 139 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 20, Bank of America, A Shotgun Wedding. With Citigroup stabilized, the markets would quickly shift focus to the next domino, Bank of America, which had swallowed Countrywide earlier in the year and, on September 15, had announced it was going to take on Merrill Lynch as well. The merger would create the world's largest brokerage and reinforce Bank of America's position as the country's largest depository institution. Given the share prices of the two companies at the time, the transaction was valued at $50 billion. But the deal was not set to close until the first quarter of the following year. In the interim, the companies continued to operate as independent entities pending shareholder and regulatory approval. For that reason, Merrill CEO John Thane and Bank of America CEO Ken Lewis had represented their companies separately at the Columbus Day meeting at Treasury. Treasury would invest the full $25 billion in Bank of America only after the Merrill acquisition was complete. In October, Merrill Lynch reported a net loss for the third quarter of $5.1 billion. In its October 16 earnings press release, Merrill Lynch described write-downs related to its CDO positions and other real estate-related securities and assets affected by the severe market dislocations. Thane told investors on the conference call that Merrill's strategy was to clean house. It now held less than $1 billion in asset-backed security CDOs and no Alt-A positions at all. We're down to $295 million in subprime on our trading books, Thane said. We cut our non-U.S. mortgage business positions in half. The Fed approved the merger on November 26, noting that both Bank of America and Merrill were well capitalized and would remain so after the merger, and that Bank of America has sufficient financial resources to effect the proposal. Shareholders of both companies approved the acquisition on December 5. But then Bank of America executives began to have second thoughts, Lewis told the FCIC. In mid-November, Merrill Lynch's after-tax losses for the fourth quarter had been projected to reach about $5 billion. The projection grew to about $7 billion by December 3, $9 billion by December 9, and $12 billion by December 14. Lewis said he learned only on December 14 that Merrill's losses had accelerated pretty dramatically. Lewis attributed the losses to a much higher deterioration of the assets we identified than we had expected going into the fourth quarter. In the January conference call, Lewis and CFO Joe Price told investors that the bank had not been aware of the extent of Merrill's fourth quarter losses at the time of the shareholder vote. It wasn't an issue of not identifying the assets, Ken Lewis said. It was that we did not expect the significant deterioration which happened in mid to late December, that we saw. Merrill's Thane contests that version of events. He told the FCIC that Merrill provided daily profit and loss reports to Bank of America, and the bank executives should have known about losses as they occurred. The SEC later brought an enforcement action against Bank of America, charging the company with failing to disclose about $9.5 billion of known and expected Merrill Lynch losses before the December 5 shareholder vote. According to the SEC's complaint, these insufficient disclosures deprived shareholders of material information that was critical to their ability to fairly evaluate the merger. In February 2010, Bank of America would pay $150 million to settle the SEC's action. On December 17, Lewis called Treasury Secretary Paulson to inform him that Bank of America was considering invoking the Material Adverse Charge (MAC) clause of the merger agreement, which would allow the company to exit or renegotiate the terms of the acquisition. The severity of the losses were high enough that we should at least consider a MAC, Lewis told the FCIC. The acceleration, we thought, was beyond what should be happening. And then, secondly, you had a major hole being created in the capital base with the losses that dramatically reduced Merrill Lynch's equity. That afternoon, Lewis flew from North Carolina to Washington to meet at the Fed with Paulson and Fed Chairman Bernanke. The two asked Lewis to stand down on invoking the clause while they considered the situation. Paulson and Bernanke concluded that an attempt by Bank of America to invoke the MAC clause was not a legally reasonable option. They believed that Bank of America would be ultimately unsuccessful in the legal action, and the attendant litigation would likely result in Bank of America still being contractually bound to acquire a considerably weaker Merrill Lynch. Moreover, Bernanke thought the market would lose faith in Bank of America's management, given that review, preparation, and due diligence had been ongoing for 3 months. The two officials also believed that invoking the clause would lead to a broader systemic crisis that would result in further deterioration at the two companies. Neither Merrill nor its CEO John Thane was informed of these deliberations at Bank of America. Lewis told the FCIC that he didn't contact Merrill Lynch about this situation because he didn't want to create an adversarial relationship if it could be avoided. When Thane later found out that Bank of America had contemplated putting the MAC clause into effect, he was skeptical about its chances of success. One of the things we negotiated very heavily was the Material Adverse Charge clause. It specifically excluded market moves, and pretty much nothing happened to Merrill in the fourth quarter other than the market move. On Sunday, December 21, Paulson informed Lewis that invoking the clause would demonstrate a colossal loss of judgment by the company. Paulson reminded Lewis that the Fed, as its regulator, had the legal authority to replace Bank of America's management and board if they embarked on a destructive strategy that had no reasonable legal basis. Bernanke later told his general counsel, "Though we did not order Lewis to go forward, we did indicate that we believed that going forward with the clause would be detrimental to the health, safety, and soundness of his company." Congressman Adolphus Towns of New York would later refer to the Bank of America and Merrill Lynch merger as a shotgun wedding. Regulators began to discuss a rescue package similar to the one for Citigroup, including preferred shares and an asset pool similar to Citigroup's ring fence. The staff's analysis was essentially the same as it had been for Citigroup. Meanwhile, Lewis decided to de-escalate the situation, explaining that when the Secretary of the Treasury and the Chairman of the Fed say that invoking the MAC would cause systemic risk, then it obviously gives you pause. At a board meeting on December 22, Lewis told his board that the Fed and Treasury believed that a failed acquisition would pose systemic risk and would lead to removal of management at the board at the insistence of the government, and that the government would provide assistance to protect Bank of America against the adverse impact of certain Merrill Lynch assets, although such assistance could not be provided in time for the merger's close on January 1, 2009. The board decided not to exercise the MAC and to proceed as planned, with the understanding that the government's assistance would be fully documented by the time fourth-quarter earnings were announced in mid-January. Obviously, if the MAC clause actually would cause systemic risk to the financial system, then that's not good for Bank of America, Lewis told the FCIC, which is finally the conclusion that I came to and the board came to. The merger was completed on January 1, 2009, with no hint of government assistance. By the time the acquisition became official, the purchase price of $50 billion announced in September had fallen to $19 billion, thanks to the decline in the stock prices of the two companies over the preceding 3 months. On January 9, Bank of America received the $10 billion in capital from TARP that had been allocated to Merrill Lynch, adding to the $15 billion it had received in October. In addition to those TARP investments, at the end of 2008, Bank of America and Merrill Lynch had borrowed $88 billion under the Fed's collateralized program, $60 billion through the Term Auction Facility, and $28 billion through the PDCF and TSLF, and $15 billion under the Fed's Commercial Paper Funding Facility. During the previous fall, Bank of America's legacy securities arm had borrowed as much as $17 billion under TSLF and as much as $11 billion under PDCF. Also, at the end of 2008, the bank had issued $31.7 billion in senior debt guaranteed by the FDIC under the Debt Guarantee Program, and it had borrowed $92 billion from the Federal Home Loan Banks. Yet despite Bank of America's recourse to these many supports, the regulators worried that it would experience liquidity problems if the fourth-quarter earnings were weak. The regulators wanted to be ready to announce the details of government support in conjunction with Bank of America's disclosure of its fourth-quarter performance. They had been working on the details of that assistance since late December and had reason to be cautious. For example, 67% of Bank of America's repo and securities lending funding, a total of $384 billion, was rolled over every night, and Merrill's legacy businesses also funded $144 billion overnight. A one-notch downgrade in the new Bank of America's credit rating would contractually obligate the posting of $10 billion in additional collateral. A two-notch downgrade would require another $3 billion. Although the company remained adequately capitalized from a regulatory standpoint, its tangible common equity was low and, given the stressed market conditions, was likely to fall under 2%. Low levels of tangible common equity, the most basic measure of capital, worried the market, which seemed to think that in the midst of the crisis, regulatory measures of capital were not informative. On January 15, the Federal Reserve and the FDIC, after intense discussions, agreed on the terms. Treasury would use TARP funds to purchase $20 billion of Bank of America preferred stock with an 8% dividend. The bank and the three pertinent government agencies, Treasury, the Fed, and the FDIC, designated an asset pool of $118 billion, primarily from the former Merrill Lynch portfolio, whose losses the four entities would share. The pool was analogous to Citigroup's ring fence. In this case, Bank of America would be responsible for the first $10 billion in losses on the pool, and the government would cover 90% of any additional losses. Should the government losses materialize, Treasury would cover 75%, up to a limit of $7.5 billion, and the FDIC 25%, up to a limit of $2.5 billion. 90% of any additional losses would be covered by the Fed. The FDIC board had a conference call at 10 p.m. on Thursday, January 15, and voted for the fourth time unanimously to approve a systemic risk exception under FDICIA. The next morning, January 16, Bank of America disclosed that Merrill Lynch had recorded a $15.3 billion net loss on real estate-related write-downs and charges. It also announced the $20 billion TARP capital investment and $118 billion ring fence that the government had provided. Despite the government's support, Bank of America's stock closed down almost 14% from the day before. Over the next several months, Bank of America worked with its regulators to identify the assets that would be included in the asset pool. Then, on May 6, Bank of America asked to exit the ring fence deal, explaining that the company had determined that losses would not exceed the $10 billion that Bank of America was required to cover in its first loss position. Although the company was eventually allowed to terminate the deal, it was compelled to compensate the government for the benefits it had received from the market's perception that the government would insure its assets. On September 21, Bank of America agreed to pay a $425 million termination fee, $276 million to Treasury, $57 million to the Fed, and $92 million to the FDIC. End of section 139. Section 140 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Commission conclusions on Chapter 20. The Commission concludes that, as massive losses spread throughout the financial system in the fall of 2008, many institutions failed or would have failed but for government bailouts. As panic gripped the market, credit markets seized up, trading ground to a halt, and the stock market plunged. Lack of transparency contributed greatly to the crisis. The exposures of financial institutions to risky mortgage assets and other potential losses were unknown to market participants, and indeed many firms did not know their own exposures. The scale and nature of over-the-counter OTC derivatives market created significant systemic risk throughout the financial system and helped fuel the panic in the fall of 2008. Millions of contracts in this opaque and deregulated market created interconnections among a vast web of financial institutions through counterparty credit risk, thus exposing the system to a contagion of spreading losses and defaults. Enormous positions concentrated in the hands of systemically significant institutions that were major OTC derivatives dealers added to uncertainty in the market. The bank runs on these institutions included runs on their derivatives operations through novations, collateral demands, and refusals to act as counterparties. A series of actions, inactions, and misjudgments left the country with stark and painful alternatives: either risk the total collapse of our financial system or spend trillions of taxpayer dollars to stabilize the system and prevent catastrophic damage to the economy. In the process, the government rescued a number of financial institutions deemed too big to fail, so large and interconnected with other financial institutions or so important in one or more financial markets that their failure would have caused losses and failures to spread to other institutions. The government also provided substantial financial assistance to non-financial corporations. As a result of the rescues and consolidation of financial institutions through failures and mergers during the crisis, the U.S. financial sector is now more concentrated than ever in the hands of a very few large, systemically significant institutions. This concentration places greater responsibility on regulators for effective oversight of these institutions. End of section 140.
Section 141 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 21, The Economic Fallout, Intro. Panic and uncertainty in the financial system plunged the nation into the longest and deepest recession in generations. The credit squeeze in financial markets cascaded throughout the economy. In testifying to the Commission, Bank of America CEO Brian Moynihan described the impact of the financial crisis on the economy. Over the course of the crisis, we, as an industry, caused a lot of damage. Never has it been clearer how poor business judgments we have made have affected Main Street. Indeed, Main Street felt the tremors as the upheaval in the financial system rumbled through the U.S. economy. $17 trillion in household wealth evaporated within 21 months, and reported unemployment hit 10.1% at its peak in October 2009. As the housing bubble deflated, families that had counted on rising housing values for cash and retirement security became anchored to mortgages that exceeded the declining value of their homes. They ratcheted back on spending, cumulatively putting the brakes on economic growth, the classic paradox of thrift described almost a century ago by John Maynard Keynes. In the aftermath of the panic, when credit was severely tightened, if not frozen, for financial institutions, companies found that cheap and easy credit was gone for them too. It was tougher to borrow to meet payrolls and to expand inventories. Businesses that had neither credit nor customers trimmed costs and laid off employees. Still today, credit availability is tighter than it was before the crisis. Without jobs, people could no longer afford their house payments. Yet even if moving could improve their job prospects, they were stuck with houses they could not sell. Millions of families entered foreclosure and millions more fell behind on their mortgage payments. Others simply walked away from their devalued properties, returning the keys to the banks, an action that would destroy families' credit for years. The surge in foreclosed and abandoned properties dragged home prices down still more, depressing the value of surrounding real estate in neighborhoods across the country. Even those who stayed current on their mortgages found themselves whirled into the storm. Towns that over several years had come to expect and rely on the housing boom now saw jobs and tax revenue vanish. As their resources dwindled, these communities found themselves saddled with the municipal costs they had taken on in part to expand services for a growing population. Sinking housing prices upended local budgets that relied on property taxes. Problems associated with abandoned homes required more police and fire protection. At FCIC hearings around the country, regional experts testified that the local impact of the crisis has been severe. From 2007 to 2009, for example, banks in Sacramento had stopped lending and potential borrowers retreated, said Clarence Williams, president of the California Capital Financial Development Corporation. Bankers still complained to him not only that demand from borrowers has fallen off, but also that they may be subject to increased regulatory scrutiny if they do not make new loans. In September 2010, when the FCIC held its Sacramento hearing, that region's once robust construction industry was still languishing. Unless we begin to turn around demand, unless we begin to turn around the business situation, the employment is not going to increase here in the Sacramento area, and housing is critical to it. It is a vicious cycle, Williams testified. The effects of the financial crisis have been felt in individual U.S. households and businesses, big and small, and around the world. Policymakers on the state, national, and global levels are still grappling with the aftermath, as are the homeowners and lenders now dealing with the complications that entangle the foreclosure process. End of section 141. Section 142 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 21. Households. I'm not eating, I'm not sleeping. The recession officially began in December 2007. By many measures, its effects on the job market were the worst on record, as reflected in the speed and breadth of the falloff in jobs, the rise of the ranks of underemployed workers, and the long stretches of time that millions of Americans were and still are surviving without work. The economy shed 3.6 million jobs in 2008, the largest annual plunge since record-keeping began in 1940. By December 2009, the United States had lost another 4.7 million jobs. Through November 2010, the economy had regained nearly 1 million jobs, putting only a small dent in the declines. The underemployment rate, the total of unemployed workers who are actively looking for jobs, those with part-time work who would prefer full-time jobs, and those who need jobs but say they are too discouraged to search, increased from 8.8% in December 2007 to 13.7% in December 2008, reaching 17.4% in October 2009. This was the highest level since calculations for that labor category were first made in 1994. As of November 2010, the underemployment rate stood at 17%. The average length of time individuals spent unemployed spiked from 9.4 weeks in June 2008 to 18.2 weeks in June 2009 and 25.5 weeks in June 2010. 59% of all job seekers, according to the most recent government statistics, searched for work for at least 15 weeks. The labor market is daunting across the board, but it is especially grim among African American workers, whose jobless rate is 16%, about 6 percentage points above the national average. Workers between the ages of 16 and 19 years old at 24.6%, and Hispanics at 13.2%. And the impact has been especially severe in certain professions. Unemployment in construction, for instance, climbed to an average of 19.1% in 2009, and averaged 20.6% during the first 11 months of 2010. Real gross domestic product, the nation's measure of economic output adjusted for inflation, fell at an annual rate of 4% in the third quarter of 2008 and 6.8% in the fourth quarter. After falling again in the first half of 2009 and then modestly growing in the second half, average GDP for the year was 2.6% lower than in 2008, the biggest drop since 1946. Looking at the labor market, Edward Lazier, chairman of President George W. Bush's Council of Economic Advisers during the crisis, told the commission that the financial crisis was linked with today's economic problems. I think most of it had to do with investment. Panic in financial markets and tightness in financial markets that persisted through 2009 prevented firms from investing in the way that they otherwise would, and I think that slows the rehiring of workers and still continues to be a problem in labor markets. In June 2009, the nation officially emerged out of the recession that had begun 18 months earlier. The good news still had not reached many of the 26.2 million Americans who were out of work, who could not find full-time work or who had stopped looking for work as of November 2010. Jeannie McDermott of Bakersfield told the FCIC she started a business refilling printer ink cartridges, but in a tight economy she didn't earn enough to make a living. She said she had been searching for a full-time job since 2008. Households suffered the impact of the financial crisis not only in the job market but also in their net worth and their access to credit. Of the $17 trillion lost from 2007 to the first quarter of 2009 in household net wealth, the difference between what households own and what they owe, about $5.6 trillion was due to declining house prices, with much of the remainder due to the declining value of financial assets. As a point of reference, GDP in 2008 was $14.4 trillion, and as a separate point, the amount of wealth lost in the dot-com crash early in the decade was $6.5 trillion. With far fewer repercussions for the economy as a whole. The painful drop in real estate and financial asset values followed a $6.8 trillion run-up in household debt from 2000 to 2007. Aided by the gains in home prices and, to a lesser degree, stock prices, households' net wealth had reached a peak of $66 trillion in the second quarter of 2007. The collapse of the housing and stock markets erased much of the gains from the run-up, while household debt remained near historic highs, exceeding even the levels of 2006. As of the third quarter of 2010, despite firmer stock and housing prices and a decline in household borrowing, household net worth totaled $54.9 trillion, a 16.5% drop-off from its pinnacle just 3 years earlier. See Figure 21.1. Nationwide, home prices dropped 32% from their peak in 2006 to their low point in early 2009. The home ownership rate declined from its peak of 69.2% in 2004 to 66.9% as of the fall of 2010. Because so many American households own homes and because for most homeowners their housing represents their single most important asset, these declines have been especially debilitating. Borrowing via home equity loans or cash-out refinancing has fallen sharply. At an FCIC hearing in Bakersfield, California, Marie Vassell explained how her family had relocated 40 miles into the mountains to a rental house to help her husband's fragile health. Their old home was put up for sale and languished on the market, losing value. Eventually, she and her husband found buyers willing to take their house in a short sale, that is, a sale at a price less than the balance of the mortgage. But because the lender was acting slowly to approve that deal, they risked losing the sale and then going into foreclosure. To top this all off, Vassell told commissioners, "My husband is in the position of possibly losing his job. So not only do I have a house that I don't know what's happening to, I don't know if he's going to have a job come December. This is more than I can handle. I'm not eating, I'm not sleeping." Serious mortgage delinquencies, payments that are late 90 days or more, or homes in the foreclosure process have spread since the crisis. Among regions, the eastern states in the Midwest, Ohio, Indiana, Illinois, Wisconsin, and Michigan, had the highest delinquency rate, topping 5% in 2007. By fall 2010, this rate had risen to 9.2%. Other regions also endured high rates, especially the so-called sand states, where the housing crisis was the worst. The third quarter 2010 serious delinquency rate for Florida was 19.5%, Nevada 17.8%, Arizona 10.8%, and California 10.3%. The data company CoreLogic identified the 25 housing markets with the worst records of distressed sales, which include short sales and sales of foreclosed properties. Las Vegas led the list in mid-2010, with distressed sales counting for more than 60% of all home sales. The state was overbuilt, and some 100,000 jobs were predicted on a level of growth and consumer spending that seemed to evaporate almost overnight. Jeremy Aguinaro, an economic and marketing analyst who follows the Nevada economy, testified to the commission. The performance of the stock market in the wake of the crisis also reduced wealth. The Standard & Poor's 500 index fell by a third in 2008, the largest single-year decline since 1974, as big institutional investors moved to Treasury securities and other investments that they perceived as safe. Individuals felt these effects not only in their current budgets but also in their prospects for retirement. By one calculation, assets in retirement accounts such as 401ks lost $2.8 trillion, or about a third of their value, between September 2007 and December 2008. While the stock market has recovered somewhat, the S&P 500 as of December 31, 2010 was still about 13% below where it was at the start of 2008. Similarly, stock prices worldwide plummeted more than 40% in 2008, but rebounded by 24% in 2009, according to the MSCI World Index Stock Fund, which represents a collection of 1,500 global stocks. The financial market fallout jeopardized some public pension plans, many of which were already troubled before the crisis. In Colorado, state budget officials warned that losses of $11 billion unaddressed could cause the Public Employees Retirement Association plan, which covers 450,000 public workers and teachers, to go bust in 2 decades. The state cut retiree benefits to adjust for the losses. Montana's public pension funds lost $2 billion, or a fourth of their value, in the 6 months following the 2008 downturn, in part because of investments in complex Wall Street securities. Even before the fall of 2008, consumer confidence had been on a downward slope for months. The Conference Board reported in May 2008 that its measure of consumer confidence fell to the lowest point since late 1992. By early 2009, confidence had plummeted to a new low. It has recovered somewhat since then, but has remained stubbornly bleak. We find nobody willing to make a decision, nobody willing to take a chance because of the uncertainty in the economic environment, and that goes for both the state and the federal level. The commercial real estate developer and appraiser Gregory Bynum testified at the FCIC's Bakerfield hearing. Influenced by the dramatic loss in wealth and by job insecurity, households have cut back on debt. Total credit card debt expanded every year for 2 decades until it peaked at $989 billion at the end of 2008. Almost 2 years later, that total had fallen 19% to $802 billion. The actions of banks have also played an important role. Since 2008, they have tightened lending standards, reduced lines of credit on credit cards, and increased fees and interest rates. In the third quarter of 2008, 67% of banks imposed standards on credit cards that were tighter than those in place in the previous quarter. In the fourth quarter, 59% did so, meaning that many banks tightened again. In fact, a significant number of banks tightened credit card standards quarter after quarter until the summer of 2009. Only in the latest surveys have even a small numbers of banks begun to loosen them. Faced with financial difficulties, over 1.4 million households declared bankruptcy in 2009, up from approximately 1.1 million in 2008. Together, the decline in households' financial resources, banks' tightening of lending standards, and consumers' lack of confidence have led to large cuts in spending. Consumer spending, which in the United States makes up more than 2/3 of GDP, fell at an annual rate of roughly 3.5% in the second half of 2008, and then fell again in the first half of 2009. Gains since then have been modest. Spending on cars and trucks fell by an extraordinary 40% between the end of 2007 and the spring of 2009, in part because consumer financing was less available as well as because of job and wage losses. End of section 142. Section 143 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 21. Businesses Squirrels Storing Nuts. When the financial panic hit in September 2008, business financing dried up. Firms that could roll over their commercial paper faced higher interest rates and shorter terms. Those that could not roll over their paper relied on old-fashioned financing, bank loans, or used their own cash reserves. Large firms, one analyst said at the time, turned to their cash balances like squirrels storing nuts. Jeff Agosta, an executive at Devon Energy Corporation, told the FCIC that had the government not supported the commercial paper market, we would have been eating grasshoppers and living in tents. Things could have been that bad. While his expression was hyperbolic, the fear was very real. The lack of credit and the sharp drop in demand took its toll on businesses. In 2006, just under 20,000 U.S. companies filed for bankruptcy protection. That figure more than tripled to nearly 61,000 in 2009. Firms' long-term plans suddenly had to be reevaluated. The effects of those decisions persist, even though credit markets have recovered somewhat. As for the banks, by mid-2007 they had begun to restrict access to credit even for large and medium-sized businesses. The Federal Open Market Committee noted this tightening when it announced on September 18, 2007, that it was cutting the federal funds rate. After the Lehman bankruptcy, companies such as Gannett Corporation, Fairpoint Communications, and Duke Energy drew down their existing lines of credit because they were worried about getting shut out of credit markets. Without access to credit, with cash reserves dwindling, and with uncertainty about the economy high, corporations laid off workers or cut their investments, inhibiting growth and reducing their potential for improving productivity. A survey of chief financial officers found that 57% of U.S. companies were somewhat or very affected by credit constraints, leading to decisions to make cuts in capital investment, technology, and elsewhere. News headlines chronicled the problems. Scarce capital forced mid-sized firms to pare back investments and shutter offices, while industrial companies including Caterpillar, Corning, and John Deere, pharmaceutical companies such as Merck and Wyeth, and tech companies alike laid off employees as the recession took hold. Some businesses struggled to cover payrolls and the financing of inventory. The introduction in October 2008 of the Commercial Paper Funding Facility, under which the Federal Reserve loaned money to non-financial entities, enabled the commercial paper market to resume functioning at more normal rates and terms. But even with the central bank's help, nearly 70% of banks tightened credit standards and lending in the fourth quarter of 2008. And small businesses particularly felt the squeeze. Because they employ nearly 40% of the country's private sector workforce, loans to small businesses are especially vital to our economy, Federal Reserve Board Governor Elizabeth Duke told Congress early in 2010. Unlike the larger firms, which had come to rely on capital markets for borrowing, these companies had generally obtained their credit from traditional banks, other financial institutions, non-financial companies, or personal borrowing by owners. The financial crisis disrupted all these sources, making credit more scarce and more expensive. In a survey of small businesses by the National Federation of Independent Business in 2009, 14% of respondents called credit harder to get. That figure compares with 9% in 2008 and a previous peak and around 11% during the credit crunch of 1991. Fed Chairman Ben Bernanke said in a July 2010 speech that getting a small business loan was still very difficult. He also noted that banks' loans to small businesses had dropped from more than $710 billion in the second quarter of 2008 to less than $670 billion in the first quarter of 2010. Another factor, hesitancy to take on more debt in an anemic economy, is certainly behind some of the statistics tracking lending to small businesses. Speaking on behalf of the Independent Community Bankers of America, C.R. Cloutier, president and CEO of Mid-South Bank in Lafayette, Louisiana, told the FCIC, "Community banks are willing to lend. That's how banks generate a return and survive. However, quality loan demand is down. I can tell you from my own bank's experience, customers are scared about the economic climate and are not borrowing. Credit is available, but businesses are not demanding it." Still, creditworthy borrowers seeking loans face tighter credit from banks than they did before the crisis, surveys and anecdotal evidence suggest. Historically, banks charged a 2% point premium over their funding costs on business loans, but that premium had hit 3 points by year-end 2008 and had continued to rise in 2009, raising the costs of borrowing. Small businesses' access to credit also declined when the housing market collapsed. During the boom, many business owners had tapped the rising equity in their homes, taking out low-interest home equity loans. 17% of small employers with a mortgage refinanced it specifically to capitalize their businesses. As housing prices declined, their ability to use this option was reduced or blocked altogether by the lenders. Jerry Jost told the FCIC he borrowed against his home to help his daughter start a bridal dress business in Bakersfield several years ago. When the economy collapsed, Jost lost his once profitable construction business, and his daughter's business languished. The Jost family has exhausted its life savings while struggling to find steady work and reliable incomes. The standards for credit card loans, another source of financing for small businesses, also became more stringent. In the Fed's April 2010 Senior Loan Officer Survey, a majority of banks indicated that their standards for approving credit card accounts for small businesses were tighter than the longer-run average level that prevailed before the crisis. Banks had continued to tighten their terms on business credit card loans to small businesses for both new and existing accounts since the end of 2009. But the July 2010 update of the Fed survey showed the first positive signs since the end of 2006 that banks were easing up on underwriting standards for small businesses. In an effort to assist small business lenders, the Federal Reserve in March 2009 created the Term Asset-Backed Securities Loan Facility, TALF, a program to aid securitization of loans, including auto loans, student loans, and small business loans. Another federal effort aimed at improving small businesses' access to credit was guidance in February 2010 from the Federal Reserve and other regulators, advising banks to try to meet the credit needs of creditworthy small business borrowers, with the assurances that government supervisors would not hinder those efforts. Yet the prevailing headwinds have been difficult to overcome. Without access to credit, many small businesses that had depleted their cash reserves had trouble paying bills, and bankruptcies and loan defaults rose. Defaults on small business loans increased to 12% in 2008 from 8% in 2007. Overall, the current state of the small business sector is a critical factor in the struggling labor market. Ailing small businesses have laid people off in large numbers, and stronger small businesses are not hiring additional workers. Independent finance companies, which had often funded themselves by issuing commercial paper, were constrained as well. The business finance company Citigroup Inc. was one such firm. Even $2.3 billion in additional capital support from the Federal Troubled Asset Relief Program, TARP program, did not save CIT from filing for bankruptcy protection in November 2009. Still, some active lenders to smaller businesses, such as GE Capital, a commercial lender with a focus on middle-market customers, were able to continue to offer financing. GE Capital's commercial paper borrowing fared better than others. Nonetheless, the terms of the company's borrowing did worsen. In 2008, it registered to borrow up to $98 billion in commercial paper through one government program and issued $13.4 billion in long-term debt and $21.8 billion in commercial paper under another program. That GE Capital had trimmed commercial paper before the crisis to less than 10% of its total debt, or about $46 billion, also softened the effects of the crisis on the company. A decision was made that it would be prudent for us to reduce our reliance on the commercial paper market, and we did, Mark Barber, the deputy treasurer of GE Company and GE Capital, told the commission. The firm put more than $60 billion in cash on its balance sheet, with $52 billion in backup bank lines of credit if needed. The decline in global trade also hurt the U.S. economy as well as economies across the world. As the financial crisis peaked in Europe and the United States, exports collapsed in nearly every major trading country. The decline in exports shaved more than 3 percentage points off GDP growth in the third and fourth quarters of 2008. Recently, exports have begun to recover, and as of the fall of 2010, they are back near pre-crisis levels. End of section 143. Section 144 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 21, Commercial Real Estate. Nothing's Moving. Commercial real estate, offices, stores, warehouses, also took a pounding, an indicator both of the sector's reliance on the lending markets, which were impaired by the crisis, and of its role as a barometer of business activity. Companies do not need more space if they go out of business, lay off workers, or decide not to expand. Weak demand, in turn, lowers rents and forces landlords to give their big tenants incentives to stay put. One example, 2 huge real estate brokerages with headquarters in New York City received 9 months free rent for signing leases in 2008 and 2009. In fall 2010, commercial vacancy rates were still sky high, with 20% of all office space unoccupied, and the actual rate is probably much higher because layoffs create shadow vacancies, a couple of desks here, part of a floor there, that tenants must fill before demand picks back up. In the absence of demand, banks remain unwilling to lend to all but the safest projects involving the most creditworthy developers that have pre-committed tenants. Banks are neither financing nor are they dumping their bad properties, creating a logjam, one developer told a National Association of Realtors survey. Nothing's moving. In Nevada, where tourism and construction once fed the labor force, commercial property took a huge hit. Office vacancies in Las Vegas are now hovering around 24%, compared with their low of 8% midway through 2005. Vacancies in retail commercial space in Las Vegas topped 10% compared with historical vacancy rates of 3% to 4%. The economic downturn tugged national brand retailers into bankruptcy, emptying out the anchor retail space in Nevada's malls and shopping centers. As demand for vacant property fell, land values in and around Las Vegas plummeted. Because lenders were still reluctant, few developers nationally could afford to build or buy right into the fall of 2010. Lehman's bankruptcy meant that Monday Properties came up short in its efforts to build a $300 million, 35-story glass office tower in Arlington, Virginia, across the river from Washington, D.C. Potential tenants wanted to know if the developer had financing. Potential lenders wanted to know if it had tenants. It's a bit of a cart and horse situation, said CEO Anthony Weistreich, who in October 2010 took the big risk of starting construction on the building without signed tenants or permanent financing. The collapse of teetering financial institutions put commercial real estate developers and commercial landlords in binds when overextended banks suddenly pulled out of commercial construction loans. And when banks failed and were taken over by the Federal Deposit Insurance Commission, the commercial landlords overnight lost major bank tenants and the long-term leases that went with them. In California, at least 35 banks have failed since 2003. Almost half of commercial real estate loans were underwater as of February 2010, meaning the loans were larger than the market value of the property. Commercial real estate loans are especially concentrated among the holdings of community and regional banks. Some commercial mortgages were also securitized, and by August 2010, the delinquency rate on these packaged mortgages neared 9%, the highest in the history of the industry and an ominous sign for real estate a full 2 years after the height of the financial storm. At the end of 2008, the default rate had been 1.6%. Near the end of 2010, it was not at all clear when or even if the commercial real estate market had hit bottom. Green Street Advisors of Newport Beach, California, which tracks real estate investment trusts, believed that it had reached its nadir in mid-2009. About half of the decline between 2007 and 2009 has been recovered, according to Mike Kirby, Green Street's director of research. Nevertheless, Kirby added, values remain roughly 20% shy of their peak. That's one perspective. On the other side, Moody's Investors Service, whose real commercial property price index tracks sales of commercial buildings, says it is too early to make a call. Moody's detected some signs of a pickup in the spring and fall of 2010, and Managing Director Nick Levity said, "We expect commercial real estate prices to remain choppy until transaction volumes pick up. The largest commercial real estate loan losses are projected for 2011 and beyond, according to a report issued by the Congressional Oversight Panel. And looking forward, nearly $700 billion in commercial real estate debt will come due from 2011 through 2013. End of section 144. Section 145 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 21, Government, States Struggled to Close Shortfalls. State and local government finances. The recession devastated not only many companies and their workers, but also state and local governments that saw their tax revenue fall, just when people who had lost their jobs or were in bankruptcy or foreclosure proceedings were demanding more services. Those services included Medicaid, unemployment compensation, and welfare, in addition to local assistance for mental health care, for children, and for the homeless. At least 46 states struggled to close shortfalls when adopting budgets for the current fiscal year, recently reported the Center on Budget and Policy Priorities, a Washington think tank. A critical aspect of our situation in Sacramento and throughout the state is that these increased demands for services are occurring at a time that resources are being dramatically reduced. Bruce Wagstaff, the agency administrator with Sacramento's Countywide Services Agency, explained to the commission. Unlike the federal government, almost every state is constitutionally required to produce a balanced budget, so running a deficit is not an option. Sujit Kanaretna, a senior fiscal analyst with the Council of State Governments, told the FCIC that the budget shortfalls facing the states are staggering numbers. It's not just the big states, it's almost all the states. He said the great transformation occurring in state finances means states are forced to reorient their whole stance vis-a-vis the kind of programs and services they offer their citizens. In the 2011 fiscal year alone, which started July 2010, states must come up with $130 billion in savings or new revenue to balance their budgets, one study estimated. By the fall of 2010, there was some good news. Revenue from some taxes and fees in some states had started to pick up, or at least slowed their rate of decline. In a September 2010 report, the National Conference of State Legislatures declared that the states are waiting to see if the economy will sustain this nascent revenue growth. And despite recent revenue improvements, more gaps loom as states confront the phase-out of federal stimulus funds, expiring tax increases, and growing spending pressures. Some states were hit harder than others, either because they were particularly affected by the crisis or because they came into the crisis with structural budget problems. In 2010, New Jersey Governor Chris Christie proposed chopping $11 billion, or a quarter of the state budget, to eliminate a deficit. California officials struggled through the summer and fall to close a $19 billion shortfall, an amount larger than the entire budgets of some states. Nonetheless, the state's Independent Budget Analysis Office said in November that the deficit had instead grown to $25 billion, $6 billion in the $87 billion budget for this year, and $19 billion in the fiscal year commencing in June 2011. As people lost jobs, many also lost their health insurance, helping to drive 3.8 million Americans into the Medicaid program in 2009 alone, an 8% increase, the largest in a single year since the early days of this government health insurance plan, according to the Kaiser Family Foundation, a nonprofit organization focusing on healthcare research. Every state showed an enrollment increase. In 9 states it was greater than 15%. In Nevada and Wisconsin, greater than 20%. States share the cost of Medicaid with the federal government. Congress included $87 billion in the stimulus package to help them with this expense, and it has extended the assistance through June 2011 at a reduced level. If the economy has not improved by then, Kaiser predicts paying for this program will be another huge potential source of trouble for the states. The National League of Cities recently said that U.S. cities are in their worst fiscal shape in at least a quarter of a century and probably have not yet hit bottom, even after 4 straight years of falling revenue. Because property taxes are one of the main source of revenue for most local governments, and because some local assessors are only now recording lower property values, their revenue is likely to continue to decline for at least several more years. The effects of a depressed real estate market, low levels of consumer confidence, and high levels of unemployment will likely play out in cities through 2010, 2011, and beyond, the survey of 338 cities reported. The authors of the survey projected that revenue would fall 3% in 2010, and cities' budgets would shrink another 2%, the largest cutbacks in the 25 years for which the group has published the report. Investors now look askance at once solid state and local bonds, raising borrowing costs for many states and making their task of balancing the budget even harder. Municipalities in Florida, the state with the third highest rate of home foreclosures, saw borrowing costs rise when they sold $442 million in bonds in September 2010. Impact at the federal level. The federal government's response to the financial crisis and the ensuing recession included some of the most aggressive fiscal and monetary policies in history, said the economist Mark Zandi and Alan Blinder. Yet almost every one of these policy initiatives remain controversial to this day, with critics calling them misguided, ineffective, or both. The government's fiscal initiatives began soon after the recession started. The Economic Stimulus Act of 2008, signed into law in February, provided roughly $170 billion in tax rebates for households and tax incentives for businesses. In October 2008, at the height of the crisis, the $700 billion TARP was enacted, and in early 2009, the American Recovery and Reinvestment Act of 2009 was enacted to stimulate the weakening economy, costing another $787 billion in tax cuts and government spending. Beginning with the rate cuts in mid-2007 through the implementation of the TALF in early 2009, the Federal Reserve provided support to the economy throughout the crisis. Aside from its emergency lending programs put in place during the financial crisis, the Fed put about $1.7 trillion into the economy from September 2008 to October 2010. Primarily by buying financial assets such as mortgages-backed securities and treasury bonds, a process known as quantitative easing. And in November 2010, officials announced another $600 billion in easing, designed to keep long-term and short-term interest rates down. In October 2010, the Treasury Department reported that the TARP program would cost far less than the $700 billion that Congress had appropriated in the fall of 2008, because banks had begun to repay the Treasury in 2009. In fact, Treasury said, TARP would wind up costing about $29 billion, mostly owing to the bailout of the automakers General Motors and Chrysler and the Mortgage Modification Program. The latest estimates from the Congressional Budget Office, CBO, put its cost at $25 billion. As reported earlier, the CBO projects that the economic cost of the GSE's downfall, including the financial cost of government support and actual dollar outlays, could reach $389 billion by 2019. Overall, as spending increased and revenues declined during the recession, the federal deficit grew from $459 billion in 2008 to $1.4 trillion in 2009, and it is estimated to have risen to $1.6 trillion in 2010. End of section 145. Section 146 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Chapter 21, The Financial Sector, almost triple the level of 3 years earlier. While the overall economy has struggled, the story for the financial sector is somewhat different. Like other sectors of the economy, the financial industry has cut jobs. After growing steadily for years, employment in the financial sector fell by 128,000 in 2007, 273,000 in 2008, and another 310,000 in 2009. Areas dependent on the financial industry, such as Charlotte, North Carolina, have been hit hard. The unemployment rate in the Charlotte area rose from 4.8% in 2006 to a recent peak of 12.8% in February 2010. Between January 2009 and December 2010, 297 banks have failed. Most were small and medium-sized banks. The number of small banks on the FDIC's list of troubled institutions rose from 829 in the second quarter of 2010 to 860 in the third quarter, the largest number since March 1993. Though a number of large financial institutions failed or nearly failed during the crisis, on the whole they have done better since the fall of 2008. Total financial sector profits peaked at $428 billion in 2006 and then fell to $128 billion in 2008, the lowest level since the early 1990s. They have since rebounded in 2009 and 2010, boosted by low interest rates and access to low-cost government borrowing. Financial sector profits were $242 billion in 2009 and reached an annual rate of $369 billion in the fall of 2010. Within the financial sector, commercial bank profits rose from $7.6 billion in the first quarter of 2009 to $18 billion in the first quarter of 2010. The gains were concentrated among the larger banks. For banks with assets greater than $1 billion, profits more than doubled from $6.3 billion to $14.5 billion from the first quarter of 2009 to the first quarter of 2010. For commercial banks with less than $1 billion in assets, profits rose only 26%, from less than $1 billion to $1.2 billion. The securities industry has reported record profits and is once again distributing large bonuses. Just for those who work in New York City, bonuses at Wall Street securities firms in 2009 were $20.3 billion, up 17% from the year before, with average compensation rising by 27% to more than $340,000. After reporting $54 billion of losses during 2007 and 2008, the New York State Comptroller reported that in 2009, industry profits reached a record $61.4 billion, almost triple the level of 3 years earlier. End of section 146.
Section 147 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 22. The Foreclosure Crisis. Foreclosures on the rise. Hard to talk about any recovery. Since the housing bubble burst, about 4 million families have lost their homes to foreclosure, and another 4.5 million have slipped into the foreclosure process or are seriously behind on their mortgage payments. When the economic damage finally abates, foreclosures may total between 8 million and more than 13 million according to various estimates. The foreclosure epidemic has hurt families and undermined home values in entire zip codes, strained school systems as well as community support services, and depleted state coffers. Even if the economy began suddenly booming, the country would need years to recover. Prior to 2007, the foreclosure rate was historically less than 1%, but the trend since the housing market collapsed has been dramatic. In 2009, 2.2% of all houses, or 1 out of 45, received at least one foreclosure filing. In the fall of 2010, 1 in every 11 outstanding residential mortgage loans in the United States was at least one payment past due but not yet in foreclosure, an ominous warning that this wave may not have crested. Distressed sales account for the majority of home sales in cities around the country, including Las Vegas, Phoenix, Sacramento, and Riverside, California. Returning to the 4,499 borrowers whose loans were pulled into CMLTI 2006 and C2, by September 2010, many had moved or refinanced their mortgages. By that point, 1,917 had entered foreclosure, mostly in Florida and California, and 729 had started loan modifications. Of the 1,715 still active loans, then, 579 were seriously past due in their payments or currently in foreclosure. The causes of foreclosures have been analyzed by many academics and government agencies. 2 events are typically necessary for mortgage default. First, monthly payments become unaffordable owing to unemployment or other financial hardship, or because mortgage payments increase. And second, in the opinion of many, now the more important factor, the home's value become less than the debt owed. In other words, the borrower has negative equity. The evidence is irrefutable. Laurie Goodman, a senior managing director with Amherst Securities, told the Congress in 2009, "Negative equity is the most important predictor of default. When the borrower has negative equity, unemployment acts as one of many possible catalysts, increasing the probability of default." After falling 32% from their peak in 2006 to the spring of 2009, home prices have rebounded somewhat, but improvements are uneven across regions. Nationwide, 10.8 million households, or 22.5% of those with mortgages, owe more on their mortgages than the market value of their house. See figure 22.1. In Nevada, 67% of homes with mortgages are underwater, the highest rate in the country. In California, the rate is 32%. Given the extraordinary prevalence and extent of negative equity, the phenomenon of strategic defaults has also been on the rise. Homeowners purposefully walk away from mortgage obligations when they perceive that their homes are worth less than what they owe and they believe that the value will not be going up anytime soon. By the fall of 2010, 3 states particularly hard hit by foreclosures, California, Florida, and Nevada, reported some recent improvements in the initiation of foreclosures, but in November, Nevada's rate was still 5 times higher than the national average. Foreclosure starts climbed in 33 states from their level a year earlier, with the largest increases in Washington state, which has 9.2% unemployment, Indiana 9.8% unemployment, and South Carolina 10.6% unemployment, according to the Mortgage Bankers Association. In Ohio, the city of Cleveland and surrounding Cuyahoga County are bulldozing blocks of abandoned houses down to the dirt with the aim of creating a northeastern Ohio bank of land preserved for the future. To do this, authorities seize blighted properties for unpaid taxes, and they take donations of homes from the Department of Housing and Urban Development, Fannie Mae, and some private lenders. Now the county finds itself under increasing duress, having endured 14,000 foreclosures in 2009. After years of high unemployment and a fragile economy, the financial crisis took vulnerable residents and shoved them over the edge of the cliff, Jim Rokakis, Cuyahoga's treasurer, told the commission. In a spring 2010 survey, 85% of the responding majors ranked the prevalence of non-prime or subprime mortgages as either first or second on a list of factors causing foreclosures in their cities. Almost all the majors, 92%, said they expected the foreclosure problems to stay the same or worsen in their cities over the next year. There has been no meaningful decline in the inventory of distressed properties found in the housing market, Guy Cigala, the chief executive and publisher of Inside Mortgage Finance Publications, told a congressional panel overseeing the Troubled Asset Relief Program in October 2010. It's hard to talk about any recovery of the housing market when the share of distressed property transactions remains close to 50%. There was a fundamental change in our financial services sector that really is the reason we're in this crisis, this economic crisis, and is the reason we're seeing and will see in total probably before we're done between 15 and 16 million foreclosure filings in this country. John Taylor, the president and CEO of the National Community Reinvestment Coalition, explained to the FCIC. And by the way, a few 100,000 people, even 1 million people going into foreclosure, you can kind of blame and say, well, they should have known better. But 15 or 16 million American families can't all be wrong. They can't all be greedy and they can't all be stupid. End of section 147. Section 148 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 22. Initiatives to Stem Foreclosures. Persistently Disregard. The same system that was so efficient at creating millions of mortgage loans over the past decade has been ineffective at resolving problems in the housing market, including the efforts of homeowners to modify their mortgages. As mortgage problems mounted, the federal and state governments responded with financial incentives to encourage banks to adjust interest rates, spread loan payments over longer terms, or simply write down mortgage debts. But to date, federal auditors and independent consumer watchdogs have given the federal governments and the banks' mortgage modification programs poor grades. The Home Affordable Modification Program, HAMP, is falling short of the 3 to 4 million families targeted for help by the end of 2012. The program's resources come from the federal TARP funds. As of December 2010, HAMP has resulted in the permanent modification of only 520,000 mortgages. Meanwhile, the banks report that they have independently approved 3.4 million loan alterations of various kinds, although many of these modifications simply roll missed payments into a new mortgage and thus result in higher monthly payments. The effectiveness of state mortgage modification and foreclosure assistance programs is unclear. Some are just getting started. New Jersey, for instance, will begin a $112 million Homekeeper program in 2011 to offer some residents who face foreclosure because of unemployment or substantial underemployment a deferred payment, no interest loan, so that they can continue making payments on their mortgages. During a series of hearings in communities around the country affected by the housing crisis, the Commission heard from many witnesses about the extraordinary difficulties they had encountered in seeking to modify their mortgages and stay in their homes. Borrowers who have been paying down mortgages for years and have built up substantial equity are especially susceptible to being turned down for loan modifications because the lender would prefer that they simply sell their homes. Kirsten Keefe, a senior staff attorney with the Empire Justice Center in Albany, New York, brought this issue to regulators' attention in March 2010. Speaking to the Federal Reserve Board's Consumer Advisory Council in Washington, Keefe identified the trends among borrowers in New York who tried to qualify for the government's hemp program. We're also routinely hearing that folks who have a lot of equity are being denied hemp modifications, she said. Diane Thompson from the National Consumer Law Center testified to the United States Senate Committee on Banking, Housing, and Urban Affairs in November 2010 about the challenges of the program. She stated, "Only a very few of the potentially eligible borrowers have been able to obtain permanent modifications. Advocates continue to report that borrowers are denied improperly for hemp and that some servicers persistently disregard hemp applications. Competing incentives may encourage banks to view foreclosure as quicker, cleaner, and often cheaper than modifying the terms of existing mortgages. For them, foreclosure is a prudent response to default because the data suggests many borrowers who receive temporary or permanent forgiveness under terms will slide into default again. Also, servicers may receive substantial fees for guiding a mortgage through the foreclosure process, creating an incentive to deny a modification. Frequently, there is another complication to attempting a foreclosure or modification: the second mortgages that were layered onto first mortgages. The first mortgages were commonly sold by banks into the securitization machine. The second mortgages were often retained by the same lenders who typically service the mortgage. That is, they process the monthly payments and provide customer service to borrowers. If a first mortgage is modified or foreclosed on, the entire value of the second mortgage may be wiped out. Under these circumstances, the lender holding that second lien has an incentive to delay a modification into a new loan that would make the mortgage payments more affordable to the borrower. The country's lending banks now hold on their books more than $400 billion in second mortgages. To the extent the banks have reported these loans as performing, the loans had not been marked down on their books. The actual value of these second mortgages could be much less than their $400 billion plus reported value. The danger of future losses is self-evident. Some frustrated first lien investors have sued servicers, asserting that they are not protecting investors' financial interests. Instead, they claim that because the servicer is holding the second lien, the servicers are looking after their own balance sheets by encouraging borrowers to keep up the payments on their second mortgage when they cannot afford to make payments on both obligations. According to Lori Goodman, for mortgage modifications to work, the holders of the second mortgages will have to accept some losses, a potentially expensive proposition. A number of other obstacles have made modifications difficult. For example, there are competing interests among various investors in a mortgage-backed security. Proceeds from a foreclosure may be enough to pay off the investors holding the highest-rated tranches of securities, while the holders of the lower tranches would likely be wiped out. As a result, the holders of the lower-rated tranches might prefer a modification if it produced more cash flow than a foreclosure. Other efforts in the private and public sectors to address the foreclosure crisis have focused on encouraging short sales. In theory, short sales should help borrowers, neighborhoods, and lenders. Borrowers avoid foreclosure, neighborhoods avoid vacant, dilapidated homes that encourage crime, and lenders avoid some of the costs of foreclosure. Nonetheless, such deals frequently stall because the process is cumbersome, demands coordination, and eats up resources. For example, lenders can be reluctant to sign off on the buyer's bid because they are not sure that the home is being sold at the highest possible price. In addition, when there are two mortgages, the holders of the first and second mortgages must both agree to the resolution. End of section 148. Section 149 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 22. Flaws in the Process. speculation, and worst-case scenarios. In 2010, additional issues have come to the fore as problems with individual foreclosures have revealed systemic flaws in how lenders documented and processed mortgages for securitization. Legal experts and consumer advocates told the Commission that procedural and documentation problems with foreclosure have been laid out in court cases and academic studies for years, but were ignored until the number of foreclosures rose so dramatically. All 50 of the nation's state attorneys general banded together in the fall of 2010 to investigate foreclosure irregularities, identify possible solutions, and explore potential redress for borrowers who were harmed by improper foreclosures. For example, lenders have relied on robo-signers who substituted speed for accuracy by signing and sometimes backdating hundreds of affidavits claiming personal knowledge of facts about mortgages that they did not actually know to be true. One such robo-signer, Jeffrey Stephan of GMAC, said that he signed 10,000 affidavits in a month, roughly one per minute, in a 40-hour workweek, making it highly unlikely that he verified payment histories in each individual case of foreclosure. In addition, a number of court cases have been filed alleging invalid notarizations, forged signatures, backdated mortgage paperwork, and failure to demonstrate having legal standing to foreclosure, that is, being the entity with the right to repossess a home. The problem of legal standing arose because the rapid growth of mortgage securitization outpaced the ability of the legal and financial system to accurately record who owns the mortgage. During the securitization process, loans were sold multiple times. To speed up processing, the financial industry created Mortgage Electronic Registration Systems, Inc., MERS, an organization made up of 3,000 mortgage lenders. It tracks changes in servicing rights and ownership interests in mortgage loans. MERS is designated as the mortgagee of record on behalf of its members, a status that is meant to give it the legal right to foreclosure if the borrower fails to pay the loan. MERS has registered 66 million mortgages since launching in 1995 and had 33 million loans outstanding as of November 2010. The standing of MERS or its designees to foreclosure has been called into question by courts and academics, however. In a hearing before the House Judiciary Committee on the Foreclosure Crisis, New York State Supreme Court Justice F. Dana Winslow testified that standing has become such a pervasive issue that I frequently use the term presumptive mortgagee in foreclosure to describe MERS. Because of multiple unrecorded transfers of the legal ownership of the mortgage, it is unclear whether MERS continued to be the mortgagee after subsequent sales of the loan, according to Winslow. Moreover, courts have held that MERS does not own the underlying note and therefore cannot transfer the note or the deed of trust or foreclosure upon the property. Winslow also highlighted other deficiencies in MERS standing, many involving sloppy paperwork, the failure to produce the correct promissory notes incurred during foreclosure proceedings, gaps in the chain of title, including printouts of the title that have differed substantially from information provided previously, retroactive assignments of notes and mortgages in an effort to clean up the paperwork problems from earlier years, questionable signatures on assignments and affidavits attesting to the ownership of the note and mortgage, and questionable notary stamps on assignments. On November 16, 2010, a bankruptcy court ruled that the Bank of New York could not foreclose on the loan it had purchased from Countrywide because MERS had failed to endorse or deliver the note to the Bank of New York as required by the pooling and servicing agreement. This ruling could have further implications because it was customary for Countrywide to maintain possession of the note and related loan documents when loans were securitized. Across the market, some mortgage securities holders have sued the issuers of those securities, demanding that the issuers rescind their purchases. If the legal challenges succeed, investors that own mortgage-backed securities could force the issuers to buy them back at the original price, possibly with interest. The issuers would then be the owners of the securities and would bear the risk of loss. The Congressional Oversight Panel, in a report issued in November 2010, said it is on the lookout for such risks. If documentation problems prove to be pervasive and, more importantly, throw into doubt the ownership of not only foreclosed properties but also pooled mortgages, the consequences could be severe. This sentiment was echoed by University of Iowa law professor Catherine Porter, who has studied foreclosures and the law. It is lack of knowledge on how widespread the problems may be that is turning the allegations into a crisis. Lack of knowledge feeds speculation and worst-case scenarios. Adam Levitin, a Georgetown University associate professor of law, has estimated that the claims could be in the trillions of dollars, rendering major U.S. banks insolvent. End of section 149. Section 150 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 22, Neighborhood Effects. I'm Not Living. For the billions of Americans who paid their bills, never flipped a house, and had never heard of a CDO, the financial crisis has been long, bewildering, and painful. A crisis that started with a housing boom that became a bubble has come back full circle to forests of for sale signs, but this time attracting few buyers. Stores have shuttered, employees have cut jobs, hopes have fled. Too many Americans today find themselves in suburban ghost towns or urban wastelands where properties are vacant and construction cranes do not lift a thing for months. Renters who never bought into the madness are also among the victims as lenders seize property after landlords default on loans. Renters can lose the roof over their heads as well as their security deposits. In Minneapolis, as many as 60% of buildings with foreclosures in 2006 and 2007 were renter-occupied, according to statistics cited in testimony by Deputy Assistant Secretary Erica Pething from the U.S. Department of Housing and Urban Development to the House of Representatives Subcommittee on Housing and Community Opportunity. For children, a repossessed house, whether rented or bought, is destabilizing. The impact of foreclosures on children around the country has been enormous. 1/3 of the children who experienced homelessness after the financial crisis did so because of foreclosures of the housing that their parents owed or were renting, according to a recent study. One school official in Nevada told the commission about the significant challenges to the educational system created by the economic crisis. All around, the demand from people who need help is outstripping community resources. Coast to coast, communities are trying to stretch housing aid budgets to help people displaced by foreclosures. In Nevada, for example, Clark County, which contains 1.9 million people living in and around Las Vegas, was forced to cut its financial housing assistance program despite the clear needs in the community. Gail Burks, the president and chief executive of the Nevada Fair Housing Center, told the commission that her group finds that many they counsel through the foreclosure process are in despair. It's very stressful. There are times that the couples we are helping end up divorcing, sometimes before the process is over. We've also seen threats of suicide. And the stories continue. Karen Mann, the appraiser from Discovery Bay, California, testified to the commission about her family's circumstances. Her daughter and son-in-law refinanced their mortgage into an adjustable-rate mortgage. When the time came for the rate to adjust upward, new financial troubles made the payments more than the family could afford. Because the market value of the home was nearly equal to their mortgage debt, the family's attempts to get the mortgage modified were fruitless. They lined up a buyer for a short sale, but the deal was nixed. Then, when medical problems created yet another challenge, the couple and their 4 children moved in with Mann. The children were relocated to new schools, and the adults dealt with the pain and emotional suffering while they were trying to rebuild their lives, Mann said. The couple filed for bankruptcy. 2 months after the bankruptcy was completed, the lender asked them if they wanted to modify their mortgage. In Cape Coral, Florida, Dawn Hunt and her husband, a mailman, and their 2 children live in an attractive ranch-style home they bought for about $100,000 more than a decade ago. It was a quiet 20-year-old subdivision where most of the residents were homeowners. In 2005 and 2006, builders rushed to the area and threw up dozens of new homes on empty lots. Homebuilder Comfort Homes of Florida LLC broke ground for the house across the street from the Hunts, but did not complete it. This fall, the house sat vacant, an empty shell. No stucco was ever applied to the concrete block exterior, and the house had no interior walls. A wasp nest decorated the electrical box near the front door. The untended grass had grown 4 feet high. Sharp sand spurs in the brush made it difficult to approach the property. 2 doors down from the Hunts, another house was also vacant. left empty when a family split up and moved a year earlier. They abandoned the car in the garage. The roof leaked, and the blue plastic tarp put in place to keep the rain out now flaps in the breeze. The Hunts called the police after vandals broke into the house one night. Intruders have been back twice more in the daylight. Now 44% of the homes in the Hunts neighborhood are in the foreclosure process or have been taken back by the bank. Most of the other houses in the community are occupied by renters whose absentee landlords bought the houses when the borrowers lost their homes to their banks. The Hunts' house has lost 2/3 of its value from the peak of the market. Nonetheless, even though the neighborhood is not as lovely as it used to be, Don Hunt told the FCIC, "I am not leaving." End of section 150. Section 151 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Commission conclusions on Chapter 22. The Commission concludes the unchecked increase in the complexity of mortgages and securitization has made it more difficult to solve problems in the mortgage market. This complexity has created powerful competing interests, including those of the holders of first and second mortgages and of mortgage servicers, has reduced transparency for policymakers, regulators, financial institutions, and homeowners, and has impeded mortgage modifications. The resulting disputes and inaction have caused pain largely borne by individual homeowners and created further uncertainty about the health of the housing market and financial institutions. End of section 151.
Section 152 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Dissenting Statement, Causes of the Financial and Economic Crisis. Intro. We have identified 10 causes that are essential to explaining the crisis. In this dissenting view, we explain how our approach differs from others. We briefly describe the stages of the crisis. We list the 10 essential causes of the crisis and we walk through each cause in a bit more detail. We find areas of agreement with the majority's conclusions, but unfortunately the areas of disagreement are significant enough that we dissent and present our views in this report. We wish to compliment the Commission staff for their investigative work. In many ways it helped shape our thinking and conclusions. Due to a length limitation recently imposed upon us by 6 members of the Commission, this report focuses only on the causes essential to explaining the crisis. We regret that the limitation means that several important topics that deserve a much fuller discussion get only a brief mention here. End of section 152. Section 153 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Dissenting Statement, Causes of the Financial and Economic Crisis. How our approach differs from others. During the course of the Commission's hearings and investigations, we heard frequent arguments that there was a single cause of the crisis. For some, it was international capital flows or monetary policy. For others, housing policy, and for still others, it was insufficient regulation of an ambiguously defined shadow banking sector or unregulated over-the-counter derivatives, or the greed of those in the financial sector and the political influence they had in Washington. In each case, these arguments, when used as single-cause explanations, are too simplistic because they are incomplete. While some of these factors were essential contributors to the crisis, each is insufficient as a standalone explanation. The majority's approach to explaining the crisis suffers from the opposite problem. It is too broad. Not everything that went wrong during the financial crisis caused the crisis, and while some causes were essential, others had only a minor impact. Not every regulatory change related to housing or the financial system prior to the crisis was a cause. The majority's almost 550-page report is more an account of bad events than a focused explanation of what happened and why. When everything is important, nothing is. As an example, non-credit derivatives did not in any meaningful way cause or contribute to the financial crisis. Neither the Community Reinvestment Act nor removal of the Glass-Steagall firewall was a significant cause. The crisis can be explained without resorting to these factors. We also reject as too simplistic the hypothesis that too little regulation caused the crisis, as well as its opposite, that too much regulation caused the crisis. We question this metric for determining the effectiveness of regulation. The amount of financial regulation should reflect the need to address particular failures in the financial system. For example, high-risk, non-traditional mortgage lending by non-bank lenders flourished in the 2000s and did tremendous damage in an ineffectively regulated environment, contributing to the financial crisis. Poorly designed government housing policies distorted market outcomes and contributed to the creation of unsound mortgages as well. Countrywide's irresponsible lending and AIG's failure were in part attributable to ineffective regulation and supervision, while Fannie Mae and Freddie Mac's failures were the result of policymakers using the power of government to blend public purpose with private gains and then socializing the losses. Both the too little government and too much government approaches are too broad brush to explain the crisis. The majority says the crisis was avoidable if only the United States had adopted across the board more restrictive regulations in conjunction with more aggressive regulators and supervisors. This conclusion by the majority largely ignores the global nature of the crisis. For example, a credit bubble appeared in both the United States and Europe. This tells us that our primary explanation for the credit bubble should focus on factors common to both regions. The report largely ignores the credit bubble beyond housing. Credit spreads declined not just for housing but also for other asset classes like commercial real estate. This tells us to look to the credit bubble as an essential cause of the U.S. housing bubble. It also tells us that problems with U.S. housing policy or markets do not by themselves explain the U.S. housing bubble. There were housing bubbles in the United Kingdom, Spain, Australia, France, and Ireland, some more pronounced than in the United States. Some nations with housing bubbles relied little on American-style mortgage securitization. A good explanation of the U.S. housing bubble should also take into account its parallels in other nations. This leads us to explanations broader than just U.S. housing policy, regulation, or supervision. It also tells us that while failures in U.S. securitization markets may be an essential cause, we must look for other things that went wrong as well. Large financial firms failed in Iceland, Spain, Germany, and the United Kingdom, among others. Not all of these firms bet solely on U.S. housing assets, and they operated in different regulatory and supervisory regimes than U.S. commercial and investment banks. In many cases, these European systems have stricter regulation than the United States, and still they faced financial firm failures similar to those in the United States. These facts tell us that our explanation for the credit bubble should focus on factors common to both the United States and Europe, that the credit bubble is likely an essential cause of the U.S. housing bubble, and that U.S. housing policy is by itself an insufficient explanation of the crisis. Furthermore, any explanation that relies too heavily on a unique element of the U.S. regulatory or supervisory system is likely to be insufficient to explain why the same thing happened in parts of Europe. This moves inadequate international capital and liquidity standards up our list of causes, and it moves the differences between the regulation of U.S. commercial and investment banks down that list. Applying these international comparisons directly to the majority's conclusions provokes these questions. If the political influence of the financial sector in Washington was an essential cause of the crisis, how does that explain similar financial institution failures in the United Kingdom, Germany, Iceland, Belgium, the Netherlands, France, Spain, Switzerland, Ireland, and Denmark? How can the runaway mortgage securitization train detailed in the majority's report explain housing bubbles in Spain, Australia, and the United Kingdom, countries with mortgage finance systems vastly different than that in the United States? How can the corporate and regulatory structures of investment banks explain the decisions of many U.S. commercial banks, several large American university endowments, and some state public employee pension funds, not to mention a number of large and mid-sized German banks, to take on too much U.S. housing risk? How did former Fed Chairman Alan Greenspan's deregulatory ideology also precipitate bank regulatory failures across Europe? Not all of these factors identified by the majority were irrelevant. They were just not essential. The Commission's statutory mission is to examine the causes, domestic and global, of the current financial and economic crisis in the United States. by focusing too narrowly on U.S. regulatory policy and supervision, ignoring international parallels, emphasizing only arguments for greater regulation, failing to prioritize the causes, and failing to distinguish sufficiently between causes and effects. The majority's report is unbalanced and leads to incorrect conclusions about what caused the crisis. We begin our explanation by briefly describing the stages of the crisis. End of section 153. Section 154 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Dissenting Statement, Causes of the Financial and Economic Crisis, Stages of the Crisis. As of December 2010, the United States is still in an economic slump caused by a financial crisis that first manifested itself in August 2007 and ended in early 2009. The primary features of that financial crisis were a financial shock in September 2008 and a concomitant financial panic. The financial shock and panic triggered a severe contraction in lending and hiring beginning in the fourth quarter of 2008. Some observers describe recent economic history as a recession that began in December 2007 and continued until June 2009, and from which we are only now beginning to recover. While this definition of the recession is technically accurate, it obscures a more important chronology that connects financial market developments with the broader economy. We describe recent U.S. macroeconomic history in 5 stages. A series of foreshocks beginning in August 2007, followed by an economic slowdown and then a mild recession through August 2008, as liquidity problems emerged and 3 large U.S. financial institutions failed. A severe financial shock in September 2008 in which 10 large financial institutions failed, nearly failed, or changed their institutional structure, triggering a financial panic and the beginning of a large contraction in the real economy in the last few months of 2008, followed by the end of the financial shock, panic, and rescue at the beginning of 2009, followed by a continued and deepening contraction in the real economy and the beginning of the financial recovery and rebuilding period. As of December 2010, the United States is still in the last stage. The financial system is still recovering and being restructured, and the U.S. economy struggles to return to sustained strong growth. The remainder of our comments focuses on the financial crisis in the first 3 stages by examining its 10 essential causes. End of section 154. Section 155 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Dissenting Statement, Causes of the Financial and Economic Crisis. The 10 essential causes of the financial and economic crisis. The following 10 causes, global and domestic, are essential to explaining the financial and economic crisis. 1. Credit bubble. Starting in the late 1990s, China, other large developing countries, and the big oil-producing nations built up large capital surpluses. They loaned these savings to the United States and Europe, causing interest rates to fall. Credit spreads narrowed, meaning that the cost of borrowing to finance risky investments declined. A credit bubble formed in the United States and Europe, the most notable manifestation of which was increased investment in high-risk mortgages. U.S. monetary policy may have contributed to the credit bubble but did not cause it. 2. Housing bubble. Beginning in the late 1990s and accelerating in the 2000s, there was a large and sustained housing bubble in the United States. The bubble was characterized both by national increases in house prices well above the historical trend and by rapid regional boom and bust cycles in California, Nevada, Arizona, and Florida. Many factors contributed to the housing bubble, the bursting of which created enormous losses for homeowners and investors. 3. Non-traditional mortgages. Tightening credit spreads, overly optimistic assumptions about U.S. housing prices, and flaws in primary and secondary mortgage markets led to poor origination practices and combined to increase the flow of credit to U.S. housing finance. Fueled by cheap credit, firms like Countrywide, Washington Mutual, AmeriQuest, and HSBC Finance originated vast numbers of high-risk, non-traditional mortgages that were in some cases deceptive, in many cases confusing, and often beyond borrowers' ability to repay. At the same time, many homebuyers and homeowners did not live up to their responsibilities to understand the terms of their mortgages and to make prudent financial decisions. These factors further amplified the housing bubble. 4. Credit ratings and securitization. Failures in credit rating and securitization transform bad mortgages into toxic financial assets. Securitizers lowered the credit quality of the mortgages they securitized. Credit rating agencies erroneously rated mortgage-backed securities and their derivatives as safe investments. Buyers failed to look behind the credit ratings and do their own due diligence. These factors fueled the creation of more bad mortgages. 5. Financial institutions concentrated correlated risk. Managers of many large and mid-sized financial institutions in the United States amassed enormous concentrations of highly correlated housing risk. Some did this knowingly by betting on rising housing prices, while others paid insufficient attention to the potential risk of carrying large amounts of housing risk on their balance sheets. This enabled large but seemingly manageable mortgage losses to precipitate the collapse of large financial institutions. 6. Leverage and liquidity risk. Managers of these financial firms amplified this concentrated housing risk by holding too little capital relative to the risks they were carrying on their balance sheets. Many placed their firms on a hair trigger by relying heavily on short-term financing in repo and commercial paper markets for their day-to-day liquidity. They placed solvency bets, sometimes unknowingly, that their housing investments were solid, and liquidity bets that overnight money would always be available. Both turned out to be bad bets. In several cases, failed solvency bets triggered liquidity crises, causing some of the largest financial firms to fail or nearly fail. Firms were insufficiently transparent about their housing risk, creating uncertainty in markets that made it difficult for some to access additional capital and liquidity when needed. 7. Risk of contagion. The risk of contagion was an essential cause of the crisis. In some cases, the financial system was vulnerable because policymakers were afraid of a large firm's sudden and disorderly failure triggering balance sheet losses in its counterparties. These institutions were deemed too big and interconnected to other firms through counterparty credit risk for policymakers to be willing to allow them to fail suddenly. 8. Common shock. In other cases, unrelated financial institutions failed because of a common shock. They made similar failed bets on housing. Unconnected financial firms failed for the same reason and at roughly the same time because they had the same problem: large housing losses. This common shock meant that the problem was broader than a single failed bank. Key large financial institutions were undercapitalized because of this common shock. 9. Financial shock and panic. In quick succession in September 2008, the failures, near failures, and restructurings of 10 firms triggered a global financial panic. Confidence and trust in the financial system began to evaporate as the health of almost every large and mid-sized financial institution in the United States and Europe was questioned. 10. Financial crisis causes economic crisis. The financial shock and panic caused a severe contraction in the real economy. The shock and panic ended in early 2009. Harm to the real economy continues through today. We now describe these 10 essential causes of the crisis in more details. End of section 155. Section 156 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Dissenting Statement: Causes of the Financial and Economic Crisis, the Credit Bubble, Global Capita Flows, Underpriced Risk, and Federal Reserve Policy. The financial and economic crisis began with a credit bubble in the United States and Europe. Credit spreads narrowed significantly, meaning that the cost of borrowing to finance risky investments declined relative to safe assets such as U.S. Treasury securities. The most notable of these risky investments were high-risk mortgages. The U.S. housing bubble was the most visible effect of the credit bubble, but not the only one. Commercial real estate, high-yield debt, and leveraged loans were all boosted by the surplus of inexpensive credit. There are three major possible explanations for the credit bubble: global capital flows, the repricing of risk, and monetary policy. Global capital flows. Starting in the late 1990s, China, other large developing countries, and the big oil-producing nations consumed and invested domestically less than they earned. As China and other Asian economies grew, their savings grew as well. In addition, boosted by high global oil prices, the largest oil-producing nations built up large capital surpluses and looked to invest in the United States and Europe. Massive amounts of inexpensive capital flowed into the United States, making borrowing inexpensive. Americans used the cheap credit to make riskier investments than in the past. The same dynamic was at work in Europe. Germany saved and its capital flowed to Ireland, Italy, Spain, and Portugal. Fed Chairman Ben Bernanke describes the strong relationship between financial account surplus growth, the mirror of current account deficit growth, and house price appreciation. Countries in which current accounts worsened and capital inflows rose had greater house price appreciation from 2001 to 2006. The relationship is highly significant, both statistically and economically, and about 31% of the variability in house price appreciation across countries is explained. Global imbalances are an essential cause of the crisis and the most important macroeconomic explanation. Steady and large increases in capital inflows into the U.S. and European economies encouraged significant increases in domestic lending, especially in high-risk mortgages. The repricing of risk. Low-cost capital can, but does not necessarily have to lead to an increase in risky investments. Increased capital flows to the United States and Europe cannot alone explain the credit bubble. We still don't know whether the credit bubble was the result of rational or irrational behavior. Investors may have been rational. Their preferences may have changed, making them willing to accept lower returns for high-risk investments. They may have collectively been irrational. They may have adopted a bubble mentality and assumed that, while they were paying a higher price for risky assets, they could resell them later for even more. Or they may have mistakenly assumed that the world had gotten safer and that the risk of bad outcomes, especially in the U.S. housing markets, had declined. For some combination of these reasons, over a period of many years leading up to the crisis, investors grew willing to pay more for risky assets. When the housing bubble burst and the financial shock hit, investors everywhere reassessed what return they would demand for a risky investment, and therefore what price they were willing to pay for a risky asset. Credit spreads for all types of risk around the world increased suddenly and sharply, and the prices of risky assets plummeted. This was most evident in, but not limited to, the U.S. market for financial assets backed by high-risk, non-traditional mortgages. The credit bubble burst and caused tremendous damage. Monetary policy. The Federal Reserve significantly affects the availability and price of capital. This leads some to argue that the Fed contributed to the increased demand for risky investments by keeping interest rates too low for too long. Critics of Fed policy argue that, beginning under Chairman Greenspan and continuing under Chairman Bernanke, the Fed kept rates too low for too long and created a bubble in housing. Dr. John B. Taylor is a proponent of this argument. He argues that the Fed set interest rates too low in 2002 to 2006, and that these low rates fueled the housing bubble as measured by housing starts. He suggests that this Fed-created housing bubble was the essential cause of the financial crisis. He further argues that, had federal funds rates instead followed the path recommended by the Taylor Rule, a monetary policy formula for setting the funds rate, the housing boom and subsequent burst would have been much smaller. He also applies this analysis to European economies and concludes that similar forces were at play. Current Fed Chairman Bernanke and former Fed Chairman Greenspan disagree with Taylor's analysis. Chairman Bernanke argues that the Taylor Rule is a descriptive rule of thumb, but that simple policy rules are insufficient for making monetary policy decisions. He further argues that, depending on the construction of the particular Taylor Rule, the monetary policy stance of the Fed may not have diverged significantly from its historical path. Former Chairman Greenspan adds that the connection between short-term interest rates and house prices is weak, that even if the Fed's target for overnight lending between banks was too low, this has little power to explain why rates on 30-year mortgages were also too low. This debate intertwines several monetary policy questions. How heavily should the Fed weigh a policy rule in its decision to set interest rates? Should monetary policy be mostly rule-based or mostly discretionary? If the Fed thinks an asset bubble is developing, should it use monetary policy to try to pop or prevent it? Were interest rates too low in 2002 to 2006? Did too low federal funds rates cause or contribute to the housing bubble? This debate is complex and thus far unresolved. Loose monetary policy does not necessarily lead to smaller credit spreads. There are open questions about the link between short-term interest rates and house price appreciation, whether housing starts are the best measure of the housing bubble, the timing of housing price increases relative to the interest rates in 2002 to 2006, the European comparison, and whether the magnitude of the bubble can be explained by the gap between the Taylor rule prescription and historic rates. At the same time, many observers argue that Taylor is right that short-term interest rates were too low during this period, and therefore that his argument is at least plausible if not provable. We conclude that global capital flows and risk repricing caused the credit bubble, and we consider them essential to explaining the crisis. U.S. monetary policy may have been an amplifying factor, but it did not by itself cause the credit bubble, nor was it essential to causing the crisis. The Commission should have focused more time and energy on exploring these questions about global capital flows, risk repricing, and monetary policy. Instead, the Commission focused thousands of staff hours on investigation and not nearly enough on analyzing these critical economic questions. The investigations were in many cases productive and informative, but there should have been more balance between investigation and analysis. Conclusions. The credit bubble was an essential cause of the financial crisis. Global capital flows lowered the price of capital in the United States and much of Europe. Over time, investors lowered the return they required for risky investments. Their preferences may have changed, they may have adopted an irrational bubble mentality, or they may have mistakenly assumed that the world had become safer. This inflated prices for risky assets. U.S. monetary policy may have contributed to the credit bubble, but did not cause it. End of section 156. Section 157 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Dissenting Statement, Causes of the Financial and Economic Crisis, the Housing Bubble. The housing bubble had two components, the actual homes and the mortgages that finance them. We look briefly at each component and its possible causes. There was a housing bubble in the United States. The price of U.S. housing increased by more than could be explained by market developments. This included both a national housing bubble and more concentrated regional bubbles in 4 sand states: California, Nevada, Arizona, and Florida. Conventional wisdom is that a bubble is hard to spot while you're in one and painfully obvious after it has burst. Even after the U.S. housing bubble burst, there is no consensus on what caused it. While we still don't know the relative importance of the possible causes of the housing bubble, we can at least identify some of the most important hypotheses. Population growth. Arizona, Florida, Nevada, and parts of California all experienced population growth that far exceeded the national average. More people fueled more demand for houses. Land use restrictions. In some areas, local zoning rules and other land use restrictions, as well as natural barriers to building, made it hard to build new houses to meet increased demand resulting from population growth. When supply is constrained and demand increases, prices go up. Over-optimism. Even absent market fundamentals driving up prices, shared expectations of future price increases can generate booms. This is a classic explanation of a bubble. Easy financing. Non-traditional and higher-risk mortgages made it easier for potential home buyers to borrow enough to buy more expensive homes. This doesn't mean they could afford those homes or future mortgage payments in the long run, but only that someone was willing to provide the initial loan. Mortgage originators often had insufficient incentive to encourage borrowers to get sustainable mortgages. Some combination of the first two factors may apply in parts of the Sand States, but these don't explain the nationwide increase in prices. The closely related and nationwide mortgage bubble was the largest and most significant manifestation of a more generalized credit bubble in the United States and Europe. Mortgage rates were low relative to the risk of losses, and risky borrowers who in the past would have been turned down found it possible to obtain a mortgage. In addition to the credit bubble, the proliferation of non-traditional mortgage products was a key cause of this surge in mortgage lending. Use of these products increased rapidly from the early part of the decade through 2006. There was a steady deterioration in mortgage underwriting standards, enabled by securitizers that lowered the credit quality of the mortgages they would accept, and credit rating agencies that overrated the subsequent securities and derivatives. There was a contemporaneous increase in mortgages that required little to no documentation. As house prices rose, declining affordability would normally have constrained land, but lenders and borrowers increasingly relied on non-traditional mortgage products to paper over this affordability issue. These mortgage products included interest-only adjustable rate mortgages, ARMs, pay option ARMs that gave borrowers flexibility on the size of early monthly payments, a negative amortization product in which the initial payment did not even cover interest costs. These exotic mortgage products would often result in significant reductions in the initial monthly payments compared with even a standard ARM. Not surprisingly, they were the mortgages of choice for many lenders and borrowers focused on minimizing initial monthly payments. Fed Chairman Bernanke sums up the situation this way. At some point, both lenders and borrowers became convinced that house prices would only go up. Borrowers chose and were extended mortgages that they could not be expected to service in the longer term. They were provided these loans on the expectation that accumulating home equity would soon allow refinancing into more sustainable mortgages. For a time, rising house prices became a self-fulfilling prophecy, but ultimately further appreciation could not be sustained and house prices collapsed. This explanation posits a relationship between the surge in housing prices and the surge in mortgage lending. There is not yet a consensus on which was the cause and which the effect. They appear to have been mutually reinforcing. In understanding the growth of non-traditional mortgages, it is also difficult to determine the relative importance of causal factors. But again, we can at least list those that are important. Non-bank mortgage lenders like New Century and Ameriquest flourished under ineffective regulatory regimes, especially at the state level. Weak disclosure standards and underwriting rules made it easy for irresponsible lenders to issue mortgages that would probably never be repaid. Federally regulated bank and thrift lenders such as Countrywide, Wachovia, and Washington Mutual had lenient regulatory oversight on mortgage origination as well. Mortgage brokers were paid for new originations but did not ultimately bear the losses on poorly performing mortgages. Mortgage brokers, therefore, had an incentive to ignore negative information about borrowers. Many borrowers neither understood the terms of their mortgage nor appreciated the risk that home values could fall significantly, while others borrowed too much and bought bigger houses than they could ever reasonably expect to afford. All these factors were supplemented by government policies, many of which had been in effect for decades, that subsidized home ownership but created hidden costs to taxpayers and the economy. Elected officials of both parties pushed housing subsidies too far. The Commission heard convincing testimony of serious mortgage fraud problems. Excruciating anecdotes showed that mortgage fraud increased substantially during the housing bubble. There is no question that this fraud did tremendous harm, but while that fraud is infuriating and may have been significant in certain areas, like Florida, the Commission was unable to measure the impact of fraud relative to the overall housing bubble. The explosion of legal but questionable lending is an easier explanation for the creation of so many bad mortgages. Lending standards were lax enough that lenders could remain within the law but still generate huge volumes of bad mortgages. It is likely that the housing bubble and the crisis would have occurred even if there had been no mortgage fraud. We therefore classify mortgage fraud not as an essential cause of the crisis, but as a contributing factor and a deplorable effect of the bubble. Even if the number of fraudulent loans was not substantial enough to have a large impact on the bubble, The increase in fraudulent activity should have been a leading indicator of deeper structural problems in the market. Conclusions. Beginning in the late 1990s and accelerating in the 2000s, there was a large and sustained housing bubble in the United States. The bubble was characterized both by national increases in house prices well above the historical trend and by more rapid regional boom and bust cycles in California, Nevada, Arizona, and Florida. There was also a contemporaneous mortgage bubble caused primarily by the broader credit bubble. The causes of the housing bubble are still poorly understood. Explanations include population growth, land use restrictions, bubble psychology, and easy financing. The causes of the mortgage bubble and its relationship to the housing bubble are also still poorly understood. Important factors include weak disclosure standards and underwriting rules for banks and non-bank mortgage lenders alike. The way in which mortgage brokers were compensated, borrowers who bought too much house and didn't understand or ignored the terms of their mortgages, and elected officials who over years piled on layer upon layer of government housing subsidies. Mortgage fraud increased substantially, but the evidence gathered by the Commission does not show that it was quantitatively significant enough to conclude that it was an essential cause. End of section 157. Section 158 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Dissenting Statement, Causes of the Financial and Economic Crisis, Turning Bad Mortgages into Toxic Financial Assets. The mortgage securitization process turned mortgages into mortgage-backed securities through the government-sponsored enterprises, GSEs, Fannie Mae and Freddie Mac, as well as Countrywide and other private label competitors. The securitization process allows capital to flow from investors to home buyers. Without it, mortgage lending would be limited to banks and other portfolio lenders, supported by traditional funding sources such as deposits. Securitization allows homeowners access to enormous amounts of additional funding and thereby makes home ownership more affordable. It also can diversify housing risk among different types of lenders. If everything else is working properly, these are good things. Everything else was not working properly. Some focus their criticism on the form of these financial instruments. For example, financial instruments called collateralized debt obligations, CDOs, were engineered from different bundled payment streams from mortgage-backed securities. Some argue that the conversion of a bundle of simple mortgages to a mortgage-backed security and then to a collateralized debt obligation was a problem. They argue that complex financial derivatives caused the crisis. We conclude that the details of this engineering are incidental to understanding the essential causes of the crisis. If the system works properly, reconfiguring streams of mortgage payments has little effect. The total amount of risk in a mortgage is unchanged if the pieces are put together in a different way. Unfortunately, the system did not work as it should have. There were several flaws in the securitization and collateralization process that made things worse. Fannie Mae and Freddie Mac, as well as Countrywide and other private label competitors, all lowered the credit quality standards of the mortgages they securitized. A mortgage-backed security was therefore worse during the crisis than in preceding years because the underlying mortgages were generally of poorer quality. This turned a bad mortgage into a worse security. Mortgage originators took advantage of these lower credit quality securitization standards and the easy flow of credit to relax the underwriting discipline in the loans they issued. As long as they could resell a mortgage to the secondary market, they didn't care about its quality. The increasing complexity of housing-related assets and the many steps between the borrower and final investor increased the importance of credit rating agencies and made independent risk assessment by investors more difficult. In this respect, complexity did contribute to the problem, but the other problems listed here are more important. Credit rating agencies assigned overly optimistic ratings to the CDOs built from mortgage-backed securities. By erroneously rating these bundles of mortgage-backed security payments too highly, the credit rating agencies substantially contributed to the creation of toxic financial assets. Borrowers, originators, securitizers, rating agencies, and the ultimate buyers of the securities into which the risky mortgages were packaged all failed to exercise prudence, and perform due diligence in their respective transactions. In particular, CDO buyers who were, in theory, sophisticated investors relied too heavily on credit ratings. Many financial institutions chose to make highly concentrated bets on housing prices. While in some cases they did that with whole loans, they were able to more easily and efficiently do so with CDOs and derivative securities. Regulatory capital standards, both domestically and internationally, gave preferential treatment to highly rated debt, further empowering the rating agencies and increasing the desirability of mortgage-backed structured products. There is a way that housing bets can be magnified using a form of a derivative. A synthetic CDO is a security whose payments mimic that of a CDO that contains real mortgages. This is a side bet that allows you to assume the same risk as if you held pieces of actual mortgages. To the extent that investors and financial institutions wanted to increase their bets on housing, they were able to use synthetic CDOs. The risks in these synthetic CDOs, however, are zero-sum, since for every investor making a bet that housing performance will fall, there must be other investors with equal-sized bets in the opposite direction. These are related but different problems. While many involve the word derivative, it is a mistake to bundle them together and say derivatives or CDOs caused the crisis. In each case, we assign responsibility for the failures to the people and institutions rather than to the financial instruments they used. Conclusions. Rather than derivatives and CDOs caused the financial crisis, it is more accurate to say securitizers lowered credit quarterly standards. Mortgage originators took advantage of this to create junk mortgages. Credit rating agencies assigned overly optimistic ratings. Securities investors and others failed to perform sufficient due diligence. International and domestic regulators encouraged arbitrage towards lower capital standards. Some investors use these securities to concentrate rather than diversify risk, and others use synthetic CDOs to amplify their housing bets. The dangerous imprecision of the term shadow banking. Part 2 of the majority's report begins with an extensive discussion of the failures of the shadow banking system, which it defines as a financial institutions and activities that in some respects parallel banking activities but are subject to less regulation than commercial banks. The majority's report suggests that the shadow banking system was a cause of the financial crisis. Shadow banking is a term used to represent a collection of different financial institutions, instruments, and issues within the financial system. Indeed, shadow banking can refer to any financial activity that transforms short-term borrowing into long-term lending without a government backstop. This term can therefore include financial instruments and institutions as diverse as the tri-party repo market, structured investment vehicles and other off-balance sheet entities used to increase leverage, Fannie Mae and Freddie Mac, credit default swaps, and hedge funds, monoline insurers, commercial paper, money market, mutual funds, and investment banks. As discussed in other parts of this paper, some of these items were important causes of the crisis. No matter what their individual roles in causing or contributing to the crisis, however, they are undoubtedly different. It is a mistake to group these issues and problems together. Each should be considered on its merits rather than painting a poorly defined swath of the financial sector with a common brush of too little regulation. End of section 158. Section 159 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Dissenting Statement, Causes of the Financial and Economic Crisis, Big Bank Bets and Why Banks Failed. The story so far involves significant lost housing, wealth, and diminished values of securities financing those homes. Yet even larger past wealth losses did not bring the global financial system to its knees. The key differences in this case were leverage and risk concentration. Highly correlated housing risk was concentrated in large and highly leveraged financial institutions in the United States and much of Europe. This leverage magnified the effect of a housing loss on a financial institution's capital reserve, and the concentration meant these losses occurred in parallel. In effect, many of the largest financial institutions in the world, along with hundreds of smaller ones, bet the survival of their institutions on housing prices. Some did this knowingly, others not. Many investors made 3 bad assumptions about U.S. housing prices. They assumed a low probability that housing prices would decline significantly. Prices were largely uncorrelated across different regions, so that a local housing bubble bursting in Nevada would not happen at the same time as one bursting in Florida, and a relatively low level of strategic defaults in which an underwater homeowner voluntarily defaults on a non-recourse mortgage. When housing prices declined nationally and quite severely in certain areas, these flawed assumptions, magnified by other problems described in previous steps, created enormous financial losses for firms exposed to housing investments. An essential cause of the financial and economic crisis was appallingly bad risk management by the leaders of some of the largest financial institutions in the United States and Europe. Each failed firm that the Commission examined failed in part because its leaders poorly managed risk. Based on testimony from the executives of several of the largest failed firms and the Commission staff's investigative work, we can group common risk management failures into several classes. Concentration of highly correlated housing risk. Firm managers bet massively on one type of asset, counting on high rates of return while comforting themselves that their competitors were doing the same. Insufficient capital. Some of the failed institutions were levered 35-to-1 or higher. This meant that every $35 of assets was financed with $1 of equity capital and $34 of debt. This made these firms enormously profitable when things were going well, but incredibly sensitive to even a small loss, as a 3% decline in the market value of these assets would leave them technically insolvent. In some cases, this increased leverage was direct and transparent. In other cases, firms used structured investment vehicles, asset-backed commercial paper conduits, and other off-balance sheet entities to try to have it both ways, further increasing their leverage while appearing not to do so. Highly concentrated, highly correlated risk combined with high leverage makes a fragile financial sector and creates a financial accident waiting to happen. These firms should have had much larger capital cushions and/or mechanisms for contingent capital upon which to draw in a crisis. Overdependence on short-term liquidity from repo and commercial paper markets. Just as each lacked sufficient capital cushions, in each case the failing firm's liquidity cushion ran out within days. The failed firms appear to have based their liquidity strategies on the flawed assumption that both the firm and these funding markets would always be healthy and functioning smoothly. By failing to provide sufficiently for disruptions in their short-term financing, management put their firm's survival on a hair trigger. Poor risk management systems. A number of firms were unable to easily aggregate their housing risks across various business lines. Once the market began to decline, those firms that understood their total exposure were able to effectively sell or hedge their risk before the market turned down too far. Those that didn't were stuck with toxic assets in a disintegrating market. Solvency failure versus liquidity failure. The Commission heard testimony from the former heads of Bear Stearns, Lehman, Citigroup, and AIG, among others. A common theme pervaded the testimony of these witnesses. We were solvent before the liquidity run started. Someone, unnamed, spread bad information and started an unjustified liquidity run. Had that unjustified liquidity run not happened, given enough time, we would have recovered and returned to a position of strength. Therefore, the firm failed because we ran out of time, and it's not my fault. In each case, experts and regulators contested the former CEO's "we were solvent" claim. Technical issues make it difficult to prove otherwise, especially because the answer depends on when solvency is measured. After a few days of selling assets at fire sale prices during a liquidity run, a highly leveraged firm's balance sheet will look measurably worse. In each case, whether or not the firm was technically solvent, the evidence strongly supports the claim that those pulling back from doing business with the firm were not irrational. In each of the cases we examined, there were huge financial losses that at a minimum placed the firm's solvency in serious doubt. Interestingly, in each case, the CEO was willing to admit that he had poorly managed his firm's liquidity risk, but unwilling to admit that his firm was insolvent or nearly so. In each case, the CEO's claims were highly unpersuasive. These firm managers knew or should have known that they were risking the solvency and therefore the survival of their firms. Conclusions. Managers of many large and mid-sized financial institutions in the United States and Europe amassed enormous concentrations of highly correlated housing risk on their balance sheets. In doing so, they turned a building housing crisis into a subsequent crisis of failing financial institutions. Some did this knowingly, others unknowingly. Managers of the largest financial firms further amplified these big, bad bets by holding too little capital and having insufficiently robust access to liquidity. Many placed their firms on a hair trigger by becoming dependent upon short-term financing from commercial paper and repo markets for their day-to-day funding. They placed failed solvency bets that their housing investments were solid, and failed liquidity bets that overnight money would always be there no matter what. In several cases, failed solvency bets triggered liquidity crises, causing some of the largest financial firms to fail or nearly fail. Investment banks caused the crisis. A persistent debate among members of the Commission was the relative importance of a firm's legal form and regulatory regime and the failures of large financial institutions. For example, commissioners agreed that investment bank holding companies were too lightly, barely regulated by the SEC lending up to the crisis, and that the Consolidated Supervised Entities Program of voluntary regulation of these firms failed. As a result, no regulator could force these firms to strengthen their capital or liquidity buffers. There was agreement among commissioners that this was a contributing factor to the failure of these firms. The Commission split, however, on whether the relatively weaker regulation of investment banks was an essential cause of the crisis. Institutional structure and differential regulation of various types of financial institutions were less important in causing the crisis than common factors that spanned different firm structures and regulatory regimes. Investment banks failed in the United States, and so did many commercial banks, large and small, despite a stronger regulatory and supervisory regime. Wachovia, for example, was a large insured depository institution supervised by the Fed, OCC, and FDIC. Yet it experienced a liquidity run that led to its near failure and prompted the first ever invocation of the FDIC's systemic risk exception. Insurance companies failed as well, notably AIG and the monoline bond insurers. Banks with different structures and operating in vastly differing regulatory regimes failed or had to be rescued in the United Kingdom, Germany, Iceland, Belgium, the Netherlands, France, Spain, Switzerland, Ireland, and Denmark. Some of these nations had far stricter regulatory and supervisory regimes than the United States. The bad loans in the United Kingdom, Ireland, and Spain were financed by federally regulated lenders, not by shadow banks. Rather than attributing the crisis principally to differences in the stringency of regulation of these large financial institutions, it makes more sense to look for common factors. Different types of financial firms in the United States and Europe made highly concentrated, highly correlated bets on housing. Managers of different types of financial firms in the United States and Europe poorly managed their solvency and liquidity risk. End of section 159. Section 160 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Dissenting Statement: Causes of the Financial and Economic Crisis. Two types of systemic failure. Government policymakers were afraid of large firms' sudden and disorderly failure and chose to intervene as a result. At times, intervention itself contributed to fear and uncertainty about the stability of the financial system. These interventions responded to two types of systemic failure. Systemic failure type 1, contagion. We begin by defining contagion and too big to fail. If financial firm X is a large counterparty to other firms, X's sudden and disorderly bankruptcy might weaken the finances of those other firms and cause them to fail. We call this the risk of contagion when, because of a direct financial link between firms, the failure of one causes the failure of another. Financial firm X is too big to fail if policymakers fear contagion so much that they are unwilling to allow it to go bankrupt in a sudden and disorderly fashion. Policymakers make this judgment in large part based on how much counterparty risk other firms have to the failing firm, along with a judgment about the likelihood and possible damage of contagion. Policymakers may also act if they worry about the effects of a failed firm on a particular financial market in which that firm is a large participant. The determination of too big to fail rests in the minds of the policymakers who must decide whether to bail out a failing firm. They may be more likely to act if they are uncertain about the size of counterparty credit risk or about the health of an important financial market, or if a broader market or economic conditions make them more risk-averse. This logic can explain the actions of policymakers in several cases in 2008. In March, the Fed facilitated J.P. Morgan's purchase of Bear Stearns by providing a bridge loan and loss protection on a pool of Bear's assets. While policymakers were concerned about the failure of Bear Stearns itself and its direct effects on other firms, their decision to act was heightened by their uncertainty about potential broader market instability and the potential impact of Bear Stearns' sudden failure on the tri-party repo market. In September, the Federal Housing Finance Agency, FHFA, put Fannie Mae and Freddie Mac into conservatorship. Policymakers, in effect, promised that the line would be drawn between debt and equity, such that equity holders were wiped out, but GSE debt would be worth 100 cents on the dollar. They made this decision because banking regulators and others treated Fannie and Freddie debt as equivalent to treasuries. A bank cannot hold all of its assets in debt issued by General Electric or AT&T, but can hold it all in Fannie or Freddie debt. The same is true for many other investors in the United States and around the world. They assumed that GSE debt was perfectly safe, and so they weighted it too heavily in their portfolios. Policymakers were convinced that this counterparty risk faced by many financial institutions meant that any write-down of GSE debt would trigger a chain of failures throughout the financial system. In addition, GSE debt was used as collateral in short-term lending markets, and by extension their failure would have led to a sudden massive contraction of credit beyond what did occur. Finally, mortgage markets depended so heavily on the GSEs for securitization that policymakers concluded that their sudden failure would effectively halt the creation of new mortgages. All three reasons led policymakers to conclude that Fannie Mae and Freddie Mac were too big to fail. In September, the Federal Reserve, with support from Treasury, bailed out AIG, preventing it from sudden disorderly failure. They took this action because AIG was a huge seller of credit default swaps to a number of large financial firms, and they were concerned that an AIG default would trigger mandatory write-downs on those firms' balance sheets, forcing counterparties to scramble to replace hedges in a distressed market and potentially triggering a cascade of failures. AIG also had important lines of business in ensuring consumer and business activities that would have been threatened by a failure of AIG's financial products division and potentially led to severe shocks to business and consumer confidence. The decision to aid AIG was also influenced by the extremely stressed market conditions resulting from other institutional failures in prior days and weeks. In November, the Federal Reserve, FDIC, and Treasury provided assistance to Citigroup. Regulators feared that the failure of Citigroup, one of the nation's largest banks, would both undermine confidence the financial system gained after TARP and potentially lead to the failures of Citi's major counterparties. Conclusion: the risk of contagion was an essential cause of the crisis. In some cases, the financial system was vulnerable because policymakers were afraid of a large firm's sudden and disorderly failure triggering balance sheet losses in its counterparties. These institutions were too big and interconnected to other firms, through counterparty credit risk, for policymakers to be willing to allow them to fail suddenly. Systemic failure type 2, a common shock. If contagion is like the flu, then a common shock is like food poisoning. A common factor affects a number of firms in the same way, and they all get sick at the same time. In a common shock, the failure of one firm may inform us about the breadth or depth of the problem, but the failure of one firm does not cause the failure of another. The common factor in this case was concentrated losses on housing-related assets in large and mid-sized financial firms in the United States and some in Europe. These losses wiped out capital throughout the financial sector. Policymakers were not just dealing with a single insolvent firm that might transmit its failure to others. They were dealing with a scenario in which many large, mid-size, and small financial institutions took large losses at roughly the same time. Conclusion. Some financial institutions failed because of a common shock. They made similar failed bets on housing. Unconnected financial firms were failing for the same reason and at roughly the same time because they had the same problem of large housing losses. This common shock meant the problem was broader than a single failed bank. Key large financial institutions were undercapitalized because of this common shock. We examined two frequently debated topics about the events of September 2008. The government should not have bailed out blank. Some argue that no firm is too big to fail and that policymakers erred when they bailed out Bear Stearns, Fannie and Freddie, AIG, and later Citigroup. In our view, this misses the basic arithmetic of policymaking. Policymakers were presented, for example, with the news that AIG is about to fail, and counseled that its sudden disorderly failure might trigger a chain reaction. Given the preceding failures of Fannie Mae and Freddie Mac, the Merrill Lynch merger, Lehman's bankruptcy, and the Reserve Primary Fund breaking the buck, market confidence was on a knife's edge. A chain reaction could cause a run on the global financial system. They feared not just a run on a bank, but a generalized panic that might crash the entire system. That is, the risk of an event comparable to the Great Depression. For a policymaker, the calculus is simple. If you bail out AIG and you're wrong, you will have wasted taxpayer money and provoked public outrage. If you don't bail out AIG and you're wrong, the global financial system collapses. It should be easy to see why policymakers favored action. There was a chance of being wrong either way, and the costs of being wrong without action were far greater than the costs of being wrong with action. Bernanke, Geithner, and Paulson should not have chosen to let Lehman fail. This is probably the most frequently discussed element of the financial crisis. To make this case, one must argue, Bernanke, Geithner, and Paulson had a legal and viable option available to them other than Lehman filing bankruptcy. They knew they had this option, considered it, and rejected it. They were wrong to do so. They had a reason for choosing to allow Lehman to fail. We have yet to find someone who can make a plausible case on all four counts. We think that these three policymakers would have saved Lehman if they thought they had a legal and viable option to do so. In hindsight, we also think they were right at the time. They did not have a legal and viable option to save Lehman. Many prominent public officials and market observers have accused these three of making a mistake. These critics usually argue that these three should have saved Lehman. When asked what else they could have done, the critics' usual response is, "I don't know, but surely they could have done something." They chose not to and caused the crisis. Those who want to label Lehman's failure a policy mistake are obliged to suggest an alternate course of action. The Fed's assistance for Bear Stearns and FDIC and Treasury's assistance for Wachovia followed a pattern. In each case, the failing firm or the government found a buyer and the government subsidized the purchase. In the case of Bear Stearns, the government subsidized the purchase, and in the case of Wachovia, the government made clear that assistance would be available if it were needed. The specific mechanics of the subsidy differed between the two cases, but in each bailout, the key condition was the presence of a willing buyer. Lehman had no willing buyer. Bank of America bought Merrill Lynch instead, and no other American financial institution was willing or able to step up. For months, government officials had tried and failed to facilitate transactions with possible domestic and foreign purchasers. At the end of Lehman weekend, the most viable candidate was the British bank Barclays. To make the purchase, Barclays needed either a shareholder vote, which would take several weeks to execute, or the permission of their regulator. They could get neither in the time available. Lehman was therefore facing an imminent liquidity run without a path to success. There was no buyer. There was the possibility that Barclays might be a buyer some weeks in the future. Bernanke, Geithner, and Paulson were then confronted with the question of whether to provide an effectively uncapped loan to Lehman to supplant its disappearing liquidity while Lehman searched for a buyer. This loan would have to come from the Fed, since before the enactment of the TARP legislation, Treasury had no authority to provide such financing. The law limits the Fed in these cases. The Fed can only provide secured loans. They were able to make this work for Bear Stearns and AIG because there were sufficient unencumbered assets to serve as collateral. Fed officials argue that Lehman had insufficient unpledged assets to secure the loan it would have needed to survive. Former Lehman executives and Fed critics argue otherwise, even though private market participants were unwilling to provide credit. Was there another option? The Fed leaders would have had to direct the staff to reevaluate in a more optimistic way the analysis of Lehman's balance sheet to justify a secured loan. They then would have had to decide to provide liquidity support to Lehman for an indefinite time period while Lehman searched for a buyer. That asset reevaluation would later have come under intense legal scrutiny, especially given the likely large and potentially uncapped cost to the taxpayer. In the meantime, other creditors to Lehman could have cashed out at 100 cents on the dollar, leaving taxpayers holding the bag for losses. Fed Chairman Bernanke, his General Counsel Scott Alvarez, and New York Fed General Counsel Thomas C. Baxter Jr. all argued in sworn testimony that this option would not have been legal. Bernanke suggested that it also would have been unwise because, in effect, the Fed would have been providing an open-ended commitment to allow Lehman to shop for a buyer. Bernanke testified that such a loan would merely waste taxpayer money for an outcome that was quite unlikely to change. Based on their actions to deal with other failing financial institutions in 2008, we think these policymakers would have taken any available option they thought was legal and viable. This was an active team that was in all cases erring on the side of intervention to reduce the risk of catastrophic outcomes. Fed Chairman Bernanke said that he was very, very confident that Lehman's demise was going to be a catastrophe. We find it implausible to conclude that they would have broken pattern on this one case at such an obviously risky moment if they had thought they had another option. Some find it inconceivable that policymakers could be confronted with a situation in which there was no legal and viable course of action to avoid financial catastrophe. In this case, that is what happened. End of section 160. Section 161 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Dissenting Statement: Causes of the Financial and Economic Crisis, the Shock and Panic. Conventional wisdom is that the failure of Lehman Brothers triggered the financial panic. This is because Lehman's failure was unexpected and because the debate about whether government officials could have saved Lehman is so intense. The focus on Lehman's failure is too narrow. The events of September 2008 were a chain of one firm failure after another. Sunday, September 7, FHFA put Fannie Mae and Freddie Mac into conservatorship. This was followed by Lehman weekend at the New York Fed, which was in fact broader than just Lehman. At the end of that week, Bank of America had agreed to buy Merrill Lynch. Lehman was filing for bankruptcy, and AIG was on the verge of failure. Monday, September 15, Lehman filed for Chapter 11 bankruptcy protection. Tuesday, September 16, the Reserve Primary Fund, a money market mutual fund, broke the buck after facing an investor run. Its net asset value declined below $1, meaning that an investment in the fund had actually lost money. This is a critical psychological threshold for a money market fund. On the same day, the Fed approved an $85 billion emergency loan to AIG to prevent it from sudden failure. Thursday, September 18, the Bush administration, supported by Fed Chairman Bernanke, proposed to congressional leaders that they appropriate funds for a new Troubled Asset Relief Program, TARP, to recapitalize banks. Friday, September 19, the $700 billion TARP was publicly announced. Sunday, September 21, the Fed agreed to accept Goldman Sachs and Morgan Stanley as bank holding companies, putting them under the Fed's regulatory purview. After this, there were no large standalone investment banks remaining in the United States. Thursday, September 25, the FDIC was appointed receiver of Washington Mutual and later sold it to J.P. Morgan. Monday, September 29, the TARP bill failed to pass the House of Representatives, and the FDIC agreed to provide assistance to facilitate a sale of Wachovia to Citigroup. Wednesday, October 1, the Senate passed a revised TARP bill. 2 days later, the House passed it and the President signed it into law. Wells Fargo, rather than Citigroup, bought Wachovia. As the month progressed, interbank lending rates soared, indicating the heightened fear and threatening a complete freeze of lending. The financial panic was triggered and then amplified by the close succession of these events, and not just by Lehman's failure. Lehman was the most unexpected bad news in that succession, but it's a mistake to attribute the panic entirely to Lehman's failure. There was growing realization by investors that mortgage losses were concentrated in the financial system, but nobody knew precisely where they lay. Conclusion. In quick succession in September 2008, the failure, near failure, or restructuring of the 10 firms triggered a global financial panic. Confidence and trust in the financial system began to evaporate as the health of almost every large and mid-sized financial institution in the United States and Europe was questioned. We briefly discussed 2 of these failures. The Reserve Primary Fund. The role of the Reserve Primary Fund's failure in triggering the panic is underappreciated. This money market mutual fund faced escalating redemption requests and had to take losses from its holdings of Lehman debt. On Tuesday, September 16, it broke the buck in a disorganized manner. Investors who withdrew early recouped 100 cents on the dollar, with the remaining investors bearing the losses. This spread fear among investors that other similarly situated funds might follow. By the middle of the following week, prime money market mutual fund investors had withdrawn $349 billion. When the SEC was unable to reassure market participants that the problem was isolated, money market mutual fund managers, in anticipation of future runs, refused to renew the commercial paper they were funding and began to convert their holdings to treasuries and cash. Corporations that had relied on commercial paper markets for short-term financing suddenly had to draw down their backstop lines of credit. No one had expected these corporate lines of credit to be triggered simultaneously, and this involuntary lending meant that banks would have to pull back on other activities. The role of Fannie Mae and Freddie Mac in causing the crisis. The government-sponsored enterprises Fannie Mae and Freddie Mac were elements of the crisis in several ways. They were part of the securitization process that lowered mortgage credit quality standards. As large financial institutions whose failures risked contagion, they were massive and multidimensional cases of the too-big-to-fail problem. Policymakers were unwilling to let them fail because financial institutions around the world bore significant counterparty risk to them through holdings of GSE debt. Certain funding markets depended on the value of their debt, and ongoing mortgage market operation depended on their continued existence. They were by far the most expensive institutional failures to the taxpayer and are an ongoing cost. There is vigorous debate about how big a role these 2 firms played in securitization relative to private label securitizers. There is also vigorous debate about why these 2 firms got involved in this problem. We think both questions are less important than the multiple points of contact Fannie Mae and Freddie Mac had with the financial system. These 2 firms were guarantors and securitizers, financial institutions holding enormous portfolios of housing-related assets, and the issuers of debt that was treated like government debt by the financial system. Fannie Mae and Freddie Mac did not by themselves cause the crisis, but they contributed significantly in a number of ways. End of section 161. Section 162 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Read by Claire. Dissenting Statement, Causes of the Financial and Economic Crisis, the System Freezing. Following the shock and panic, financial intermediation operated with escalating frictions. Some funding markets collapsed entirely. Others experienced a rapid blowout in spreads following the shock and stabilized slowly as the panic subsided and the government stepped in to backstop markets and firms. We highlight 3 funding markets here. Interbank lending. Lending dynamics changed quickly in the federal funds market, where bank loan excess reserves to one another overnight. Even large banks were unable to get overnight loans, compounding an increasingly restricted ability to raise short-term funds elsewhere. Repo. By September 2008, repo rates increased substantially and haircuts ballooned. Non-traditional mortgages were no longer acceptable collateral. Commercial paper. The failure of Lehman and the Reserve Primary Fund breaking the buck sparked a run on prime money market mutual funds. Money market mutual funds withdrew from investing in the commercial paper market, leading to a rapid increase in funding costs for financial and non-financial firms that relied on commercial paper. The inability to find funding, financial firm deleveraging, and macroeconomic weakness translated into tighter credit for consumers and businesses. Securitization markets for other kinds of debt collapsed rapidly in 2008 and still have not recovered fully, cutting off a substantial source of financing for credit cards, car loans, student loans, and small business loans. Decreased credit availability, the collapse of the housing bubble, and additional wealth losses from a declining stock market led to a sharp contraction in consumption and output and an increase in unemployment. Real GDP contracted at an annual rate of 4.0% in the third quarter of 2008, 6.8% in the fourth quarter, and 4.9% in the first quarter of 2009. The economic contraction in the fourth quarter of 2008 was the worst in nearly 3 decades. Firms and households that had not previously been directly affected by the financial crisis suddenly pulled back. Businesses stopped hiring and halted new investments, while families put spending plans on hold. After the panic began, the rate at which the economy shed jobs jumped, going from an average of 185,000 jobs lost per month in the first 3 quarters of 2008 to an average of over 700,000 jobs lost per month in the fourth quarter of 2008 and the first quarter of 2009. The economy continued to lose jobs through most of 2009, with the unemployment rate peaking at 10.1% in October 2009 and remaining above 9.5% for the rest of 2009 and the first 11 months of 2010. While the shock and panic therefore appear to have ended in early 2009, the harm to the real economy continues through today. Firms and families are still deleveraging and are uncertain about both future economic growth and the direction of future policy. The final tragedy of the financial and economic crisis is that the needed recovery is slow and looks to be so for a while longer. End of section 162.
Section 163 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Financial Crisis Inquiry Commission. Dissenting Statement. Introduction. Why a dissent? The question I have been most frequently asked about the Financial Crisis Inquiry Commission, the FCIC, or the Commission, is why Congress bothered to authorize it at all. Without waiting for the Commission's insights into the causes of the financial crisis, Congress passed and the President signed the Dodd-Frank Act, DFA, far-reaching and highly consequential regulatory legislation. Congress and the President acted without seeking to understand the true causes of the wrenching events of 2008, perhaps following the precept of the President's Chief of Staff, never let a good crisis go to waste. Although the FCIC's work was not the full investigation to which the American people were entitled, it has served a useful purpose by focusing attention again on the financial crisis and whether, with some distance from it, we can draw a more accurate assessment than the media did with what is often called the first draft of history. To avoid the next financial crisis, we must understand what caused the one from which we are now slowly emerging and take action to avoid the same mistakes in the future. If there is doubt that these lessons are important, consider the ongoing efforts to amend the Community Reinvestment Act of 1977, CRA. Late in the last session of the 111th Congress, a group of Democratic Congress members introduced H.R. 6334. This bill, which was lauded by House Financial Services Committee Chairman Barney Frank as his top priority in the lame duck session of that Congress, would have extended the CRA to all U.S. non-bank financial companies, and thus would apply to even more of the national economy the same government social policy mandates responsible for the mortgage meltdown and the financial crisis. Fortunately, the bill was not acted upon. Because of the recent election, it is unlikely that supporters of H.R. 6334 will have the power to adopt similar legislation in the next Congress, but in the future, other lawmakers with views similar to Barney Frank's may seek to mandate similar requirements. At that time, the only real bulwark against the government's use of private entities for social policy purposes will be a full understanding of how these policies were connected to the financial crisis of 2008. Like Congress and the administration, the Commission's majority erred in assuming that it knew the causes of the financial crisis. Instead of pursuing a thorough study, the Commission's majority used its extensive statutory investigative authority to seek only the facts that supported its initial assumptions, that the crisis was caused by deregulation or lax regulation, greed and recklessness on Wall Street, predatory lending on the mortgage market, unregulated derivatives, and a financial system addicted to excessive risk-taking. The Commission did not seriously investigate any other cause and did not effectively connect the factors it investigated to the financial crisis. The majority's report covers in detail many elements of the economy before the financial crisis that the authors did not like, but generally failed to show how practices that had gone on for many years suddenly caused a worldwide financial crisis. In the end, the majority's report turned out to be a just-so story about the financial crisis rather than a report on what caused the financial crisis. What caused the financial crisis? George Santayana is often quoted for the aphorism that those who cannot remember the past are condemned to repeat it. Looking back on the financial crisis, we can see why this study of history is often so contentious and why revisionist histories are so easy to construct. There are always many factors that could have caused a historical event. The difficult task is to discern which, among a welter of possible causes, were the significant ones, the ones without which history would have been different. Using this standard, I believe that the sine qua non of the financial crisis was U.S. government housing policy, which led to the creation of 27 million subprime and other risky loans, half of all mortgages in the United States, which were ready to default as soon as the massive 1997-2007 housing bubble began to deflate. If the U.S. government had not chosen this policy path, fostering the growth of a bubble of unprecedented size and an equally unprecedented number of weak and high-risk residential mortgages, the great financial crisis of 2008 would never have occurred. Initiated by Congress in 1992 and pressed by HUD in both the Clinton and George W. Bush administrations, the U.S. government's housing policy sought to increase home ownership in the United States through an intensive effort to reduce mortgage underwriting standards. In pursuit of this policy, HUD used 1. The affordable housing requirements imposed by Congress in 1992 on the government-sponsored enterprises, GSEs, Fannie Mae and Freddie Mac. 2. Its control over the policies of the Federal Housing Administration, FHA. And 3. A best practices initiative for subprime lenders and mortgage banks to encourage greater subprime and orange high-risk lending. HUD's key role in the growth of subprime and other high-risk mortgage lending is covered in detail in Part 3. Ultimately, all these entities, as well as insured banks covered by the CRA, were compelled to compete for mortgage borrowers who were at or below the median income in the areas in which they lived. This competition caused underwriting standards to decline, increased the numbers of weak and high-risk loans far beyond what the market would produce without government influence, and contributed importantly to the growth of the 1997-2007 housing bubble. When the bubble began to deflate in mid-2007, the low-quality and high-risk loans engendered by government policies failed in unprecedented numbers. The effect of these defaults was exacerbated by the fact that few, if any, investors, including housing market analysts, understood at the time that Fannie Mae and Freddie Mac had been acquiring large numbers of subprime and other high-risk loans in order to meet HUD's affordable housing goals. Alarmed by the unexpected delinquencies and defaults that began to appear in mid-2007, investors fled the multi-trillion-dollar market for mortgage-backed securities, MBS, dropping MBS values, and especially those MBS backed by subprime and other risky loans, to fractions of their former prices. Mark-to-market accounting then required financial institutions to write down the value of their assets, reducing their capital positions and causing great investor and creditor unease. The mechanism by which defaults and delinquencies on subprime and other high-risk mortgages were transmitted to the financial system as a whole is covered in detail in Part 2. In this environment, the government's rescue of Bear Stearns in March of 2008 temporarily calmed investor fears but created a significant moral hazard. Investors and other market participants reasonably believed, after the rescue of Bear, that all large financial institutions would also be rescued if they encountered financial difficulties. However, when Lehman Brothers, an investment bank even larger than Bear, was allowed to fail, market participants were shocked. Suddenly, they were forced to consider the financial health of their counterparties, many of which appeared weakened by losses and the capital write-downs required by mark-to-market accounting. This caused a halt to lending and a hoarding of cash, a virtually unprecedented period of market paralysis and panic that we know as the financial crisis of 2008. Weren't there other causes of the financial crisis? Many other causes of the financial crisis have been cited, including some in the report of the Commission's majority, but for the same reasons outlined below, none of them alone, or all in combination, provides a plausible explanation of the crisis. Low interest rates and a flow of funds from abroad. Claims that various policies or phenomena, such as low interest rates in the early 2000s or financial flows from abroad, were responsible for the growth of the housing bubble, do not adequately explain either the bubble or the destruction that occurred when the bubble deflated. The U.S. has had housing bubbles in the past, most recently in the late 1970s and late 1980s, but when these bubbles deflated, they did not cause a financial crisis. Similarly, other developed countries experienced housing bubbles in the late 2000s, some even larger than the U.S. bubble, but when their bubbles deflated, the housing losses were small. Only in the U.S. did the deflation of the most recent housing bubble cause a financial meltdown and a serious financial crisis. The reason for this is that only in the U.S. did subprime and other risky loans constitute half of all outstanding mortgages when the bubble deflated. It wasn't the size of the bubble that was the key, it was its content. The 1997-2007 U.S. housing bubble was in a class by itself. Nevertheless, demand by investors for the high yields offered by subprime loans stimulated the growth of a market for securities backed by these loans. This was an important element in the financial crisis, although the number of mortgages in this market was considerably smaller than the number fostered directly by government policy. Without the huge number of defaults that arose out of U.S. housing policy, defaults among the mortgages in the private market would not have caused a financial crisis. Deregulation or lax regulation. Explanations that rely on lack of regulation or deregulation as a cause of the financial crisis are also deficient. First, no significant deregulation of financial institutions occurred in the last 30 years. The repeal of a portion of the Glass-Steagall Act, frequently cited as an example of deregulation, had no role in the financial crisis. The repeal was accomplished through the Gramm-Leach-Bliley Act of 1999, which allowed banks to affiliate for the first time since the New Deal with firms engaged in underwriting or dealing in securities. There is no evidence, however, that any bank got into trouble because of a securities affiliate. The banks that suffered losses because they held low-quality mortgages or MBS were engaged in activities, mortgage lending, always permitted by Glass-Steagall. The investment banks that got into trouble, Bear Stearns, Lehman, and Merrill Lynch, were not affiliated with large banks, although they had small bank affiliates that do not appear to have played any role in mortgage lending or securities trading. Moreover, the Federal Deposit Insurance Corporation Improvement Act of 1991, FDICIA, substantially increased the regulation of banks and savings and loan institutions, S&Ls, after the S&L debacle in the late 1980s and the early 1990s, and it is noteworthy that FDICIA the most stringent bank regulation since the adoption of deposit insurance, failed to prevent the financial crisis. The shadow banking business. The large investment banks, Bear, Lehman, Merrill, Goldman Sachs, and Morgan Stanley, all encountered difficulty in the financial crisis, and the Commission's Majorities Report lays much of the blame for this at the door of the Securities and Exchange Commission, SEC, for failing adequately to supervise them. It is true that the SEC's supervisory process was weak, but many banks and S&Ls, stringently regulated under FDICIA, also failed. This cast doubt on the claim that if investment banks had been regulated like commercial banks, or had been able to offer insured deposits like commercial banks, they would not have encountered financial difficulties. The reality is that the business model of the investment banks was quite different from banking. It was to finance a short-term trading business with short-term liabilities, such as repurchase agreements, often called repos. This made them especially vulnerable in the panic that occurred in 2008, but it is not evidence that the existence of investment banks or the quality of their regulation was a cause of the financial crisis. Failures of risk management. Claims that there was a general failure in risk management in financial institutions or excessive leverage or risk-taking are part of what might be called a hindsight narrative. With hindsight, it is easy to condemn managers for failing to see the dangers of the housing bubble or the underpricing of risk that now looks so clear. However, the FCIC interviewed hundreds of financial experts, including senior officials of major banks, bank regulators, and investors. It is not clear that any of them, including the redoubtable Warren Buffett, were sufficiently confident about an impending crisis that they put real money behind their judgment. Human beings have a tendency to believe that things will continue to go in the direction they are going and are good at explaining why this must be so. Blaming the crisis on the failure to foresee it is facile and of little value for policymakers who cannot legislate prescience. The fact that virtually all participants in the financial system failed to foresee this crisis, as they failed to foresee every other crisis, does not tell us anything about why this crisis occurred or what we should do to prevent the next one. Securitization and structured products. Securitization, often pejoratively described as the originate-to-distribute process, has also been blamed for the financial crisis. But securitization is only a means of financing. If securitization was a cause of the financial crisis, so was lending. Are we then to condemn lending? For decades, without serious incident, securitization has been used to finance car loans, credit card loans, and jumbo mortgages that were not eligible for acquisition by Fannie Mae and Freddie Mac. The problem was not securitization itself, it was the weak and high-risk loans that securitization financed. Under the category of securitization, it is necessary to mention the role of collateralized debt obligations, known as CDOs. These instruments were toxic assets because they were ultimately backed by the subprime mortgages that began to default in huge numbers when the bubble deflated, and it was difficult to determine where those losses would ultimately settle. CDOs, accordingly, for all their dramatic content, were just another example of the way in which subprime and other high-risk loans were distributed throughout the world's financial system. The question still remains why so many weak loans were created, not why a system that securitized good assets could also securitize bad ones. Credit default swaps and other derivatives. Despite a diligent search, the FCIC never uncovered evidence that unregulated derivatives, and particularly credit default swaps, CDS, was a significant contributor to the financial crisis through interconnections. The only company known to have failed because of its CDS obligations was AIG, and that firm appears to have been an outlier. Blaming CDS for the financial crisis because one company did not manage its risks properly is like blaming lending generally when a bank fails. Like everything else, derivatives can be misused, but there is no evidence that the interconnections among financial institutions alleged to have caused the crisis were significantly enhanced by CDS or derivatives generally. For example, Lehman Brothers was a major player in the derivatives market, but the Commission found no indication that Lehman's failure to meet its CDS and other derivatives obligations caused significant losses to any other firm, including those that had written CDS on Lehman itself. Predatory lending. The Commission's report also blames predatory lending for the large buildup of subprime and other high-risk mortgages in the financial system. This might be a plausible explanation if there were evidence that predatory lending was so widespread as to have produced the volume of high-risk loans that were actually originated. In predatory lending, unscrupulous lenders take advantage of unwitting borrowers. This undoubtedly occurred, but it also appears that many people who received high-risk loans were predatory borrowers or engaged in mortgage fraud because they took advantage of low mortgage underwriting standards to benefit from mortgages they knew they could not pay unless rising housing prices enabled them to sell or refinance. The Commission was never able to shed any light on the extent to which predatory lending occurred. Substantial portions of the Commission Majority's report describe abusive activities by some lenders and mortgage brokers, but without giving any indication of how many such loans were originated. Further, the Majority's report fails to acknowledge that most of the buyers for subprime loans were government agencies or private companies complying with government affordable housing requirements. Why couldn't we reach agreement? After the Majority's report is published, many people will lament that it was not possible to achieve a bipartisan agreement on the facts. It may be a surprise that I'm asking the same question. If the Commission's investigation had been an objective and thorough investigation, many of the points I raised in this dissent would have been known to the other commissioners before reading this dissent and perhaps could have been influential with them. Similarly, I might have found facts that changed my own view, but the Commission's investigation was not structured or carried out in a way that could ever have garnered my support or, I believe, the support of the other Republican members. One glaring example will illustrate the Commission's lack of objectivity. In March 2010, Edward Pinto, a resident fellow at the American Enterprise Institute AEI, who had served as Chief Credit Officer at Fannie Mae, provided to the Commission staff a 70-page, fully sourced memorandum on the number of subprime and other high-risk mortgages in the financial system immediately before the financial crisis. In that memorandum, Pinto recorded that he had found over 25 million such mortgages. His later work showed that there were approximately 27 million. Since there are about 55 million mortgages in the U.S., Pinto's research indicated that, as the financial crisis began, half of all U.S. mortgages were of inferior quality and liable to default when housing prices were no longer rising. In August, Pinto supplemented his initial research with a paper documenting the efforts of the Department of Housing and Urban Development, HUD, over 2 decades and through 2 administrations to increase home ownership and reducing mortgage underwriting standards. This research raised important questions about the role of government housing policy in promoting the high-risk mortgages that played such a key role in both the mortgage meltdown and the financial panic that followed. Any objective investigation of the causes of the financial crisis would have looked carefully at this research, exposed it to the members of the Commission, taken Pinto's testimony, and tested the accuracy of Pinto's research. But the Commission took none of these steps. Pinto's research was never made available to the other members of the FCIC or even to the commissioners who were members of the subcommittee charged with considering the role of housing policy in the financial crisis. Accordingly, the Commission's Majority report ignores hypotheses about the causes of the financial crisis that any objective investigation would have considered, while focusing solely on theories that have political currency but far less plausibility. This is not the way a serious and objective inquiry should have been carried out, but that is how the Commission used its resources and its mandate. There were many other deficiencies. The scope of the Commission's work was determined by a list of public hearings that was handed to us in early December 2009. At that point, the Commission members had never discussed the possible causes of the crisis, and we were never told why those particular subjects were important or were chosen as the key issues for the set of hearings that would form a backbone of all the Commission's work. The Commission members did not get together to discuss or decide on the causes of the financial crisis until July 2010, well after it was too late to direct the activities of the staff. The Commission interviewed hundreds of witnesses, and the Majority's report is full of statements, such as Smith told the FCIC that. However, unless the meeting was public, the commissioners were not told that an interview would occur, did not know who was being interviewed, were not encouraged to attend, and of course did not have an opportunity to question these sources or understand the context in which the quoted statements were made. The Commission's Majorities Report uses these opinions as substitutes for data, which is notably lacking in the report. Opinions in general are not worth much, especially in hindsight and when given without opportunity for challenge. The Commission's authorizing statute required that the Commission report on or before December 15, 2010. The original plan was for us to start seeing drafts on the report in April. We didn't see any drafts until November. We were then given an opportunity to submit comments in writing, but never had an opportunity to go over the wording as a group or to know whether our comments were accepted. We received a complete copy of the Majorities Report for the first time on December 15. It was almost 900 double-spaced pages long. The date for approval of the report was 8 days later on December 23. That is not the way to achieve a bipartisan report or the full agreement of any group that takes the issues seriously. This dissenting statement is organized as follows. Part 1 summarizes the main points of the dissent. Part 2 describes how the failure of subprime and other high-risk mortgages drove the growth of the bubble and weakened financial institutions around the world when these mortgages began to default. Part 3 outlines in detail the housing policies of the U.S. government that were primarily responsible for the fact that approximately one-half of all U.S. mortgages in 2007 were subprime or otherwise of low quality. Part 4 is a brief conclusion. End of section 163.